pressing airlines. So this more out of the administration, more out of the White House, particularly around what they're looking to do to try and help out consumers. But, what is within these talks and what's actually going to come at the end of it?
There's just not much that the administration can do on its own. What might make a difference, or at least make it look as if Democrats are on the ball, is if they could pass some sort of legislation. And there still is a chance they could pass, I guess, what you might call the remnants of Biden's Build Back Better plan, which might be some kind of green energy tax credits, but perhaps very minimal social welfare spending. But honestly, at this point, people don't want to hear about green energy. They just don't want to hear it right now. People want to know, a lot of people are like, I get it. We need to address climate change, which is a very long-term problem. What are you going to do for me right now? And, here's what we're going to see. We're going to see Biden going over to Saudi Arabia this summer. What he needs to deliver from that trip is a tangible outcome in terms of more Saudi Arabian oil output. And there are some other things they're working on. There just are no quick fixes to this inflation problem.
And Rick, it doesn't sound like President Biden might be getting much support from the business community. A good survey, or a dour survey, I should say, from the Conference Board out today, just looking at waning consumer confidence amongst the business community and the leaders that, in fact, are running these large companies.
Yeah, and in that survey, something like 60% of CEOs and business leaders say they do expect a recession in 12 to 18 months. I mean, guys, do you feel like I do? Let's just start the recession today. Let's get into it and get it over
Rick, I wonder if we're in one.
We're talking ourselves into a recession here. And we're not in a recession here in the United States. So one thing I'll say about that that Conference Board survey, that was a survey of global business leaders, and the economy in other parts of the world is worse than it is here. Europe may already be in a recession, and they are far more exposed to higher energy prices due to Russia's invasion of Ukraine than we are here in the United States. So Biden did say in his AP interview yesterday, he said, we're in the United States, we're really in about the best position of any leading country in terms of our economy. He's right about that. But again, you're not going to talk Americans into a better mood by saying, don't worry, other people have it worse. So we may be sort of the cleanest dirty shirt, if you will, but this is just not going to persuade people that these are good times in America.
Well put as always. Yahoo Finance's Rick Newman. Thanks so much.
Bye, guys.
Okay, let's continue our discussion on this week's wild market conditions with Tony Crescenzi, PIMCO market strategist and portfolio manager. Good to see you here this morning, Tony. It's been a while. Look, we just got commentary from Fed Chief Jerome Powell moments ago saying they are acutely focused, that is the Fed, on fighting inflation. Do you think this market has fully priced in a more aggressive Federal Reserve?
We don't know, and that's the angst that the markets are displaying once again today, and of course yesterday. There's a wide band of uncertainty regarding how high the Fed has to go in order to fix the current inflation problem. Market participants are quite confident that the Fed will ultimately be successful. In fact, as we know, there's an adage, don't fight the Fed, and don't fighting the Fed today means believing in its idea that the inflation rate will go down to the 2% objective that Jerome Powell, Fed chair, mentioned today. The issue for markets and market participants is what it will take to get there. Currently, market participants think that the Fed will move to about 4% on its funds rate, add in the equivalent of about 100 basis points of tightening from its balance sheet reduction, $1 trillion per year, 3 years, it equals roughly a point in terms of total monetary tightening. So 500 basis points of total monetary tightening is now built into market prices, and there's a substantial negative fiscal impulse this year, a $1 trillion reduction in spending, according to the Congressional Budget Office, to $5.8 trillion. That brings the deficit down 8 points to 4.2%. And the last component of this tightening is, of course, the pain that we're all experiencing in the financial markets. Financial conditions indices suggest the biggest tightening of financial conditions in magnitude in terms of movement since 2008, and perhaps on par or equal to, or greater than. The level of financial conditions that could be considered still helpful to the economy, if you will. They're still not tight overall. but the amount of tightness has been severe. So there's a lot of uncertainty, a lot of tightening built in, but it's still not enough for the average market participant.
Tony, off of Fed Chair Powell's comments this morning, we've just seen the Dow turn negative here after being up triple digits. And so for the markets that are trying to price in all of the Fed speak that's been taking place, how far out are the markets looking, if we can put a timeline on this?
Well, I struggle to give an answer because there's even 1 month's data could change the view materially. We saw that last week with the CPI. It changed views materially. So did the University of Michigan Consumer Sentiment Index, which showed inflation expectations rising. It's something that the Fed chair mentioned as one of the factors that led to the 75 basis point increase. And so market participants will be on edge with those types of data, inflation data, for some time. So market participants are confident the inflation rate will come down. You see this in the inflation products. You see it in various gauges the Fed looks at, something called the five-year. There are numerous things that suggest market participants are confident, but it's the general public that has to be convinced in a Volcker-esque type of way, perhaps. And that's the worry. And if you did a search on Mr. Volcker, you'd see lots of stories about and references to Mr. Volcker today. The Fed chair, of course, tightened aggressively to fix the 70s inflation problem that many say is a result of lax policy from Fed chairs Arthur Burns and G. William Miller from 1970 to 78.
Tony, well, if we're back in that a Volcker-like environment and we're seeing a period of stagflation in this environment, where does that general public go to make money?
Well, we are all experiencing turbulence. Investors are experiencing turbulence, and we're all pilots to our portfolios. And what does a pilot do in an airplane when there's turbulence? Try to find smooth air. How does an investor do that today? Simply by taking a long-term orientation. You have to think about the various types of companies and sectors that one thinks will fare well in the years to come. And on the interest rate front, we would say that today's interest rate levels are quite attractive for fixed income and other investors. Think about the Bloomberg aggregate, a yield of about 4.1%. That's well above what's expected to be the inflation rate, at least according to Jerome Powell today, who said the Fed's acutely determined to get the inflation rate down to 2%. Let's say the Fed doesn't get it there and gets to 2.5% or even 3%. There's a good cushion now, a real yield, as they say, a yield that's above the expected inflation rate. So an investor should take the long-term view and perhaps think about where they were a year ago when yields were in the ones and when they were dreaming of the idea of getting 4% on high-quality bonds. So take the long-term view.
So for investors that are looking for that smooth air, particularly we've heard from companies that are investing for the next 3 to 5 years in that next wave of growth. But in a recessionary environment, if you see cutbacks on spending or at least or even restructuring within some of these companies, and that retracts or retraces some of that vision that they had put out there and said we were going to be spending aggressively on, how vastly different do these companies look versus now? And going into the future, are they still going to be spending towards some of those larger goals?
Well, you're right that in the near term, there will be cutbacks and even verbal commitments on things will perhaps be scaled back. This is the normal human reaction to react to fear and anxiety, which is to retrench a bit. But ultimately, at least this is what's occurred for decades or even literally hundreds of years, the capitalist mindset will likely return. This idea of the profit motive and also the desire to live better. Think of Adam Smith in the 1700s in The Wealth of Nations, who said basically that people in desiring to improve the way of living would improve and increase the wealth of nations. And so you should put your faith in that, because we all want to live better and have better things and to make more money. And so that's still intact. And so there'll be certain companies, perhaps sectors, that don't make it out of this. That's part of the creative destruction process. And that's why it's really important to think from the bottom up as well as the top down in terms of the types of sectors, companies, et cetera, that will thrive in what we think is a very bright outlook.
Tony Crescenzi, who is the portfolio manager and market strategist over at PIMCO. Thanks so much for joining us this morning with your insight. We appreciate it. You guys, coming up, crypto crash. The crypto winter has just begun and it might be getting colder. Rich Parker's out. We're going to break down all the action from a very rough week for Bitcoin and friends.
Breaking news, the FDA has authorized both Moderna and Pfizer's COVID-19 vaccine for kids under 5. Both vaccines still need final sign-off from the CDC, which is anticipated this weekend. Let's take a look at shares of both of those companies here in the early going, or I should say in the pre-market. Muted reaction so far, but indicating a higher open.
Switching gears, everyone, crypto has not been spared by the current market volatility. Bitcoin now trading at levels not seen since 2020. So let's toss it on over to Inez Foray at the Wi-Fi Interactive for more on this crypto route. Inez, great to see you.
Yeah, great to see you guys. Well, it's been a rough week for crypto holders, as we've seen a Bitcoin that is lower this week. And it all really started when you had Celsius that halted the crypto platform, which halted withdrawals, transfer swaps of Bitcoin. You also had Coinbase, which announced that it was laying off this week 18% of its workforce, with CEO Brian Armstrong talking about a possible recession and a crypto winter. And then in the backdrop of all of this, you had, of course, Bitcoin, which is the flagship crypto. And Bitcoin, I'm just going to pull up a 10-day chart because we really saw over the last 10 days down 33%. A month-to-date chart, you can see it was around 31,000. Right now, it's at the just below the 21,000 level. And guys, this really goes to that point, and I know that Julie has mentioned this before, that crypto, Bitcoin, seen by some as it was being talked about a hedge against inflation. When stocks go up or when stocks go down, Bitcoin will go up. No, it has not proven the case. And in fact, when you see the Fed tightening its screws, all asset classes come down.
Yeah, indeed, they in fact have. And as Foray, thanks so much. And Brad, this is, when I talk to folks on the street, I don't hear anyone saying, I'm excited about crypto. I want to get in and buy this dip on crypto. I love that Coinbase is down 50, 60%. Let me back up the truck and buy this. I'm not hearing any of that sentiment out there. Nothing.
If anything right now, I think what we will hear is some of the major crypto bulls that are out there who have invested either in directly crypto or in some of the crypto touching platforms. They're going to continue to try and say, okay, even with this move lower, you've got to like the fact that a lot of the other speculative assets are going to get the rug pulled out from underneath of them and create more viability. That could, by the way, create more viability for the larger market capitalization currencies, whether that be Bitcoin, whether that be Ethereum. And I, as I've always talked about in the past, a firm believer or bullish in the flippening, which is where Ethereum takes over the value of Bitcoin. I think still, even from this point, it's going to come down to not just proof of concept, proof of scaling is going to need to be next as well when you have even more people that want to tap into the blockchain. And this, I think, for one thing, in all of the downward movements, it gives people more of an opportunity to get educated on this and perhaps do even more due diligence than people do when something is on the rise, on the way up, and seeing some of these astronomical rises, because then it's just like, all right, a FOMO trade at that point.
Isn't that a movie, Bullish in the Flippening?
Bullish in the Flipping?
Yeah, I think
it's
it. If not,
we're making it this weekend.
I'm making the joke. It's Friday. That's what we're doing. Markets under pressure. That's what we're doing here. All right, coming up, Adobe has the hottest ticker page on Yahoo Finance right now. We're back with the details next. Shares of Adobe are under pressure this morning after reporting mixed earnings and a worse than expected outlook. And Brad, a couple things to pick apart here with Adobe. And as I mentioned, it's also the top trending ticker on the Yahoo Finance platform this morning. They lowered their guidance for its current fiscal year by $250 million. And they're pinning the blame on FX headwinds, just like Microsoft we've been talking about all week. Another big cap tech company warning about the revenue and profit hit from various foreign exchange moves. Also a $75 million hit from the Ukraine war. I have to knock Adobe's executive team here. You know, I listened to that earnings call, and there was really no acknowledgement of what is happening in the world. And right now, for me, I'm giving high marks to executive teams that are hopping on these calls and various investor presentations out there on Wall Street. They're all happening over the next few weeks still, that are keeping it real.
Yeah.
You know, I understand DocuSign CEO Dan Springer, he came on with us last week, challenging quarter. He told it like it was. You hopped on this Adobe call, and it sounds like a bunch of executives that are setting their investors up for failure when they report 3 months from now. You would think GDP was growing 6 or 7% and consumer spending was going through the roof, and interest rates were still at rock bottom levels.
Yeah, and there is that realism in the forecast versus the actuality of what they're trying to redirect towards. And if there's anything, they're trying to ensure that in all of these companies, when they're continuing to invest in some of these core categories like digital media and net new digital media, that all sounds great, but at the end of the day, when we boil down to how they're going to continue, even in this environment, to see internationally, as we were just talking about a moment ago, Europe possibly already being in a recession, how does that dampen what your outlook looks like and where you're actually going to see some of that continued run rate from this point forward if businesses and end consumers, which is what this company dabbles in both sides of that, B2B and B2C, if they're getting hit on both of those ends.
No, right on. And you know, I can't help but to think if they would have read the room right, use this type of environment to just keep it real with your investors. We all see what's going on in this world, various inflationary pressures, consumers pulling back, and businesses also pulling back on how much they do spend. I understand digital opportunities are amazing, and you want to position yourself the future of cloud services, but you know what? Businesses are in fact pulling back. And then I look at the valuation of Adobe. It's not priced for recession. It's still trading at almost 30 times forward earnings, according to data on Yahoo Finance Plus, a PEG ratio of almost 2 times. And again, this comes as slowing growth starts to set into this company.
There will be companies over the course of this next earnings season that will be extremely real with us, and there will be those that are almost overly real to the point where it seems like they might be sandbagging even in order to just beat on some depressed kind of outlooks as well.
Yeah, well, here we're coming up against that opening bell on Wall Street. What could be a very interesting trading session in light of new commentary, Fed Chief Jerome Powell. There's that opening bell. And there you can see over at the NASDAQ, I have to give a shout out to the team at NASDAQ. That is the first opening bell, I believe, in the metaverse. So that is, you are looking at a potential future for opening bells here, at least over at the NASDAQ, that is, an opening bell in the metaverse. And Brad, I've truly seen it all. I lived through the great financial crisis. I watched values of bank stocks get wiped out 70 to 80%. Now I'm sitting here today with you, my friend, watching an opening bell essentially in a video game. Okay,
so you know I used to work in that building every day. Not this one. I wonder how much that real estate costs in the metaverse, because we know some of the spots in Decentraland are coming in pretty high.
And probably more money than you and I have. Of course, this opening bell sponsored by our friends over at FlexShares.
All right, switching gears, everyone. Let's talk a little bit about travel here, even as we're opening up the markets here on the day. The Dow Jones Industrial Average, you're seeing that open lower by about 25-ish points there. And then additionally, we saw the NASDAQ and the S&P 500 just barely holding on to some gains right now. Also taking a look at some of the travel sector stocks, airline stocks, they're holding on to gains this morning as summer travel demand is in full swing, but with rising inflation and ticket prices already sky high, how long will the demand last? We may have seen it start to show yesterday as airline stocks, they did fall yesterday, but the broader markets were down extremely.
Can I just go back into that metaverse? I just want to go back into the NASDAQ metaverse.
Yeah,
it's been a long week.
Scotty.
I just want to get back in there. But look, I've been watching these travel stocks all week long, and it's getting really, really ugly. But let's zoom out a little bit here. Let's look at the 1 month chart for some of these names. Delta down 17%. We've got Carnival Cruise Line down 40% in a month. You have Norwegian Cruise Line down 31%. There's a couple things going on here. One, all these companies have large, sizable debt positions on their balance sheet. When you start to think about recession or go into one, that is the last place you want to be, which could come at a time where consumers are pulling back. So your top line sales are slowing down at a time where you have significant debt commitments coming outside of the coming out of the pandemic is not exactly a recipe for stock price appreciation. And then, look at the airlines too, and a good pricing study over at Adobe Their most recent data showed prices for domestic flights in May up 30% over 2019.
Yeah.
That is a huge increase to the point where you have to wonder, do consumers start to pull back on taking a trip here when you have prices up by that much?
Well, let's talk about some of the macro effects around this, and some of them overlap, some of them don't here. Specifically, when you talk about Carnival, cruise lines, or any of the cruise line operators, and then also the fuel prices that they have to take on, as well as the airline operators do, and those costs getting passed on through consumers. Consumers are seeing higher ticket prices, but then once they're in the experience too, they're going to see higher prices for everything that they're paying for just to have the fullness of that experience economy within the cruise line operator or even within that flight that they're taking as well. Now, the difference is here, operationally wise, for cruise lines, they were in a period of re-engagement, trying to get passengers back on. For the airlines, what we had already heard earlier this year was that they were seeing leisure travel demand start to tick up, and that business travelers, when they came back, they were going to be competing with the leisure travelers. So as long as that remains intact, and there's a question of if there will be some at least modest demand destruction in this current quarter and then even in future quarters because of what those same customers are impacting elsewhere when they're moving about the country, or even just when they're purchasing groceries or gas on a day in, day out basis, how that will have a knock-on effect on some of those other travel experiences as well. We didn't even get into the accommodation space, which is undergoing its own type of, I think, headcount overhaul. Also, just the type of experiences that they're bringing into some of those different stay packages as well.
I did find where flights are free. They're in the metaverse. They don't cost anything in the metaverse. Yeah, I'll send you the link. You can sign up for it.
Done deal. Cheap flights.
All right, shares of World Wrestling Entertainment, another stock that's going to be in focus today after news that Vince McMahon will be stepping down as CEO while the wrestling company's board investigates him for alleged misconduct. In the meantime, his daughter, Stephanie McMahon, will serve as interim CEO and chairwoman. You can see the shares down slightly here in the early going. Look, this comes after an extensive report by the Wall Street Journal a couple days ago, but worth keeping in mind here, I think, two things. One, Stephanie McMahon is running the company. Obviously, that is Vince McMahon's daughter. So if there's any positive here from an investor standpoint, at least she understands the company and what it has done in the history of the company. And then, but secondarily, look, they still control the company. The Journal story early in the week goes through great lengths explaining that he still controls voting power of what ultimately would happen in this company. So just because Vince McMahon is leaving as CEO, he's still retaining his creative role inside the company, which one that he has valued for many, many years. Don't expect WWE to come in here and somebody to buy the company or be sold. It still runs the McMahon family.
You know, there's a lot of other considerations too in terms of the partnerships that WWE has been able to take on over the course of this year, whether that be new individual partnerships on the name, image, and likeness front. Do you see some of those partners start to back out? Do you also, across some of the corporate partnerships, whether that be in streaming or gaming, where WWE, and I don't know gaming and gambling on WWE, but for all the partnerships that they've seen come about, where do you start to look across those? And in the midst of this and in the wake of this investigation, do some of those start to kind of pull back on, you know, what they had charted going forward for the eyeballs, the impressions, and the reach that the WWE was looking for? But that is just one of the impacts that they have to consider here, and it'll be interesting to see how Stephanie McMahon, who's taking over in the interim position and capacity right now, navigates all of that.
And of course, the television deals too.
Massive.
Yeah, massive indeed. Well, all right, switching gears, or actually just staying on entertainment here. Shares of Disney haven't been very happily ever after. Shares are down about 10% this month. This comes as the highly anticipated Toy Story spinoff Lightyear hits theaters today. Brad, I don't know if I'm going to see this one.
I'm going to see it.
But nonetheless, look, Disney is in focus here because vacations are starting to get more expensive. And you look at some of the recent analyst commentary by The Street, they are reporting that attendance is starting to weaken a little bit. Not falling off a map, but an already expensive Disney trip is getting a lot more expensive. And I think you're at that point where you're having a lot of families wonder, do they need to go to Disney in some type of environment? You
know, what Jurassic Park proved last weekend is the film doesn't even have to be good, and you'll still probably do well at the box office. And what's gotten people back to the box office? Dinosaurs, Marvel superheroes, Batman, and maybe Buzz Lightyear.
Yeah, look, you really get the sense that Disney could be dealing with a lot of just negativity. You have Bob Chapek, who's under incredible pressure to turn this company around, and it has not happened. His tenure as CEO has not lived up to expectations, and the last thing Bob Chapek at Disney, the CEO, needs is recessionary, causing pressured traffic at his various parks?
The parks is the world that he came from, right? And so you would hope that in navigating a recession before, that he would be able to kind of glean some of that know-how and that insight. But I think at the same time, in some of these other divisions where, sure, he's been annexed to it because of the brand, but when you're directly thinking about merchandise, if merchandise pulls back, if you're directly thinking about the number of streaming customers that you have, and them not opting up into some of those higher tiers, and then you get into the box office side of the business, if people don't go to theaters, those are all direct headwinds that they're going to have to consider in this immediate term. Guys, coming up, recession stress. While Powell makes moves, Biden tries to calm things down. We've got more on the growing stress for the average American ahead.
Layoff announcements picking up and the stock market tanking, people are growing increasingly worried about a recession, as our nifty chart of the day shows. Google search data shows volumes for recession are tracking to be as high as March 2020. Search volume for recession is also tracking at levels seen during the Great Recession. Again, you can see those spikes there really picking up in terms of search volume. All right, straight ahead, with consumers being drilled by higher gas prices, we'll take a look at next how much spending could be in fact pulling back. We'll also get a read on the latest market conditions. We'll be right back.
Welcome back to Yahoo Finance Live, everyone. Markets are holding on to some gains right now, and the Dow is up by about triple digits, 0.5%. Let's also get on over to Yahoo Finance's Emily McCormick with more on the major averages and what we've been tracking very early on in today's tape. Emily.
Well, Brad, we're seeing a bit of a reversal from the market moves from yesterday. And if we head over to the Yahoo Finance Interactive, you can see clearly that the S&P 500, Dow, and NASDAQ are firmly in positive territory just about 15 minutes after that opening bell. Now, if we do look over the past 5 days on the S&P 500, you can see that that index is still down by about 5.2% for the week. As of yesterday's close, the index had been down about 6% and was on track for its worst week since March 2020. But it looks like we may narrowly avoid those levels and that interval, of course. Now, if we take a look at the NASDAQ 100, again, a different picture from what we saw yesterday. A lot of green across the screen with only a couple of components here in the red. A big reversal from what we saw yesterday, whereas this screen was mostly red with just a couple of spots of green in intraday trading. So certainly some bright spots here when we take a look at that trading action. Also want to highlight what we're seeing in terms of the sector action in the S&P 500. As we can see, energy is the only of the 11 major components that is trading lower this morning. And then if we head over as well to the Chinese stocks, big reversal there as well. Alibaba, of course, one of the big standouts moving higher after Reuters reported that the People's Bank of China was going to be approving Ant Group's move to create a financial holding company. So yesterday we certainly saw a big risk-off move in these markets, seeing a little bit more optimism, a little bit more of a bounce today. We'll see whether this ultimately holds. And again, still heading for steep weekly losses, guys.
Yeah, glad you mentioned Alibaba, Emily. It is now the top trending ticker on the Yahoo Finance platform. Emily McCormick, thanks so much. Okay, there's a lot coming at the U.S. consumer right now. Gas prices over $5 a gallon. Food prices through the roof. Fears of a recession starting to take hold. Pull all this together, and we could be looking at a consumer spending pullback in the months ahead. Let's chat more about this with MasterCard's chief U.S. economist and friend of the show, Michelle Meyer. Michelle, happy Friday to you. Look, as I just said, there's a lot the consumer's dealing with right now. Are we at that point where consumer spending could just fall off a cliff?
Hey, Brian, thanks for having me on. Always good to chat with you. Yes, the headwinds are blowing very strong right now. There's high inflation. There's high inflation necessities, food and energy, as you noted, and shelter. At the same time, the Fed is trying to fight that by hiking interest rates. So there are headwinds. We do need to pay close attention to it. And there's surveys are suggesting that consumers are noticing as well. That said, when you look at the actual data, when we look at MasterCard Spending Pulse data, the consumer is still out there spending. We actually saw an acceleration in the year-over-year growth rate in May relative to the prior month as consumers get ready for the back-to-school season. So there are challenges. We should expect a moderation looking ahead, but by no means are we seeing anything that resembles a collapse in spending here.
Michelle, you've been doing this for a while. Are you surprised we haven't seen a sharper pullback?
You know, I'm not, for a few reasons. The first is look at the labor market, right? We still have very high job openings rates. We still have very strong job growth. The last jobs report showed 390,000 jobs were added across industries. The unemployment is very low. Wages are rising. So there's support in terms of that fundamentals in that people have jobs. They expect to continue to have jobs. The other very, very important factor is that they have savings, right? This last year was one of extraordinary stimulus, monetary stimulus, fiscal stimulus, and that created a lot of cash on balance sheet. And those cash levels are still high. So people have the ability to use that to help to finance spending. So what we're seeing in kind of the simplest form is a reversal of that real excessive stimulus, right? We're seeing that pullback. We're seeing an attempt to rebalance the economy. And that does mean a moderation is going to come, but it doesn't mean that it has to be this abrupt change in the course of the economy.
Michelle, do you believe that supply chain issues will be, and these have made inventory levels extremely unpredictable for some retailers, do you believe that they'll hold up to a necessary standard or at least a level that will make it stable enough to meet some of these spending pulse goals and targets, at least in forecasts of 7.5% growth during the back-to-school season?
Yeah, so the supply side is critical, and I'm glad you brought that up, because it's not just, when you think about the economy, it's not just how much consumers want to buy, it's how much is available there. And this has been a major challenge in the past year to 2 years, is that supply chains were limited. They were broken for many items, and inventory levels fell to very low. ratios, and as a result, prices increased dramatically. The good news is that that's starting to be resolved for certain products, and in fact, you do hear some retailers that have had, just in case inventories actually sitting on some decent stockpiles now. And in the end, that can maybe even lead to some disinflation, which would be really quite welcome given the inflationary pressures that are out there. So I think that there is product available now more so than certainly a year ago at this time. Remember also that consumers have shifted their prioritization around spending. You're seeing a lot more experience-based spending, travel, restaurants, lodging, and you're seeing the items that go along with that. So kind of occasion apparel, for example, where people want to buy certain items in order to experience life again and get back out there. So there's differences in the consumer wallet. The story's going to look very different depending on what sector you're focused on.
Michelle, just a follow-up to that, because as we're thinking about how the retailers themselves are kind of navigating this environment, the operating costs for the sales that retailers are banking on, they're vastly different than they were this time last year in terms of the 2019 comps. And so all of that considered, from your perspective, is there an outsized risk of some margin compression on their front if they have to discount at the same time that they are going into the back to school season, even in the holiday season?
So I think the challenge for retailers right now is to be as nimble as possible in terms of responding to consumer demand. Everybody was caught off guard right when the pandemic hit, and people wanted to snatch up as many goods as they could, big ticket items, everything related to housing. And there was a major shortage and we couldn't accommodate that demand. And now that has changed, right? Where there's a lot more spending related to leisure and again, this kind of experience economy. So it's about being nimble. It's about being able to respond to these changes in consumer behavior, and being able to realize where, and how you can pass on costs. So, the consumer is the pulse of the U.S. economy, and trying to understand what's happening in real time, I think, is critical.
Michelle, do you think we are talking ourselves into a recession? I realistically, this weekend, President Biden's comments to the AP in his latest interview about recession and things slowing down, that's going to be played all over the place over the next few days.
Yeah.
And if you see those headlines, maybe you're just less inclined to not go out there and buy a new shirt.
Yeah, so I like the Google search chart you pulled up. I look at that myself because I think it is important to understand kind of the buzz, right? What's the animal spirits out there? How concerned are people? Because when they hear about recession, they start to wonder. But at the same time, they're also looking at healthy income. They're looking at money out there, and they're still trying to, resolve from this pent-up demand that they've had for a long time. So, animal spirits matter. Behavioral economics is really important. So we do have to think about these sentiment changes and how people are perceiving the economic environment. But also what they're getting in, right? Income in means a certain amount of spending out. So to me, the recession story, I think it's smart to be thinking about these headwinds. I think it's smart to be thinking about the path of the economy looking forward. And a lot of these recession calls are about 12 to 18 months forward. I think it's hard to say a recession is around the corner. We're just not at all seeing that in the data. But to say that there could be some considerable risks into the future, absolutely. We should be thinking about that. You have a real pivot in the economy with the Fed hiking interest rates dramatically and trying to cool down the economy to rein in inflation. But we have to be careful with how we characterize these recession risks, in my view.
Michelle, always great to get your insights and perspective. MasterCard's chief U.S. economist, Michelle Meyer, thanks so much.
You got it.
All right, guys, coming up, Barbie and Ken.
That's me. All right, I look great.
They popped the picture up, and I
slimmed down great.
Yeah, looking good, Sauce. All right, Barbie and Ken, they're coming to life, but can they save toys? The challenges facing the industry ahead. Woo. U.S. toy industry unit sales, they declined 6% this year from January to April, according to a recent report by the NPD Group. The toy industry feeling the effects of a challenging economic cycle as recession fears loom. So what's in store for the sector moving forward? Sazi's take hits the toy chest today, Saz.
That was my my bear in that picture, if anyone was wondering. His name is Ticker. But look, we've been all morning long focused on the potential of a recession, what people are spending and what they're not spending. And I would say this NPD data, which runs from January to April, and some most recent data just came out, another way of looking at it is year to date, is a red flag for the state of the toy industry, which had been doing well through the pandemic. You look at unit sales, like you mentioned, Brad, down 6%, average selling price is up 7%. So what is essentially happening? The likes of Mattel, a Hasbro, a Funko, their costs for producing all these toys, they have gone through the roof in large part because of supply chain bottlenecks. They are now in the mode of pushing through price increases for consumers on a category that has historically been very price sensitive, and you're seeing consumers perhaps starting to pull back. And again, that's a red flag because, as you know, we're not too far removed from the holiday season. It's going to come quick. It's going to come fast. Everybody's going to go out there and buy some toys. That said, there are some bright spots here in this data. Collectible sales up 28% year over year. Within that, traditional plush toys up 43%, led by Squishmallows, which we talked about recently because they're sold and they helped the quarter out of Five Below, disastrous quarter by Five Below. But one of the bright spots for them were these Squishmallows. Just fascinating, simple.
We're
to make.
Squishmallow bullish indicator.
We are, very bullish. But also Funko Pop, and you like this. I know you're a Lego guy.
Big time.
Building sets up 7% year to date, led by Lego Star Wars and traditional building sets. So Lego sales are doing well. But overall, my take is this. It's going to be hard, I think, for a lot of these Mattel, the likes of Mattel and Hasbro, to push through even more price increases on consumers that as they get over the head with inflation in food and gasoline prices, it's going to be hard, I think, for them to put forth a robust holiday shopping season. Of course, there you see my pet bear, Ticker, frowning.
It's like a teardrop tattoo as well.
Oh, wow, boo.
Killing the toy season.
That's brutal. That's brutal.
All right. So, right now, Legos. Yeah, you know I'm a huge Lego fan. All right. So what does this spell out? I mean, merchandise right now. Even if households are pulling back on some of that spending, then what categories are they going to lean into? What is like the most resilient of the toy category? Does it seem?
It seems to be those very, at least from a toy perspective, those very approachable, simple toys, like a Squishmallow. It's an attractive price point, it's somewhat affordable, and it brings you what appears to be endless amounts of joy and relaxation. Maybe I need one of these things.
Okay, we got to talk about Mattel, Barbie,
Ryan Gosling.
Yeah,
okay. Look, this one caught fire, and there's
this is from the movie. We should
say. There is a stock angle to this because we've talked to Mattel CEO Anand Krais at length, and he has put a whole bunch of new movies in the pipeline, looking out over the next few years. Now, this Barbie movie, you can see Ryan Gosling there showing off his chiseled abs, looking like an old school Abercrombie & Fitch model. But that movie is supposed to hit later. That is supposed to hit later this year, and there's really no resemblance between myself and Ryan Gosling, but still, it's nice to imagine. That Barbie movie is supposed to hit next year, and it could lead to strong sales for Mattel because it is out there making this movie, putting it out there, but also, obviously, dolls and various other figurines and sets.
You use the Peloton bike. Do you think he uses the Peloton guide?
I think he's using some stuff from GNC, maybe a little Peloton bike, and maybe that Beyonce diet.
Can we do the side-by-side picture again? You got to make the same facial expression.
You're going to make me do it.
There it is. That's close. That's
why they pay us big bucks, Brad.
There we go.
We can do that real time.
Guys, coming up, the best of the worst, why despite the pain at the pump, you should be thankful for filling up your tank in the U.S. That's next.
Welcome back to Yahoo Finance Live. I'm Brian Sazzi alongside Brad Smith. Julie Hyman is out on assignment. Limping into the weekend, that is the vibe on Wall Street after a brutal week for the markets. We are seeing some tepid buying across the board with the Dow in the green, the S&P 500 and NASDAQ also clinging on to modest gains. Now, here are three things you need to know right now. Crypto carnage. We'll dive into the outlook for the crypto complexes. Everything from Bitcoin to Coinbase to have been routed this week. Right now, Bitcoin prices are clinging to that $21,000 level. Tech wreck. Crypto isn't alone in having a tough week. Tech stocks have also continued to be hammered on fears of much higher interest rates, but there are some names that you should be perhaps looking at on weakness. We'll explore just that. And with the NBA Finals all wrapped up, we'll talk to an analyst from Macquarie to break down the sports betting world. But back on the economy. From rising rates to falling stocks, it's been a wild week for both the U.S. economy and Wall Street. Our next guest says while the Fed's aim to bring inflation under control is necessary, it may feel like the cure is worse than the disease. Joining us now is Beth Ann Bovino, S&P Global Ratings Chief U.S. Economist. Beth Ann, always nice to get some time with you. Look, it's been a wild week here for the markets, for the economy. As we look out to the rest of the June, where do you think we might see the economy head?
Out through this month. I mean, this month, I think things are going to hold up relatively well. We are starting to see signs that consumers are pulling back, and that's not just on low-income households. You're starting to see, well, you mentioned the crash in the equity markets. That usually has an impact on the wealth effect, affecting higher-income households as well. So we expect to see that slowing down. But generally, the U.S. momentum in the economy at this point in time will hold up. Doesn't mean it'll last forever, and that's where we're concerned going into 2023.
Beth Ann, markets will typically price in a recession prior to it actually showing up in the economic data. But a question particularly is how deep of a recession might markets be trying to price in?
I would say that, markets are fearful, understandably. We're talking about the Fed moving much more aggressively than that they had earlier indicated. And indeed, they came out with a 75 basis point rate hike without giving us any guidance beforehand. So that seems to see that the Fed's scared. And when the Fed's scared, the markets are scared, pricing in a much more aggressive Fed policy. And that means an aggressive response to a recession. Now, whether the markets are right or wrong on the recession remains to be seen, but there's a lot of headwinds. Now we see the risk of a recession increasing rather dramatically. We had it at 35% for 2023. It looks like it's climbing higher, but the size of the recession is the real question. And given we do have buffer both with the household balance sheets and business balance sheets, we suspect that the recession might not be as severe as markets fear right now.
What is that ultimate trigger point, Beth Ann, that tips us into a recession?
Watch what the consumer does. The consumer makes up, close to 70% of economic activity. We're watching them. It looks like they blinked, and there's understandably so. When you have food and fuel making up the biggest size of the consumer basket, meaning there's not much left to spend on discretionary items. You mentioned toys. I felt bad for the children, but that might be one area that's cut, and that means that when people stop spending, the economy weakens. I also watch as a near-term indicator what happens with the jobs front. Those initial jobless claims numbers is a leading indicator according to our business cycle barometer, and that's something that we're keeping a sharp eye on.
Even with his comments this morning, Fed Chair Jay Powell tossing a big question mark into today's tape, and we've seen that play out as the Dow has kind of waffled in and out of negative and positive territory. With all of this in mind, this week for the Fed in aggregate, the recession concerns that have been brought up within the conference call, this is the same committee that said inflation was transitory at the end of the day. Did Wednesday's decision and the press conference do enough to, I guess, alleviate some of the credibility concerns coming into this FOMC meeting?
I think the Fed will hopefully be able to pull back the reins and get control of the narrative. But right now there is a lot of there's a lot of challenges they face. They also noted in that press conference that indeed a lot of things are out of their control, and that's true and understandable. Meaning that their tool is basically interest rate policy and monetary policy, which affects demand. They can't control the supply chain response, and that, while it's very true, it's certainly not very comforting for markets, I believe.
Beth Ann, how damaging is it to consumer wealth if gas prices stay above $5 a gallon, looking out over let's say into the year end?
I think that on the low end of the income bracket, food and fuel, particularly food, which is fuel, which is at as you mentioned a new record high, is going to squeeze the low income households. We saw it before. It was that if you look at disposable income, again, this is from 2019, and it's gotten a lot worse since then. We saw that about 12% went to energy spending. For high income households, it's a lot lower. It's closer to 2%. This goes back to 2019, but it's still about the same. It's all gone up because of these prices. That means less money for these households to spend, and that's a real squeeze. You mentioned the equity crash. We're in a bear market now. That also is a leading indicator for recessions as well, if it lasts long, and right now it feels like it will.
Beth Ann, always great to get some of your time and really discuss what some of these macro impacts are and what everybody's navigating through right now. Beth Ann Bovino, who is the S&P Global Ratings Chief U.S. Economist. Thanks so much for the time. Have a great weekend. And every American is feeling pain at the pump, but we actually may not know how good we have it compared to other places in the world. Yahoo Finance's Inez Ferre joins us now. All right, Inez, how good do we
Sell
have
this one?
Right, that's right. And this may be little consolation, of course, for consumers here in the U.S. that are paying $5 a gallon for gasoline. But look, if you take a look at other places in the world, particularly Europe, you are seeing gasoline or petrol prices higher than here in the U.S. And part of that has to do with the tax system in Europe and the heavy taxes that you have on these gasoline there in these European countries. But look, Germany's paying north of $7 per gallon. Of course, they go by liters, but when you convert it to gallons in US dollars, these are the prices. France, Italy, Spain, UK is paying more than $8 a gallon. You've got Norway paying more than $10 a gallon, and Hong Kong is paying the most, more than $11 per gallon for gasoline. Europe has the issue of that's even worse than here in the US with this energy crisis, because they're also paying nosebleed prices for natural gas, and now Russia is tightening the screws on supplies into some European countries. The feeling is that what analysts have told me is that as you see these energy prices high in other parts of the world, you may see other parts of the world first go into a recession, if we are talking about recessions here, before the US, and particularly Europe, because of these really high energy prices.
Well, if anything, Inez, I think that chart just reminded me, should we get some form of hurricane and that pressure's oil, we might be seeing Norway-like prices here. But look, gas prices have come down a bit, though, recently.
Yeah, they have. Here in the U.S., we are seeing the national average for gasoline now at $5 per gallon. A couple of days ago, it was at $5.02 a gallon, so down 2 cents. Some analysts are saying that in the next few days, you could see it come down even more, maybe slip around 5 cents or so in the next few days. And part of that has to do with gasoline futures that are lower. But look, if you take a look at diesel prices are still at all-time highs. And as far as supply is concerned, diesel is the shortest supply of refined products around the world. And diesel is heavily used here in the US, in Europe, in Asia, all over the world. So you are still seeing very high prices for energy.
I'll be right back. I'm going to go fill up my cart. Down 2 cents. That's great. See you guys later.
a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a love found. Wish that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be that I could write down what you mean to me. I wish that I could tell you. I wish that I could tell you. I wish that I could tell you all the things that you do. Come back, 'cause I'm gonna be a lonely girl again. Come back, 'cause I'm gonna be a lonely girl.
do have some exposure to liquid cryptos, we have held on, and we did have solid entry points. But when we've seen these crypto winters, we have seen recovery, especially amongst these blue chip cryptos.
In terms of the headcount, this crypto winter, it has taken a toll on companies like BlockFi, companies like Coinbase. You were tweeting about this week as well with some of the layoffs that had come forth from these companies in crypto. Robinhood had actually already done some of their layoffs prior to this most recent leg lower. Do you expect more of the headcount reductions to take place as a result of this leg lower, this most recent move lower and downturn in crypto prices over the past 2 weeks?
Yes, and undoubtedly, and we're seeing this in the broader tech sector too. The valuations had gone very high and ahead of themselves because of what we were seeing in the public markets, and the some of the private valuations were even higher than some of the public markets. So, those had to stabilize, and along with those higher valuations, more money coming into these companies. The hiring was really taking off ahead of its growth and future growth. So, something that Brian Armstrong from Coinbase said this week, that they hired, it was a mistake to hire as much as they did ahead of the growth. I mean, these companies often, saw these spurts of growth in crypto and were taken aback by them and didn't have the personnel to manage some of that growth. So I think this time around they overhired, and they're seeing the repercussions of that. And we don't know how long the crypto winter will last this time around. So I think they're just being conservative. And obviously Coinbase is a public company and has more scrutiny because it is, but the rest of the sector is certainly taking note of that and restructuring accordingly.
Future Perfect Ventures founder and CEO Jalak Jobanputra, always good to see you. Have a good weekend.
Thank you. You too. Take care.
Coming up, recession-weary shoppers have no fear. Amazon Prime Day is here. More on this next.
Wow, yes.
And Jeff, let's just talk about the demand picture first. If you're headed towards maybe a soft landing, maybe not as bad of a recession as had been anticipated, what does that mean for energy prices?
It's very positive. That's why oil and commodities are considered late cycle assets, because once the rate hikes begin, it takes a while before you really begin to slow the economy. So like tech stocks and growth names get hit first, but it takes time before the rate hikes begin to slow growth. Cyclical names, the Exxons, the Shells, oil, commodities, copper, all of that continue to perform late in the cycle for precisely that lag reason. Now, that doesn't factor in the structural story, that revenge of the old economy we've talking about, which I think makes them more resilient from a supply side through this cycle. But bottom line is, energy's been the best performing sector in the indices. Oil, the commodities, they're up 28% year to date. This is all reflecting that nature, and we haven't even started to talk about the structural story.
Okay, so a structural story, let's get to that too. This has been your reason that you've been long oil for a very long time now, and are looking at us in what, a 7-year cycle, you think, Jeff?
Oh, well, our view, historically, when you enter one of these super cycles, they last somewhere around 12 years. The one in the 70s started in 68, ended in 80. The one in the 2000s started in 02, ended in 14. This one started in 2020, which means it probably make it to the end of this decade or even further. Now, what we title it is the revenge of the old economy. And all of the earnings coming out confirm this idea, the revenge of the old economy. Tech, missing, substantially. You look at the energy names, all surprising up to the upside. Industrials, all the old economy is what is outperforming here, partially due to the underinvestment thesis. Because what is the revenge of the old economy story? It's essentially poor returns over the previous decade saw capital redirected into the new economy. All of that tech, this starved the old economy, the capital it needed to grow the supply base, creating a lot of the problems we're seeing today. One last point I'd like to point out is Microsoft and Exxon this quarter printed similar free cash flow. Exxon announces tomorrow, but we got a pre-announcement. So there's similar free cash flow, about 90% of Microsoft. Yet Exxon trades 25% of Microsoft. Let me tell you this, year 2000, Microsoft was on top, Exxon was nowhere to be found. 2010, Exxon was on top, Microsoft was nowhere to be found. 2020, Microsoft on top, Exxon nowhere to be found. What do you think is going to happen over the course of the next 5 to 10 years? This is that revenge of the old economy cycle.
Want to get down on the New York Stock Exchange. Our good friend Jim Cramer. What a market this morning between Meta on one side of the universe, so many other companies coming in with earnings better than expected. Meantime, got this new GDP print. Make sense of it for us.
All right. Well, I think there's a tremendous amount of money coming out of technology in general, coming out of big cap, and going into companies that have cost control and see some light at the end of the tunnel. There are companies that recognize what you have to do when you have to batten down the hatches. And there are other companies who don't seem to understand that we might be in tougher times. So I look at it like that. I also think that GDP number not as important, maybe durable goods. Everything that I'm seeing, really, Andrew, is an extraordinary revulsion to big cap tech. Maybe Apple can save that tonight, maybe Amazon. But the notion of companies that can do spending that has no end to it, they're finished. They're finished as places.
They're finished. They're finished as
places to invest.
We keep talking about this falling knife, as if the knife continues to fall. Though there are people who look at this and say,
look, I'm looking at the money coming out. Where's the money coming from to buy to buy industrials? It certainly isn't coming from new people saying, "Wow, it's time to put money in the stock market," because they get such a great rate on the 2-year. I think it's money coming, rotating out of companies that have dominated this market for the last decade and into companies like Caterpillar who actually know what the hell they're doing.
Are you thinking that the tech companies that I think that you're disappointed in are going to get religion, if you will, and get disciplined? And what does discipline look like?
You know what they are? I would call them atheists. They believe in nothing.
It's a nihilist.
We were also talking about Elon Musk earlier today as he was walking into Twitter holding the sink with him. Looks like if you were arbing that, you're a winner today, or will be a winner later this week.
Well, when you incorporate in Delaware, you tend to get the benefit of the doubt. And I think that Elon, I think he'll probably do a good job because he's masterful and he's got an idea that we probably don't know in our heads. He's probably got something. I don't think he's going in there idly. I would trust him more than anyone in tech. He seems to have a concept of making money. He seems to be liking the concept of making money.
You think 5 years from now we'll be talking about that company, IPOing at a valuation meaningfully higher than what he's paid for it?
Yes, because it'll look nothing like the company we have now, which is a company of declining revenues and no ability to do any commerce. And I think that Elon Musk is addicted to doing commerce and making money, which is one of the reasons why he's so pleasurable.
보는 눈, 그건 하루아침에 생기지 않아. 견디기 힘든 조롱, 셀 수 없는 손가락질, 수만 번의 시뮬레이션, 수만 번의 좌절 끝에 마침내 얻게 되는 거지. 그러니 너의 실패는 절대 헛된 게 아니야. Keep trying. Keep it going. 그럼 결국엔 rockstar, hipstar, superstar, idol, icon, identity. Why not? 크게 떠봐. 네 인생 greatest of all time. 멋지게. 너 보는 눈 있잖아. 고랑모.
우리들의 M8TI 이야기. P와 J의 아슬아슬 성공시대. J는 원망했다. P와 함께 사업을 시작한 자신.
네, 죄송합니다.
아이디어와 추진력이 넘쳐나던 P는 언제나 사람들의 주목을 받았다. J는 그런 그녀가 최고의 파트너가 될 줄 알았다. 함께 사업을 시작하기 전까지는.
그렇게 바꿔. 아, 좋다. 아니야.
즉흥적이었던 P는 프로젝트를 뒤집고 새로 하기 일쑤였다. J는 P가 버거웠다.
아방가르드 하면서 막 사이키델리카. 근데 그거 알아? 우리 이거 마감이 일주일도 안 남았다?
에이, 일주일이면 충분하지.
우리가 이거 한다고 가진 거 다 팔았잖아. 우리 가진 거 없다? 원목 재단한 건 어떻게 할 건데? 팔아? 팔 거야? 이번엔 그냥
J는 착각했다. P가 자신의 말에 동의한 줄.
나 먼저 간다. 머리.
우리 있던 게 어디 갔지?
어떻게 나랑 상의도 안 하고 그럴 수 있어? 나 동업자 아니야?
J는 이번이야말로 끝이라고 생각했다.
끝내자.
M을 소개받기 전까지는.
인사해. M이야.
M은 P의 즉흥적인 아이디어도 빠르게 반영해 주었고 J의 디테일한 계획도 스케일 넘치게 보여주었다. 그야말로 스마트 오브 스마트하게. M과 함께였기에 아슬아슬하지만 행복했던 여름이었다. 우리들의 M8TI 이야기. 삼성 스마트 모니터 M8.
Heidi, I'm going to start with you. As the administration and the Democrats try to shift, I think, the narrative, do you think that's a winning narrative given what we're seeing happening around the country and given some of the recent debates that have not been favorable for Democrats?
Well, I mean, I would tell you it's about time. It's about time that they start talking about the economy. I think that this summer they thought it was going to be a values-based election on reproductive rights. And I think they woke up when you started to see people come home to the issue they always come home to, which is the economy. And I think, here we are at the last hours of this campaign talking about something we should have been talking about a number of months ago. So it may be too little too late.
Grover, I'm curious actually, as somebody who thinks about taxes and lowering taxes, how you think about what kind of message the GOP can offer at a time when we've seen what happened, for example, in Europe or in the UK specifically, given the sort of push-pull of the bond market right now?
Well, if you look at the United States, not at the Europeans, which have not been doing terribly well, you've seen across the country in the 50 states, red states cutting taxes and doing extremely well. 5 states have moved to a single rate tax. In Illinois, in 2020, when Biden was elected, same day, the people of Illinois voted down a graduated income tax. The whole envy thesis of the modern Democratic Party voted down in Illinois. It's on the ballot again in Massachusetts this year. 5 times the people of Massachusetts have voted down going away from a single rate flat tax towards a graduated or progressive tax. We'll see what happens this time, but the message across the states is one of states announcing they're moving towards phasing out the income tax. Take a look at the whole idea of inflation where it is. We're now bringing back the idea of ending the inflation tax on capital gains. We don't tax inflation on your wages, but we do on capital gains. This is an idea that's passed the House in 1978, the Senate in 1982, and the Senate again in 1992, with Schumer on the floor praising it as a must-do bill, ending the taxation of inflation in your capital gains. There's a bill ready to go. Ted Cruz on the Senate side, Warren Davidson on the House side. This answers the question of how do you deal with Biden's inflation. The list of projects that Biden said he wanted to talk about or that you listed, he's been talking about those for 2 years. Those are losers. Stan Greenberg, Democratic pollster, said Biden's thing is killing his own message.
Hey, Heidi, real quick.
Well, first off,
can you lower taxes at a time when inflation's high?
First off, every state that is bragging about their surplus should send back the money that the federal government sent them, because you cannot divide a state revenue from federal revenue given how intertwined they are. Secondly, I think it's always so interesting. No one ever mentions Kansas as an exact experiment that failed miserably. And no one mentions that we've got sales tax on consumers that is regressive at 7-8% in this country. If you want to give people a tax break, why not cut the sales tax? And finally, even the American Enterprise Institute said that a tax cut at this point would be inflationary and not a good idea. So there's a whole lot to unpack in what just got said, and we don't have a lot of time to do it.
Shepard Smith here. Thanks for watching CNBC on YouTube.
Global energy crisis putting more pressure on the American consumer, is likely to see higher energy bills this winter. Joining us now to discuss energy policy and possible solutions, Tom Fanning, Chairman, President, and CEO, Southern Company, which posted quarterly results earlier this morning. Adjusted earnings 2 cents short, revenue well above expectations. Yeah, we may have some difficult times this winter, but it's all relative compared to what might happen across the pond, Tom.
Yeah, Joe, gosh, you know, I've been joining you guys in this program for over a decade now, and I can remember about a decade ago when Fukushima happened and there was this question of whether we would continue to build nuclear. I remember you and I had an exchange, and I said it's really important to understand European energy policy because watch what they do and then do the opposite. You know, anybody that didn't think Putin would weaponize energy, I think, was sadly misguided. You know, here in the United States, we have the ability to be energy independent. And so we need to continue to promote all of the above in terms of fuel sources. If you just rely on natural gas, we are going to see a tough time. I think to date, household energy prices are up over 20%. Southern's been able to keep that number less than half of that.
Yeah, you loaded fuel into a new nuclear plant. Is it reactor 3? Is this the only one being built in the United States in decades, and it's yours?
Yeah, in a generation of Americans is what I like to say. And Joe, the two benefits we see out of that, the energy coming out of that nuclear plant will be at the equivalent of about $1 per million BTU. We know that in 2020, for example, gas was around $2 per million BTU. Since then, it has doubled almost and doubled again almost. So that plant looks awfully good right now. And when you think about this transition to net zero by 2050, we know that renewables will play a big part in that. Renewables don't work when the sun doesn't shine or the wind doesn't blow. That nuclear plant will work 24/7, 365.
빠졌는데 더 슬림해질 수 없을까? 내 통신요금? 비다이렉트 샵. 안 가봤구나? 가보자고! 비다샵! 뜨거!
BTV 인터넷 기본 할인에 화끈한 30% 추가 할인까지.
비다샵 가능? 샵 가능?
비다샵 24시간 오픈. SK 브로드밴드.
더 빼준다고?
Mark, I know you've been positive on this stock for a very long time, maybe almost back to the IPO. You've had a buy rating on it. That was a smart call for a very long time, but this year has been a different story. What the heck happened, and what you heard yesterday, what do you take out of that? Is that a big dark cloud, or are you still looking for silver linings?
I'm sticking with the buy on it. What I found interesting listening to the call last night is the more that Zuckerberg talked about his investment plans for the metaverse and AI, the more the stock traded off in the aftermarket. The core business, the core advertising business, and it's still 98% advertising revenue, looks like it started to stabilize. If you adjust for currency, you had low single-digit % growth in the June quarter and again in the September quarter and probably again this next quarter. And then as Reels monetization ramps up and engagement continues to rise on the core side and user growth continues to rise and they start recovering some of that lost signal from Apple, you're going to get revenue growth acceleration. And this quarter, I think, was probably the trough margin quarter. So I think fundamentally things get better. The investor question is, can you buy Meta the stock if you don't believe in the metaverse? Is that fundamentally disruptive to the investment thesis? And that's a really hard question to answer. I think you can. I think there's a there to the metaverse. I think Meta as a stock is worth more because they invest in the metaverse. Would I prefer that they invest $5 billion? Yes, rather than the 10 to 15 billion that they're spending. But the business is cheap. The stock is cheap enough that I'm willing to give them a little bit of pass on all that investment spent. But that's really the make or break on the stock. And that's why investors are revolting today. They don't like the metaverse spend.
Yeah, they don't like the name. They don't like the amount of money being spent on it. They don't like the returns they've seen to date or lack of returns, whether that be the audience or what's happening just overall. We talked about this earlier this morning, Mark, and I kind of look at it. I think if Zuckerberg and company were allowed to buy something else, they probably would have. Obviously, that hasn't been the case for a long time. Regulators aren't going to allow them to come in and make another big purchase, so they have to build it themselves. But now you're talking about investment levels that are really getting up there. If it's $9.5 billion or whatever it's been for this year to date so far, I mean, and you're planning on ramping up that spend. I mean, you're talking about numbers that start to look like what it would be for a major acquisition or for the CapEx numbers of something like an AT&T or a Verizon or a Union Pacific. I mean, you're looking more and more like a slow growth company and not necessarily a company that's going to be a really fast growth company.
You're right, Becky. You've set it all up correctly, except, remember, what did we learn about the advertising business today versus yesterday? The advertising business looks like it's stabilized rather than deteriorating. It's actually a little different than Google, but both of these are facing major, if you're in advertising now, these are the dark days. And, at some point, we're going to get beyond this, and it's probably a 12-month outlook. So if you're willing to look out 12 months, revenue growth is almost certainly going to reaccelerate. We think it gets to 20% in the core business, margins rise. That's fundamentally attractive. It gets back to this question about the metaverse. Becky, there is no metaverse acquisition to be done. I mean, Facebook is the leader in this market.
Right, but I mean, if you were making an acquisition, you could say, hey, Instagram is really hot. It's taking off. I want to buy it. This is, I think the metaverse is going to be hot, and maybe we can make something that people will eventually want to go to. That's a different story, too. There's, just a risk-reward scenario if you're buying something that's already hot versus trying to build something and hope it gets hot.
That's absolutely true. So they're the leader in a nascent space, and so the question for investors is, if you don't like metaverse, can you buy Meta stock? I think you can. I think the stock's cheap enough to do that, and the core business is, I think, stabilizing, and then that growth in users and engagement, that's the real make or break on the core stock. If engagement is falling and users were falling, you'd run for the hills on Facebook. That's not what's happening. So that's why I'll stick with it. But I get how controversial the investment is in the metaverse. But I think it's a pace or a scale. I think most investors would want them to spend some amount of money. They prefer $5 billion rather than $15 billion.
Welcome back to Squawk. The Biden administration set to go on the offensive to try and reframe the Democrats' economic message to voters with less than just 2 weeks until the midterm elections. The president and some of his top officials canvassing the country today to regain momentum for the party in a bid to try to hold on to power in Congress. Elon Moore joins us now with the White House's strategy. Good morning.
Good morning, Andrew. The president will attempt to sharpen Democrats' economic pitch today as the White House goes into full campaign mode with the midterms just around the corner. His goal is to contrast his party's plan to build the economy from the bottom up and the middle out with what he's calling Republicans' mega MAGA trickle-down economics. Okay, so what does that exactly mean? Senior White House officials said that Biden will highlight Democrats' work to bring down costs on prescription drugs, healthcare, gas prices, and student loan debt. He'll deliver his speech in Syracuse, where Micron has announced a 20-year, $100 billion investment in chips that's projected to create 50,000 jobs. And that theme of lower prices and domestic investment in manufacturing will be echoed by his top lieutenants across the country today. Treasury Secretary Yellen in Ohio, Commerce Secretary Raimondo in Maryland, HHS Secretary Becerra in Texas. But Biden is also expected to attack Republicans as pushing to extend tax cuts for the wealthy and threatening to cut Social Security and to cut Medicare. Well, recent polls show the economy is now front and center for voters, and that has tilted the playing field toward Republicans. The latest analysis from 538 shows GOP support at 45.3%, compared to 44.9% for Democrats. That's less than half a percentage point between them. So there's not much time left for Democrats to get their message through to voters. But of course, they're betting that even the slightest move in that needle could make a difference. Guys.
And they delivered, yes. The ECB with back-to-back three-quarters of a point increases on their rate, brings their deposit facility rate now to 1.5%. Their marginal lending rate moved from 150 to 2.25, 75 basis points. And their main financing rate moved from 1.25 to 2%. We see that the 10-year in the U.S. yields haven't moved much from 406. The euro currency, though, is dropping. And do remember, the euro closed yesterday above parity for the first time since September 19th, since its low on the 21st of October. Not that long ago, it's up nearly 4%, but obviously we're going in the other direction now. And if we look at what's going on with bond yields, they are dropping. They were hovering right around 219. They've dropped about 8 basis points towards 211. Their high water mark was on the 21st, the same day the euro, of course, made its low. The high water mark in rates was 242 on a bond. So you could see it has moved lower like many sovereigns. We're going to continue to monitor post-press conference with Christine Lagarde. Many want to know how this increase is going to affect the weaker economies like Italy, like Spain, that are, of course, going to have to potentially see some of their debt serviced and purchased by Christine Lagarde in a multi-pronged approach, which is awfully confusing. Becky, back to you.
Hey, Rick, that was what was expected, at least by economists ahead of time, that they'd do another 75 basis point hike. Seeing the euro drop like that, though, was there some sort of whisper expectation that maybe they'd do even more, or was there some sort of expectation that there'd be stronger language than they saw in the initial press release?
Well, I think we're going to have to wait for the press conference, but in my opinion, watching what's going on with regard to rates moving a bit lower and the euro moving a bit lower, most likely has to do with the recessionary implications and the slowing of the economy. We all know that there's an awful lot of natural gas all of a sudden that seems to be floating around. Infrastructure and costs are still a major issue. And of course, we saw that Germany is going to subsidize their high energy costs to such an extent that they put the rest of Europe at a disadvantage. And all these issues are negative for their economy, which is most likely trumping what we are seeing and what we expected that was delivered by Christine Lagarde and her committee.
누구나 리조트에 도착해 제일 먼저 뛰어드는 곳은 풀장이 아닌 침대였죠. 그런 당신을 보며 만들었습니다. 수만 번의 다이빙도 견뎌낼 수 있는 변형 없는 메모리 폼을.
이런 폼 소노가 아니면 누가?
모두의 숙면 플랫폼 소노 시즌.
Well, the numbers are trickling out. Let's start out with what we currently know. 217,000 on initial jobless claims. That was a bit lower than expected. And 217, well, in the rearview mirror, we have 214. So you can see these are awfully low numbers. On continuing claims, 1,438,000. That's definitely a bigger jump than we expected. And that is the highest level going back to, and I'm a bit surprised, all the way back to early April. Now, GDP first look at third quarter up 2.6%. Better than expected. And despite takeaways from inventories and trade deficits, 2.6 is 0.2 better than expected, and definitely better than 0.6 with a minus sign in the rearview mirror. Let's go through it, shall we? On the pricing index, 4.1%. That follows 9%. The high water mark there, well, 9% was, and that takes you back to 1981. So that's a nice fallback. With respect to the pricing issues, we want to continue to pay very close attention. Now, I haven't seen all the other metrics coming through, so let's now jump to durable good orders. Durable good orders expected to be up 0.6, are a bit lagging there, up 0.4. Strip out transportation, and you can see transportation boosted durable goods because they dropped down to 0.5% with a minus sign. Non-defense capital goods, a proxy for capital spending by businesses, also a very, very big disappointment there. If we look at those orders, they're down 0.7%, and shipments are down 0.5%. Now, finally, we get the rest of the pricing. I see that the core PCE is 4.5%, exactly as expected. In the rearview mirror is 4.7. The high water mark was June of 21 at 6%. So we have definitely come off a bit there. So pricing pressures have eased. We see that interest rates, well, very, very much a drop to about 5 basis points from 406 area to 401 for 10s. We continue to monitor the entire curve's yields are slightly higher, but not dramatically higher. Back to the panel.
Shepard Smith here. Thanks for watching CNBC on YouTube.
Predicted markets, the betting markets, the RC, real clear politics averages, everything sort of broke at the same time. How long ago, Dan?
That's right, Joe. Good morning, and we're less than 2 weeks out. You really started to see about 3 big changes about 3 weeks ago. The first is the congressional generic ballot turned to the Republicans. Republicans have won midterm elections, even when that was pointing to a slight Democratic lead. So pretty strong when the Republicans are in the lead. Number 2, the betting odds began to move. And number 3, we build election portfolios at Strategas. We have a Republican portfolio, a Democratic portfolio. These are the stocks that will benefit if either party wins. And what we do, Joe, is we run those stocks relative to each other to see how the market is pricing in the election. And we found that this has been a much better indicator of polls in the last few presidential cycles. For most of August and September, this was projecting a Republican House and a Democratic Senate, just a 35% chance of a Republican sweep. And over the last 3 weeks, that number has doubled. We've gone from about a 35% chance of a Republican sweep to a 70% chance of a Republican sweep. So the move has been dramatic, and it's being reflected in the polls, the betting odds, and now even as
스마트싱스 일상 도감.
김혜한 아파트. 엄마 왔다.
주차장 도착. 시작해볼까? 분위기 먼저 으스스. 보일러 끄고 에어컨 켜고.
이게 다 뭐야?
작전 개시.
빨간 불, 커튼.
다음 TV.
미련 출발.
서프라이즈!
엄마 놀리지? 너무 무서웠어. 유령이다.
저건 내가 한 게 아닌데. 투더 스마트 싱스.
매 순간 확신을 주는 어느덧 경계 없는 삶으로 나를 안내하는 이것은 내 안을 채우는 경험 새로운 럭셔리를 경험하다 Luxury is not a thing Volvo S90
면도에 클렌징을 더한 질레트랩스 딥 클렌징 바. 면도날이 닿기 전 이물질을 제거. 한 번의 움직임으로 깔끔한 면도. 면도와 각질 제거를 동시에. 신제품 질레트랩스 딥 클렌징 바. 면도에 클렌징을 더한 질레트랩스 딥 클렌징 바. 면도날이 닿기 전 이물질을 제거. 한 번의 움직임으로 깔끔한 면도. 면도와 각질 제거를 동시에. 신제품 질레트랩스 딥 클렌징 바.
한순간 나를 집중하게 했다. 문득 깊은 감성을 깨웠다. 이것은 내 안을 채우는 경험, 새로운 럭셔리를 경험하다. Luxury is not a thing. Volvo S90.
20万人民币全家移民加拿大。对，你没听错，20万人民币，您可以。
Julia, good morning, by the way. Earliest timing for a Fed pivot, Q4 2023, next year. So we're 12 months away. How do markets look between now and then?
So we think that we are going to stay in an inflation trading regime for the next couple of months because the momentum in inflation is still quite high. Even if you just look at shelter inflation, it's come down some of the leading indicators, but for the PCE, core PCE to show that takes at least a couple of months. And then you'll start to see maybe the employment market starting to show some weakness. We think that will be probably around mid of next year. But for us to get to a point where the labor market conditions are more fundamentally consistent with the Fed's inflation target, we think will take us to probably end of next year. So that's why we expect a pivot really only in Q4 of 2023.
Now, that GDP read we got, what did you make of it? What do you think the Federal Reserve is going to make of it? Because it was essentially the growth coming from net exports and more specifically increased energy exports as well, and there's much weaker imports too.
Yeah, so I guess there's the strong dollar coming into play with that a little bit. But I think the point I think here is that the weakness in the economy isn't really as big or as coming as fast as people have expected. I think a lot of indicators on the consumer side actually are still pretty resilient. The housing market slowing at the margin, but under supply is actually pretty big.
But then you look at Amazon and Apple, and they're warning about what's going to happen in the fourth quarter.
Yeah, well, they're growth stories, right? They're growth narratives. But if you look at the underlying economy, it's really supported by ultra tight labor market. Unemployment rate is 3.5%. It's going to take, we think 12 months for that to really show a material slowdown that slows wage growth. So I think, the growth picture will start to weaken, but it's not really weakening as fast, and it's starting from a really, really, really strong position. So I think that, at some point next year, we think around mid next year, it will start to become a factor for the Fed. But I think until then, and even after that, inflation will continue to be a pretty important indicator for the Fed when they make policies. So we really have to come to a point where inflation is truly sustainably down, and we think that will be really end of next year.
Yeah, so it seems that the sort of sequence of events is the Fed hikes maybe until March and then keeps it there and we wait, and then we'll see when they start to signal that they're about to take rates low. Here's the question though, what do you do between say now and March, for example? Is it obviously not growth because you shot that down? Where do you want to be?
So we have been sort of heading out a little bit in short dated, we call high quality credit. So these are select IG bonds that are really good companies, really good fundamentals. They're giving you 4 to 5% yield coupon right now to take on 2 to 3 year bond, let's say 2-year bond. So investors can take
is how much is this going to lead to further job cuts in the tech world? And that's really going to be the theme, I think, throughout all of these earnings.
Those tech names dragging down the S&P 500. We're down by about 0.7% on the S&P. There is a rally in the Treasury market. Treasury yields are lower on a 10-year in America by 4 basis points. And this dollar is a whole lot weaker. From New York City, this is Bloomberg.
The volatility, the fear, the capitulation has really not been there yet.
We do have a recession penciled in. I suspect it may not be as bad as some of the more extreme forecasts that are out there.
Have the markets seen their bottom? We're all talking about the risk of recession, but markets still, to me, don't have it priced in.
I think it's very hard to see something that's going to be smooth landing in any way.
The financial strains are going to become more severe because right now the Fed is on the way to go from 3 towards 5%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
3 days of gains colliding with negative news after the close yesterday. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Ferro. TK back with us tomorrow. Equity futures down 0.6% on the S&P. We've had 3 big days of gains, Bramo, and we get some bad earnings, I would say, after the close.
Yeah, especially given that this is in the big tech world and there already had been such beaten up expectations, considering that they'd failed to meet that bar, raises some big concerns for some of the other tech earnings that we get today and tomorrow.
It's earnings from Google that disappoint. It's the guidance from Microsoft that disappoints. And this was always going to be about the guidance, never mind 3Q. It's tell us what you think for 4Q and beyond. Have we got a decent picture of that just yet from these big names?
It's not good. I mean, and I throw Texas Instruments in there as well, and I know we don't talk about them as much, but as you pointed out, this is a broader swath of the tech sphere. This isn't just the small electronics and things like iPhones or other things. These are, just the broad industrial complex, as you point out. So how can this be positive, especially when it's broad-based? It's not just ad spend. It's also with respect to the investment in the cloud.
It's ad spend, it's IT investment. It's beyond that. It's machinery. It's industry. Let's talk about house price growth as well. That data point, I have to say, typically at 9 a.m., 30 minutes away from the opening bound, that data comes out. And for years, I would just ignore it.
No one cares.
For years. Right. Now, all of a sudden, it moves the bond market. It moves equities, too.
What you saw is the fastest deceleration in the increase year over year in home prices ever. And just now we're seeing that 30-year fixed mortgage rates are topping 7% for the first time in 20 years, as according to MBA data. Clearly, high mortgage rates are putting a huge chill on housing. How much does this actually bleed into the CPI? People are actually excited to see this because they think, oh, this is great. This means a deceleration in inflation. And other people come out and they say, actually, prices are still rising. It's going to take a while to go into CPI. Oh, and guess what? Wages may also be increasing at a faster pace. We'll wait to see that on Friday with the ECI.
Fed decision coming up next week. The ECB tomorrow. The Bank of England as well next Thursday. We'll get to the UK in just a moment. Equity futures right now on the S&P down 0.6%. On the Nasdaq, a whole lot lower off the back of some disappointed tech numbers. More Facebook tech after the close. Bramo's going to go through that for you in just a moment. Yields are lower in the bond market on a 10-year by 4 basis points, just north of 4% on a 10-year Treasury. Big moves in the FX market, though. Tons of dollar weakness against the euro-dollar, positive 0.6%. I'm struggling to get used to parity now, Lisa, but we're back above parity on euro-dollar.
Do you think that you have to get used to it?
I've got no idea.
I mean, that's really the question. Can we get used to this? Is this dollar weakness a story that is more pervasive, having to do with the rest of the world, or is this an issue of arguably perhaps intervention by some major Asian banks? So what's coming up, just in moments, we're going to hear from UK Prime Minister Rishi Sunak. He's taking his first Prime Minister questions. How much can he give some insight into what that plan will be that they plan to unleash on November 17th? They want to get a full assessment of it. That might be a good thing in terms of prudence. However, it does, as John was mentioning, put the Bank of England in a little bit of a difficult situation. We are seeing a slight bit of pound strength. 10 a.m., this may be the moment of the day, the Bank of Canada rate decision. They tend to be the front runner. If they decelerate the pace of their rate hikes, how much does that set the tone for a step down at the Federal Reserve? And I'm sure that people are like, oh, why are you doing that? But I think that that's actually feasible, right? They have set the tone.
Sure. We'll see what they do. I mean, I'm laughing because I find this step down stuff just ridiculous.
I know that you're laughing, but and
this
a lot of people
has been a conversation for about a month, maybe longer.
I know.
In fact, maybe 2 months.
All right. But I think people are getting hopeful that perhaps we're getting to that point and maybe we'll even get some market disruption. And the Meta, as we were talking about after the bell, Facebook, how much do they confirm this feeling of advertising really decelerating? And how much do they sort of add to the gloom that we're hearing? And what point does this lead to layoffs? And I really, that's what I'm going to be listening for. How much is Facebook going to cut its staff? And how much is this really setting the tone for others?
How much is Twitter going to cut its staff once Elon Musk gets hold of it? That's a good question.
This is, so evidently he's going to buy it, right? Friday he's going to close.
We'll see.
Calling on the banks. You're skeptical?
No, I just think, I remain open-minded about this story.
You're not alone. Because
it's got this message on the Bloomberg. It said, imagine a world without an obsession with the must-Twitter deal, UK politics and Fed speaker diarrhea. What would we talk about?
The weather, how beautiful the world is.
Joining us around the table to talk about the weather and how beautiful the world is Ananya Ladaya, the Global Equities Senior Research Analyst over at Invesco. Ananya, great to catch up with you. We've had a big rally in the last 3 days. We often do this, but I've got to ask the question, how do you know the difference between a bear market rally and something more durable?
Good question, Jonathan. And the answer is you really don't until it's well behind you. But here are a few things that we do know. We know that investors are obviously skittish as the Fed pulls away the punch bowl of easy money, and that's going to lead to a lot of mispricing and uncertainty as people position for this new world. And in these situations, historically, you've always seen that when we're through the worst, the biggest gains of the next leg of the cycle usually come in the first third of the cycle, when the fundamentals are still deteriorating, when there's still gloom and doom, when sentiment is still negative. So we know that whether this is a bear market rally or the real deal, you don't want to be sitting it out till someone blows the all-clear whistle. And so we are still judiciously bullish on equities. There's a lot of long-term forces to be excited about once you look beyond the short-term noise and all the headwinds that you've been talking about. Equities ultimately are a claim on human progress, and there are so many forces pushing GDP higher over the next 5, 10, whatever years that we believe that, mass affluence, new technology, aging, restructuring, these big forces that we call mantra will continue to drive equities and compound them over any long term.
What did you say? A claim on human dominance or progress?
Human progress, yeah.
Do I really want to buy into the claim on human progress right now?
Do
you
have
feel like
doubts
that?
about
I mean, I'm just
human progress,
I'm just
don't
wondering.
you?
I mean, I'm not going to get into that. We don't have to go existential. I am curious, though, of whether the recent earnings cause you any questions or pause about what kind of claim on human progress we have at this moment.
Well, existentially speaking, Lisa, just for a second, the one trait that has never ever worked in the history of mankind is to be short human progress. That has never worked, right? And as Jeff Bezos said, since we're talking tech, human beings have an immense ability to innovate themselves out of a hole. So moving on from, highfalutin human progress to what happened yesterday, it's, all the headlines that you've put up this morning, right? It's not positive. It's not a sure thing. But we're not having any data points here that suggest the bottom is falling out and that things are effectively negative. We're seeing a slowdown in budgets. We're seeing more scrutiny. Decisions are being pushed out. It's like turbulence on an airplane. Put on your seatbelts, but the oxygen masks aren't dropping yet.
So are you buying big tech?
We are always buying any stream of cash flows where the net present value is higher than the stock price. And with big tech, the larger case for tech or these stocks is extraordinary, right? I mean, we're living in a world deluged with data. These business models are a thing of beauty. They're they're low capital intensity, they're very high returns on equity. Investors would be unwise to ignore big tech. But at the same time, in light of the environment that we've been talking about, you want to be judicious. You want to be in places that have a strong position on the value chain, that have some kind of pricing power and margin sustainability, clean balance sheets, and copious amounts of free cash flow.
Everything you've said, we could have said at the start of the year, couldn't we?
We could have, but the valuations would be a lot higher. So
Sure, but that's my point. Everything you've said is true and could have been true at the start of the year, and we're down by more than 20% on the Nasdaq. Haven't we got to reapproach how much these companies are worth, the multiple we want to pay on them? Now we've just blown up 10 years worth of central banks boosting bond buying, leaving rates at zero, seeing negative rates elsewhere. Isn't that the ultimate challenge for us now, to work out the price of the risk-free asset and the price of risk? And for me, that's an ongoing process. Isn't that an ongoing process for you and the team as well?
Yeah, so the one difference between the beginning of the year and now is that valuations are significantly different, right? So that changes the entire calculus for an equity investor, because at some point, everything at a price. And at some point when things do get priced in, the risk reward becomes asymmetric. So on a case-by-case basis, some things are starting to look attractive. The part that I think we've had a, sort of a sobering moment on, people who played on the speculative end of the spectrum, the Jam Tomorrow stories where it was all about taking in free money, growing like gangbusters, and having some indeterminate business model manifest at some future date. That story's definitely gone out the window.
Ananya, wonderful to catch up with you. Let's do this again.
Thank
Ananya Ladaya there of Invesco. On a tough day for equities after a big 3 days of gains on the S&P 500. I say tough, we're down by 0.7%, not a major move. Bit lower on the Nasdaq. We're going to catch up with the man with the crystal ball. It's Mike Wilson at Morgan Stanley, the CIO and Chief US Equity Strategist. We'll do that in the next hour. And this is a man that's called this market pretty well over the last year. And just
Yeah.
last week came out and said you could get a short-term technical rally. And Lisa, guess what we got? A very big week of gains.
Yeah, what did he say? 4,200, but we could get up to 4,000.
Those kind of levels,
those
through
kinds of
4K.
levels. So we're getting there, and then bottom falls out. But I like Ananya's idea of a claim on human progress.
I saw you making
a thing
notes.
of beauty. I mean, it's like keeps me going after Nouriel Roubini yesterday. But this issue right now of how much do we have to price in a new valuation structure, as you raised, is the question. And it's unknown because people don't understand what the end point is and what this inflationary regime is. And it's a really important point that underpins a lot of the volatility we've been seeing.
Still trying to figure that out, trying to figure out what happens in the UK as well. We know that we'll get a fiscal statement on November 17th. We're reporting, Lisa, some of the ideas that are coming about from the UK government going into that fiscal statement. The UK is seeking to plug a £35 billion fiscal hole on November 17th, according to officials. The Treasury has drawn up 104 options to cut spending.
104?
104. It's very specific stuff, isn't
Exactly, I love it.
But this is going to be painful.
It's going to.
At a time where we have high prices, a cost of living crisis, and we're going to see some austerity from the British government.
And how much is Rishi Sunak, who has been in the business world and is a wealthy individual, how much will he target some of the businesses with taxes and things that really Liz Truss tried to move away from? How much does he double down on that in order to plug that gap?
Do you know why Tom took the day off? To watch PMQs. TK's messaging me right now, enjoying PMQs. Question time with the Prime Minister, and Lizzie Burden's going to give us some insight to what they're talking about.
I think he's practicing. He's role-playing with jury duty, you know. He's trying to figure it out. He's like, in the court.
I've actually got no idea what it's up to.
Banging on the table.
Futures on the S&P down 0.7%. We'll catch up with Lizzie over in Westminster in just a moment. The Prime Minister in the UK, spending does need to be paid for. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. New British Prime Minister Rishi Sunak has delayed an economic strategy announcement that was due to be delivered on Monday. It will now be released on November 17th. According to Sunak's office, he wants more time to make the, quote, right decisions on managing the British economy.
Our number one priority is economic stability and restoring confidence that the United Kingdom is a country that pays its way.
The government wants to close a fiscal gap of more than $40 billion. Bloomberg's learned that Elon Musk is promising to close the acquisition of Twitter by Friday. Musk made the pledge in a video conference call with bankers helping fund the deal. They're providing $13 billion in debt financing. The European Union's executive arm will lay out plans to drastically cut pollution levels across the bloc today. That could potentially eliminate more than 70% of the 300,000 premature deaths annually over the next decade. Overhauling air pollution will bring the EU closer to guidelines laid out by the World Health Organization. And Deutsche Bank is signaling that it may exceed its full-year revenue target. The German bank's traders kept taking business from rivals, and rising interest rates fuel income from lending. Deutsche Bank saw fixed income trading jump 38% in the third quarter, beating most of the U.S. investment banks. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Prime Minister and I have decided that it is prudent to make that statement on the 17th of November, when it will be upgraded to a full autumn statement. And I've discussed this last night with the Governor of the Bank of England. He understands the reasons for doing that, and I'll continue to work very closely with him.
Over to you, Governor Bailey. The Bank of England decision next Thursday. That was Chancellor Jeremy Hunt in the UK. The Prime Minister, Rishi Sunak, declining to say just moments ago in Parliament if benefits will rise with inflation. Bramo, we're going to find out what these spending plans look like in about a month from now, and this Bank of England's got to anticipate that with their decision next week.
And the likelihood is they will probably strip back a lot of the benefits. They probably won't spend as much. I mean, that's basically what needs to happen, saying that you have to spend you have to cover some of what you spend. I do wonder, though, how much the Bank of England and Andrew Bailey is in the hot seat. Did you see this column from former Fed official Kocha Lakota coming out and basically saying that markets didn't oust Truss It was the Bank of England that did, by not plugging the gap in the regulatory hole that was some of these pension plans, the pension schemes. How much is this going to be a political issue for Andrew Bailey to try to do the least damage at this next meeting?
Look, I know it's a sport to beat up on central banks. I'm happy to participate. You know that. Of course. Of course. Made a career of doing that.
I'm not saying this. I'm saying
when it comes to this Bank of England,
yes, carry on.
A certain, just a little dose of sympathy. I think they were incredibly concerned about contributing to fiscal dominance or perceived fiscal dominance. And if they had done so, we would have had a much, much bigger problem in the United Kingdom. Having said that, they do have responsibility to make sure that financial instability doesn't make things even worse. And there was clearly a financial instability concern in the United Kingdom.
I would argue that it is getting less and less clear how central bankers remove themselves from the political discourse, how they remove themselves from offering up either some fiscal discipline or offering up, some sort of fiscal amenability to basically say, you guys can do whatever you want, because at this moment, their policies are directly moving in tandem with what's going on fiscally. So they can't ignore it.
This is the irony of
it.
If you try to avoid the politics, you become a part of the politics anyway.
There's no way to avoid it. That's another way of saying it. And that's what we're seeing. And so, at what point does Andrew Bailey try to stay out of politics at this tenuous moment with a rate decision that's really important from an economic perspective with inflation?
But you've now got governments worldwide, including central banks, in the politics. We've talked about this operational independence for a long time in developed markets, but look at what's happening in the United States. We've had Senator Warren, we'd had Senator Sanders, and now we've got the Senate Banking Committee Chair, Sherrod Brown, writing a letter to Chairman Powell, according to Punchbowl News just yesterday, complaining about rate hikes. We're going to see so much more of this. And what's amazing to me is that the people in power, did you hear much complaints about zero rates at the Federal Reserve when those people were in power taking advantage of it? And this is the other edge of that sword.
Right. Where is the political responsibility at a time when you need to come up with long-term plans and you've got short-term election cycles, and what's expedient from the election cycle might not be what's expedient for the economy?
You've got problems worldwide right now. Let's talk about some of them with Bloomberg's Lizzie Burden over at Westminster. Lizzie, you've been hearing the Prime Minister speaking in Parliament in the last 15 minutes or so. What did you hear?
Well, John, if you thought that the grown-ups were back in the room, maybe think again, because Rishi Sunak might have pressed the reset button, but it sounded a lot like the responses that we heard at the dispatch box as his predecessors. Keir Starmer was using the same attack lines that we kind of thought he would. He accused Rishi Sunak of making a grubby deal with Suella Braverman and putting her back as Home Secretary. By grubby deal, he means that he's had to negotiate with the Tory right in order to get back into office. Then Keir Starmer attacked Rishi Sunak for his wife's tax status. He asked when the non-dom loop is going to get closed. He referred to a video that showed Rishi Sunak saying that rich constituencies are going to get more funding. He's really trying to show that Rishi Sunak's out of touch in a cost of living crisis. And Sunak's response was to refer to Jeremy Corbyn again, to insult Keir Starmer about living in North London again. And it's a worrying time, actually, because Rishi Sunak is polled to be, but 2/3 of people think that he is out of touch with the British people. So it's an image that he really needs to turn around. I just want to come into your debate about benefits rising in line with inflation. The appointment of Mel Stride to Work and Pensions Secretary is telling. Even if there's no confirmation yet that benefits are going to rise in line with inflation, Stride wanted that to happen, so perhaps that indicates that it will. And also on the Bank of England, perhaps what needs to happen, this is what former policymakers say to me, is more oversight of the financial stability measures, and perhaps that's a job for the Treasury Select Committee. And it links with the Mel Stride question because he has vacated the chairman's seat at the Treasury Select Committee, so perhaps a job for his new successor.
Lizzie, just quickly here, are you surprised that the other members of Parliament didn't come in hot on what this new plan was, on what the contours of the November 17th issue was going to be?
I have to say they're still going, so I can't tell you exactly whether any of them have been on that yet. But I think really the overwhelming message from the government is that it wants to consider these plans in depth. It's promising to balance the books in the medium term and saying that they are in touch with the Bank of England and the Office for Budget Responsibility closely. And so there isn't going to be a huge surprise as there was with Truss and the mini budget. They're trying to say they've learned their lessons and the bond vigilantes don't need to come out this time. In terms of what it means for the Bank of England, it hasn't really changed the rate expectations for the November meeting. What you might see is 50 to 70, a debate between 50 and 75 basis points, and given the remarks from some of the MPC recently, maybe some words about a lower set of hikes down the line.
Hey, Lizzie.
Because they've said that market pricing is too high right now.
That was Ben Broadbent just last week. Thank you, Lizzie. Great to catch up. Lizzie Burden there over in Westminster. Futures right now down about 0.5%, recovering just a little bit. It's a new world. How many times have we said that in the last couple of years, and then the world changes again? The Prime Minister in the UK, Rishi Sunak, saying this, Lisa: inflation is the enemy. And inflation right now, if anyone in power, is the enemy.
So how do you counter it? Right? And how do you...
That's the problem.
And how much can, in really, the politicians do that? How much are they willing to do that, perhaps, is the better question, because is it going to be austerity? Is it going to be some sort of investment that they can't pay for right now, based on how high rates are, without really cutting back pretty dramatically with the economic growth perspective?
Every single economic downturn for the last several decades has been met with some form of counter-cyclical circuit breaker, either from fiscal policymakers who are constrained now, or monetary policymakers who are grappling with inflation. That's a challenge for the economy, and it's a challenge for this market too. Futures lower by 0.5% from New York. This is Bloomberg. Two hours away from the opening bout. Here's the price action. Equities down by 5 or 0.6% on the S&P 500. Much lower on the Nasdaq 100, down by 1.5%. Alphabet disappoints. I can tell you Microsoft disappoints on guidance. Bramo's going to run you through that in just a moment. In a bond market, 2s, 10s and 30s. Think about the journey where we've been over the last week. On Friday through 460. Right now on a 2-year back to 443. Yields lower again. The house price growth data out of the United States yesterday softer, much more negative than anticipated. Yields lower by 5 basis points today and much lower yesterday too. On a 10-year down by another 5 to just north of 4% on a US 10-year. A ton of focus on the UK right now. I think we've also got to focus on the other side of the story, which is just a much, much, much weaker dollar through G10. A much, much weaker dollar, and pound sterling 115.81. I said think about the journey. Well, cable's at 115. Earlier on it was through 116. It's up about 1% on the session today. And at the end of September, it was 103.50, Lisa. So that's quite a range on a major currency pair over the last month or so.
So how many people have you talked to who say, with conviction, they're all in? They're buying the pound here. They think it's a great bargain.
You think I speak to anyone with conviction about anything?
Well, sure. I mean, how many people do you come on and talk about that?
Isn't that the problem right now? I speak to so many people and they don't have conviction about a thing.
Okay. Well, this is one area that's trading like an emerging market. So how do you deal with that, right?
Tremendously difficult. And for the governor of the Bank of England as well, even more so. Now they've changed the sequencing over when we get the fiscal plan out of the UK.
And when you talk about conviction, that really comes to the stock market too. It's unclear what the narrative is, how much has been baked in. And this really was highlighted by some of the big tech earnings. We already see a decline of 28% in the NASDAQ year to date. And yet some of these disappointments were met with pretty severe downturns in some of the shares. You're looking at Alphabet or Google shares down nearly 6%. Microsoft shares down 6.5%. Alphabet came out, Google came out. They did disappoint. They talked about shrinking some of their workforce, possibly trying to crimp some of the costs that they're really seeing with the margin compression. That's not as surprising as Microsoft, and a negative outlook, a downgrade to what they expect for the Azure, for their cloud computing unit. How much does this speak, as we were talking about earlier, John, how much does this really speak to the slowdown more broadly within tech, and Texas Instruments really speaking to that too? Those shares down 5.4%.
We'll leave those three names up and look at them. It's the breadth of the story here that's got everyone's attention. It's the ad spend at Alphabet, the disappointment there. It's the guide when it comes to corporate IT budgets for cloud, as you mentioned, over at Microsoft. And then Texas Instruments. We've talked a lot about chips. We've talked more so about iPhones, smartphones, computers, all of that. Now we're talking about something much, much broader than that, and that's what Texas Instruments speaks to. It's about industrial machinery. It's the breadth of the story overnight that I think is of some concern to a lot of people.
And it's the reason why Meta or Facebook is going to be so closely watched after the bell today, and Amazon and Apple tomorrow. If you take a look, you are seeing the declines in sympathy there, perhaps not as severe, but 3.9% decline over at Facebook. Amazon's going to be really interesting because that's even broader, right? You see the declines there as well. But Apple, those shares actually outperforming. They're down just 0.4%. But how much are they coming under fire from their peers, saying you guys are not acting fairly? And how much does this really unite some of the big tech names against them because of their app store policies that have gotten really controversial?
If there is a name that can define an earnings season, it's Apple.
Yeah.
And we've been steadily lowering the bar over the last couple of weeks. And some great reporting here at Bloomberg talking about how disappointing some of the iPhone sales might have been, that the demand might be faltering somewhere at some point. We'll find out. I've just find myself talking about that so many different times. I feel like I've been part of this movie before, and it ends the same way. They knock it out of the park. So if they don't this time, I think it still will have that element of surprise, even though we have lowered the bar, because people are used to lowering the bar and then knocking it out of the park every single quarter.
How much is that the reason why the shares of Apple have outperformed? They're down only 14% year to date.
People don't believe it.
People don't believe that they could be a victim of the slowdown. So what happens when they aren't? I think that's really well said.
Is your iPhone slowed down? Has it?
A little bit.
Does it stop charging?
I don't really want to talk about it.
They always do this, don't
I know. I don't want to be a conspiracy theorist.
I say they. I'm not part of the conspiracy. Just saying it always seems to happen.
They target you?
I've got no idea. Maybe they target Ashok Bhatia. He joins us now, Deputy CIO of Fixed Income at Neuberger Berman. Ashok, I won't ask you about whether your iPhone's slowing down or not. Let's talk about fixed income. We've had some bad news, sir. We saw it in house price growth data yesterday, and Treasuries rallied. I have to say that's new, because typically Treasuries are part of the bad news and they don't rally at all. Can you take any signal from that, or is it still too early?
I think we're getting into the zone where, like, our biggest view is the thing that's coming for the bond market is a period of devolatilization, if that's a word, but less volatility. And the reason for that is we're going to be reaching, like, the bond market's priced for 4.75 to a 5% terminal funds rate. Fed, last Friday seems to be signaling they want to start thinking about that pause that has been anticipated all year. But once that happens, you're going to pin the front end of these bond markets of 2-year yields. And then the 10-year yield is going to start moving a little bit more on expectations of growth and whether or not the Fed will ease in 2023 or 2024. And when that starts to happen, the 10-year yield starts to get bounded by just how quickly the Fed could ease, as well as, how strong the remaining inflation data can be. But what that really, I think, is transitioning the bond market from is a market where we've been driven exclusively by inflation and the central bank reaction function to an environment where we're going to be driven more by growth and the amount of slowdown and how that ultimately impacts inflation. So we don't expect, like, 10-year yields, maybe near term we'll get back down to 3.75 or something like that. But as long as that's generally correct, that we're going to get a bit more of a growth-centric bond market and a period of less volatility, it should open up for a lot of capital to come back into fixed income, and that's the core thesis we have.
How concerned are you, Ashok? We've been talking a lot about political risk and pushback against some of the central banks for moving too quickly and crimping growth at a time of great political risk for the people in charge of the fiscal budget. How concerned are you that the pressure will push the central bankers away from being as aggressive as they might have to be to crimp inflation, leading to a sort of stagflationary or sort of higher inflation environment for longer that really pressures yields for longer?
That risk is definitely rising, and I think it's something that's going to play out for the next couple of years. But it will be a couple of dimensions, because the big thing for this UK news and then the retracement was this has generally been an environment this year where fiscal policy and the stimulus was naturally declining and central banks were hiking, and both authorities were going in the same direction. And then the UK comes around and we suddenly have, expansive fiscal policy with tightening monetary policy, and it's just sort of inconsistent. So I think the two things that are coming in the coming periods are exactly what you said, whether, there's pushback on the central banks. I think we're at a point where central banks are not going to be very responsive to that. They're going to stick with tightening, at least for the Fed. But the other issue that's coming is whether or not, just as the UK is course correcting to tighter fiscal policy, that becomes more of a broad theme, and balanced budgets and tighter fiscal policy happens over the coming 12, 18 months in other areas and could accelerate any growth slowdown. So I think both of those risks they're developing.
Either side, what does that mean for a credit cycle that a lot of people still think is pretty resilient, at least as far as what's being priced in? And then you have the likes of some people, Nouriel Roubini among them, saying people are missing the forest for the trees here. There's going to be something more significant going on.
Well, I think we're in the camp that at least, the next 12 to 18 months will be a pretty benign fundamental environment for credit. And, I do think the market is generally recognizing that or shares that view. Even when equities were making, new lows for the year, high yield spreads, 50 to 100 basis points off of the widest spreads we saw. So credit has generally been holding in better. But I think the main thing that we're thinking about for credit investing is the whole world is going to have to adjust to this higher rate structure. But issuers that have a lot of floating rate debt in their capital structure, they're going to be adjusting first. They're going to see the higher interest expense, the declining leverage, declining EBITDA coverage. Our sense is generally that's not a default event. It's more of a risk of downgrade is how we see credit markets. But fixed rate capital structures, they have a little bit more of optionality to see how the rates picture develops. So I would characterize us as a bit more concerned about what the interest rate environment means for leverage statistics rather than expecting, a significant default wave over the coming 12 to 18 months.
Ashok, just quickly on the index, on the high yield index specifically, can you speak to how much the quality of that index has improved over the last 5 years or so? And perhaps give us a decent idea of how much signal or lack thereof we can expect from that index when it comes to telling us how weak this economy is getting and how quickly.
It's a great point, and I think it's something that the market will be, the appreciation of what you said, Jonathan, is rising. So the high yield market has gone from roughly sort of a third double B to over 50% double B issuance. It's increasingly more of a permanent capital structure for companies than a speculative type of capital structure. Now, there's certainly single B, triple C issuers, but the overall composition of the index is the highest in terms of rating, is the highest it's ever been. I think the other element of it is it's a shrinking market. Net supply in the capital markets or in the more speculative capital is increasingly going into the loan market and into the private debt markets. And it's leaving the high yield market in a position that is not the high yield market of 10 or 20 years ago. So I think, as you said, reading too much of a macro view into high yield spreads it's getting, I think, a little harder to draw that conclusion.
Really important stuff, Ashok. Always appreciate your time, sir. Ashok Bhatia there of Neuberger Berman. Lisa, that final point there, I think it's tremendously important. To his point, people are slowly starting to appreciate it. But how many people come on the programme still and say, well, look at spreads, they tell you this and things are okay. You need to be looking elsewhere.
Well, and especially because people use this, or they did traditionally use this, as kind of the sort of red flag.
The leading indicator.
As far as happen. And it's not anymore. Although, what does this mean about private credit?
Exactly.
And that's, I think, the bigger question.
And how much insight do we get into what's happening there?
And how soon before the problems already emerge?
It's super tough. Neil Dutt is going to catch up with us from Renaissance Macro at about 8:30 Eastern. You two are friends again, aren't you? Best friends, I saw.
He believes in human progress, and I do too.
You two are both on the same page.
We are on the same page right now, and it's a beautiful thing.
That's remarkable. Neil's coming up a little bit later. Looking forward to that from New York. This is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Lisa Mateo. New British Prime Minister Rishi Sunak has delayed an economic strategy announcement that was due to be delivered on Monday. It will now be released on November 17th. Sunak's seeking more time to make what his office calls the right decisions on managing the British economy. Europe is running out of time to act on natural gas before winter. The bloc still can't agree on what a price cap should mean. Policymakers have gotten a break. There's a surplus of gas in Europe, thanks in part to warm weather, but that's caused the sense of urgency to fade. A new report from the United Nations paints a grim picture of global warming. It says Earth is on track to warm by more than 2 degrees Celsius by the end of the century, despite plans to cut greenhouse emissions. The UN says the good news is that projections show emissions won't increase after 2030. Higher prices have pushed consumers to tap the brakes on how much they charge up. Visa saw spending growth slow the most in about a year. Volume rose 10.5% to $2.9 trillion in the fiscal fourth quarter, a decrease from the 12% growth reported in the previous 3 months. Profit still exceeded analysts' expectations. And New York is still the most expensive rental market in the U.S., but Boston has now passed San Francisco for second place on the list. According to rental listing company Zumper, the median one-bedroom rent in New York now $3,860. Boston rose almost 6% this month to $3,060, while San Francisco is $40 less. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The kind of crack in the inflation landscape is going to take a while to get into the index. I can make a compelling case that we are moving in the right direction, that the opposition wants to take us in the wrong direction. But yes, it's going to take some time before it works its way into the index and people feel it, I think, more noticeably.
That was Jared Bernstein of the White House Council of Economic Advisors, a few weeks out from the midterms from New York City this morning. Good morning. The price action negative on the S&P 500, down about 0.7% off the back of disappointing ad revenue numbers out of Google, disappointing guidance for software, cloud spend out of Microsoft, and disappointing numbers as well from Texas Instruments. A broad sweep of negative news after the close yesterday. A little bit later after the close, we get Meta, Facebook numbers coming up shortly. Rally in the bond market, that continues this week. This morning, we're down by about 4 or 5 basis points, just north of 4% on a 10-year. Talked a lot about this rally in the bond market and the weakness you're seeing off the back of it in foreign exchange. A weaker dollar, euro dollar, positive 0.6%, 10023. We have a 1 in front of euro dollar again going into the ECB tomorrow and looking potentially for a 75 basis point interest rate hike. We had some news out of Russia in the last 60 minutes. Vladimir Putin, a Russian leader, has been speaking. Wanted to get Maria Tadeo to jump on the phone and get us up to speed on all of that. Maria, can you walk us through what we heard from Vladimir Putin in the last 40 minutes or so?
Jonathan, and the key here is that you have to pay attention to what Vladimir Putin says and what Russia is doing. Whether you believe what they say, whether they mean what they say, that's a separate story. It's very clear by now that we are in a propaganda war too. But what we have today are pictures on Russian TV. Vladimir Putin is overseeing nuclear drills, and the Russians say they have completed this training. Everything was on target, and the training has gone as they expected. Otherwise, it has been successful. Now, there's a number of things you have to keep in mind. There has been a flurry of calls now from the Russians about the dirty bomb. This is an explosive that's wrapped up in radioactive material. They say Ukraine is planning to do this. Ukrainians deny this. They say take the nuclear atomic agency, agency to come to Ukraine and check it. This is not the case. But nonetheless, the Russians say this. Today there's a drill. The way that some interpret this is that either Russia is trying to reach out to the West to get diplomatic channels going on, or actually this is a false flag for what could be a serious escalation in the war. And also, Jonathan, put this in context. This is now a very sticky war. We're now entering the winter. This is very complicated to move people, to move men, troops, army, weapons in the winter. And Russia's in a position when they're not advancing. They're having to stay in position, defending targets. And Ukraine says our counter operation continues. So the pressure for Vladimir Putin increasing domestically. This is the Russian army, the pride of the nation. Technically, on the ground, it's a different story. So you have to read the signals here. I'm being told it's two scenarios. Either this is a false flag that's in the making, or Russia, given the desperate situation on the ground, is trying to make communications channel now back on with the Ukrainians. That's dead. That's why they're reaching out to the West under the pretext of this dirty bomb.
It's a concerning time, Maria. Thank you for jumping on the phone and running us through all of that. We heard from the President of the United States, Joe Biden, in the last 24 hours on this topic. He said, quote, Russia would be making an incredibly serious mistake were it to use a tactical nuclear weapon. I have to say, Anne-Marie, hey, mate, you were in the room with the President yesterday when he got his booster shot. Can you walk me through what's going on with this administration? Because we had this bizarre chain of events happening yesterday where 30 Democratic progressives wrote a letter about pushing the administration to go towards some kind of diplomatic solution. and then retracting it and walking it back. What on earth is going on?
Well, let's just say clearly the White House is saying that nothing has changed in their approach with dealing with Ukraine and that they are not in a moment to negotiate with Russia at this time. And then you have, though, Jonathan, what's happening, as you say, it's quite confusing. A lot of people are shaking their heads and unsure of where this is coming from. These 30 progressives released this letter that said maybe now is the time as we pair some of these economic assistance alongside diplomacy, even including potentially sitting down and talking with Russia. There was a ton of blowback on this letter from the progressive wing of the Democratic Party. So then they retracted the letter, and you had the caucus chair, Pramila Jayapal, come out and say it was a staffing issue. They didn't vet it because this letter was circulating in the summer. But then at the same time said, as the chair, I take control and I take the responsibility for this getting out. The issue of course, is you have to think, and I'm hearing from representatives saying, well, I signed it in June and it was a different scenario. Was it really a different scenario? Yes, there wasn't a talk of a dirty bomb every day making headlines, but what you did have in June was President Putin installing authorities in occupied territory. And of course, that led to the annexation, illegal annexation of these territories in October. And then there was still fighting on the ground.
But Anne-Marie, that's a political back and forth, and we can get into that. We will get into that. Everybody is talking about that. There's a broader issue, which is that both parties, but the Democrats in particular, because they're in charge, are grappling with the economic blowback of this conflict and some of the sanctions. Is there a cohesive message that we're getting, especially after we heard from Sherrod Brown yesterday, talking about the concern about the Federal Reserve's actions with inflations in terms of what they would like to see put into place that could crimp inflation more significantly?
Well, what's interesting about this letter from the progressives, Lisa, is that it was 15 days before a midterm election, where what is the number one issue, poll after poll? It's the economy, and then right behind it is inflation. So you have this pressure on lawmakers across the board about to deal with rising consumer prices. And this is what the struggle is and why people may go out and vote, why many are saying the polls are closing and there potentially could be this red wave. At the same time, you asked about a cohesive message. I don't think it's cohesive in terms of how the Democrats are approaching the economy ahead of the midterm elections. You had the likes of Sherrod Brown. Of course, he's the chair of the Senate Financing Committee, so he's the one that has to overlook what the Fed is doing, writing this letter to the Fed on the heels as well of Senator Bernie Sanders, Senator Warren over the past couple of months talking about the Fed. Are they going too fast? They have to keep in mind the unemployment. But is by and large the Democrats using the Fed as a scapegoat? Not yet.
AMH, down in Washington. Anne-Marie, thank you. Got to talk about two things with regards to this letter from the Senate Banking Committee Chair, Sherrod Brown. The optics and the content. On the content, there will be many people that believe he has a point, including the Wall Street economists that come on this programme and have flagged exactly what he's saying, which is the Fed's actions do not address some of the main drivers of inflation. Then you've got the optics. For all the complaints about the former administration, about the way they dealt with this Federal Reserve, if this pushback grows from the other party down in Washington, D.C., then they're both playing the same game. And this Federal Reserve, I think, is finding itself in a very, very sticky spot. When I saw these comments yesterday, the first thing I thought of, and I mentioned this earlier this morning, were the comments from Chairman Powell in Jackson Hole at the end of August. When the chairman comes out and effectively tells everyone, doesn't even whisper it, that what we're going to do is cause some pain. But if we don't, there's greater pain for not dealing with it. So ultimately, what they're telling you, and it's in their projections, is that the objective is to get unemployment up. That's part of the goal. Right. To get unemployment up, to get inflation down. And we've said repeatedly on this show, it's going to be very, very difficult to convince people in Washington and across this country that higher unemployment is a price worth paying to get inflation down.
And this is going to be a very difficult thing, because how does Fed Chair Jay Powell continue to reinforce that message when the political blowback starts to get that much more intense?
If it does get more intense, particularly ahead of next week when this Fed is set to go again, potentially by 75 basis points. Coming up in the next hour, do not miss this. It's Mike Wilson and Morgan Stanley next.
Right now, all central banks are playing tough and talking tough and acting tough.
I think that the Fed is highly aware of what they've done to financial markets.
This is a world where we're going to see a very significant slowdown of activity.
In this economy, the recession risks that we're seeing are by no means uniform.
Everyone's waiting for this Fed meeting next week, but I think the message will be, no, we're going ahead, we're still staying hawkish, and the dollar will rally into Christmas.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
No Fed speak all week. It's been wonderful, blissful, I have to say. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Ferro. TK back with us tomorrow. Futures right now down 0.75% on the S&P. We've had a nice run. 3 big days of gains, Bramo. And then the earnings hit us around the head yesterday evening.
Do you really think it's been blissful for the past couple of
wonderful.
days? Really? You think so?
Oh, for sure.
This has been sheer bliss. Other
I
than
love
the
the
down
quiet
number.
period now. I love the quiet period.
It definitely creates more focus on the actual data. And the data has been softening on the macro level, which was bad news was good news. And then you got the things which perhaps changed the scenario and really raises the specter of how much has actually been priced in, given that any misses were heavily punished in the aftermarket hours.
We've talked about this a million times. Can you make the argument we've priced in a bulk of the rate hiking cycle? If you're pricing a 5% terminal rate, I think you could probably make that argument better now than you could 3-4 months ago. Fine. Have we priced in the consequences of that rate hiking cycle? Most people on this program say no, we haven't. So we started to see some weakness of the earnings. And it was a broad sweep of earnings too. It was ad spend at Google. It was IT budgets, corporate IT budgets in the Microsoft projections that got people's attention. Bit of concern there. Texas Instruments as well.
Yeah.
Just speaking to the story that this is not just about smartphones and computers, that this slowdown might go beyond that.
And you talk about how we haven't necessarily priced in the ramifications of higher rates for longer. We don't even understand what the ramifications of inflation themselves are on some of the consumers, right? So how much is this just because inflation is high, consumers are pulling back? We don't know where the economy is going to be just in a broader sense. The issue is if you get an economic slowdown sufficient for a step down or some sort of slowdown in the pace of rate hikes, is that good news or bad news? You've been asking that all year. And right now, at least treated by the earnings and the way that they've been treated in aftermarket hours, it has been bad news. Bad news is bad news. And how much can that continue?
It depends why they're doing it. Now, if you're going from 75 to 50 to 25 because the economy is slowing down, that's not great news. If you're going down from 75 to 50 to 25 because you get this positive supply side response, that's good news. That's bullish. That's great. They've got to back away of rate hikes because you've got the supply side solution to the inflation problem. But if they've got to destroy demand, problems. If it's because of financial stability, big issues. And that's what Mohamed El-Erian had to say on Bloomberg yesterday.
Here's my issue, and this was really highlighted by Google earnings yesterday. You heard the CFO come out and say that it takes time to move this ship, right? That they're trying to pare back some of the headcount. They're trying to pare back some of the expenses in order to have bigger margins, but it takes time. So they have to get those plans in place. If the Fed turns around and stops raising rates as much, how much of an actual effect does it have on the economy that's already turning around, that already will lead to higher unemployment?
It's pretty bearish stuff there, Brian.
Look, we listened to, Nouriel Roubini, and he made some good points.
I said to Mohamed, I caught up with Mohamed after we caught up with Nouriel.
Depressing.
I said to Mohamed, it's good that Nouriel came before you because he set the bar so low that even Mohamed was sounding constructive.
I was about to say.
Relative to Nouriel.
He sounded downright optimistic. It's not a done deal that we're going to get recession. That was basically bull.
Since when was this optimistic to say it's not 100% a done deal that we get a recession? That's constructive these days?
Especially from Mohamed El-Erian.
Okay, that tells you a lot about sentiment.
And it tells you something about also following Nouriel Roubini.
Sure. Futures down 0.75%. I have to say, I started the book last night.
It's a good book.
If I come in day after day, increasingly bearish, you know why.
You're not going to shave.
Month.
You'll come in looking haggard.
I messaged Nouriel last night, said I've started the book, and let's see how. You can follow me and say what I sound like in the next the next few weeks.
Life
all right?
with Nouriel Roubini.
Futures down 0.75% on the S&P. There's a rally in the bond market. Yields are lower by 4 basis points. We're just above 4% on a 10-year. That rally in the bond market continues. Interesting to see some dollar weakness out there as well. Euro dollar back above parity, back with a one handle on euro dollar. There you go. Euro dollar positive about 0.5%. But Lisa, I think that rally in the bond market is curious off the back of bad news. We're finally starting to see the risk mitigation characteristics return to the bond bond market in response to negative data, specifically off the back of that house price growth data in the United States?
And will it all be killed with the CPI report, right? I mean, at what point does the proof really come in inflation that isn't coming down in certain areas? People think that, yes, housing prices are increasing at a slower pace. You're seeing retailers discount certain items. You're seeing car prices, used car prices, not new car prices, come down. How much will that really bleed into broader, lower inflation versus simply kicking the ball over to employment costs and other issues?
I keep saying there's a man on Wall Street with a crystal ball, and the fortune teller joins us right now. Mike Wilson, the CIO and Chief US Equity Strategist at Morgan Stanley. Mike, wonderful to catch up with you, sir. I say this because you come out last week and talk about this short-term tactical call of a market that's going to mount up a little bit, maybe through 4K again on the S&P 500. And here we are, massive week of gains last week, first couple of days this week, pretty tidy as well. What is it about the short term, Mike? And we could talk about the longer term, but what is it about the short term between now and maybe the start of next year where you become a little bit more constructive?
Yeah, it's a tough gig, right? Making predictions is a tough job, especially about the future. But that's the life we've chosen. And look, we have to try and make these tactical calls when we feel like they're actually tradable. And we do feel like we got to a point a couple weeks ago, mainly for technical reasons. But there are some fundamental things that are changing too. Now, this summer we didn't actually try and pivot into that tactical move because we didn't have all the elements. Let's talk about them one at a time. The first one is, sentiment and positioning is extremely bearish, probably as bearish as we saw back in June at the last time we had a tactical rally. Secondly, though, we got to the 200-week moving average. That's something that we did not achieve in June. And that's a very important technical level that a lot of people don't talk about. We look at it very closely. It is your long-term support level. And to break that level, you typically need a recession. Okay. Now, the odds of recession are very high, as you were just speaking, but we haven't seen the whites of the eyes of that recession yet. And until you get that, you can usually hold that 200-week moving average. So that was a big factor. And then probably the most other important factor is we think rates are topping. Rates are looking very toppy. Our rate strategists have done a great job here. They've gotten more neutral. They're now calling for no longer bear flatteners, but actually steepeners. And that's going to be mostly at the front end. But nonetheless, the back end's going to come down too as the market starts to think about the Fed pivoting. And then the last thing is the earnings story. As you guys know, that's where we've been focused. We're probably more bearish than most on the outlook for next year. But, we got earnings this quarter. And what we just don't think we're going to get, John, is we're not going to get the full capitulation from companies on 2023. We think it's just going to take longer. We've written about that quite a bit. You read our research. So how we're thinking. We're still bearish in the intermediate term. We don't think the bear market's over, but we do think this tactical rally is going to be big enough to try and pivot and trade it. For those clients who can do that.
How far along, Mike, are we in this tactical rally?
All rallies and all downturns are about time and price. Lisa, as you know, I would say in terms of price, we've talked about 200-day moving average now is an achievable level. That's sort of 4150, but it's coming down. So depending on when you get there, that'll determine the level. I think in terms of time, it's probably into the holiday period, maybe Thanksgiving. Then we'll get the sort of the Black Monday results, from the holiday shopping season, and we'll see if it is going to be a Black Monday or a Red Monday. Do we get the sell through? We're pretty discouraged, in terms of what we think we're going to get through on holiday sell through, mainly because what you just mentioned, there's going to be a lot of discounting to move some of that extra inventory, something we've been highlighting for a while. And so that's when we'll get the next chance to perhaps see, the fundamentals overtake the technicals on the downside. And then we think ultimately the bear market will be over probably sometime in the first quarter. Now, all of this is, subject to revision, right? So I want to make it perfectly clear, if the market starts to trade off again and the S&P breaks down and blows through 3650 on the downside, we'll be bearish again, okay? But, this is our job. We think, and we like the price action the last couple of weeks, notwithstanding, some negative earnings reports last night. We think maybe the market will hold up, and that'll be another positive catalyst, because if stocks don't go down on bad news or the market isn't going down on bad news on fundamentals, then what do you have?
And Mike, you talked about this difference between technical factors and fundamental factors. In the near term, what's the optimal way of paying that tactical rally in the equity market? How do you want to do that? Through the index of the S&P or somewhere beneath it, somewhere else?
Yeah, good question. First of all, the call is really, to help our clients who, can short stocks, right? So the main call was just get out of the way. And because when you get these kinds of rallies, the shorts usually go up the most. And that's what's happened so far. So it's a low quality rally so far. The shorts have rallied the most. So some of the expensive, kind of growth stocks, some of the low quality cyclical stocks, the small caps have hit a little run here. That will probably persist. And then I think ultimately it'll morph into probably NASDAQ leading because rates are going to come down, right? Part of our call is that rates have to come down. If rates don't come down, John, and we don't go below 4%, like in a meaningful way, the rally will peter out probably around these levels. But if that happens, as we suspect, and rates do come in, then you'll see these growth stocks have probably a pretty meaningful move, despite the fact that maybe we're getting some bad earnings reports.
We're going to talk a little bit more about the fundamental stuff in just a moment, but just a little tease, Mike, if you can. 2023, early 23, it's earnings season for Q4 and maybe some guidance for the rest of the year. You said we haven't had it yet. We haven't had that overwhelming negative guide from corporate, C-suite management, all the rest of it in America. Mike, how do you know what that looks like? What does that look like? What do you think that looks like? How will you know when you see it?
Well, those are trade secrets. I can't share that. No, I mean, look, we'll know it when we see the forward estimates really come down. Okay. In other words, so far, let's just talk about some numbers. It makes it easier for people to kind of follow what we're looking at, which is, so we think markets trade on next 12-month EPS. Okay. And in the S&P 500 case, that got to 240. That was the peak in June. We're down to about 233, 234. Which is only about 2 or 3% off the highs. We think that ultimately is going to go to about 195. So when we see that forward estimate get down about 30, 40, 50% in its way to the ultimate destination, then we'll feel like, okay, it's there. We're not going to wait for 195. By then the market would have definitely discounted it. But at 233, 234, that's not anywhere near where we think we need to be to say, okay, the market gets a joke. And that's something like 220, 225, John. That's kind of what we're looking for in NTM EPS for those people who follow it.
Mike, they're playing the music. They want us to go. So we're going to continue this conversation in just a moment. Mike, stay right there. Mike Wilson there of Morgan Stanley. Equity futures down 0.7 on the S&P from New York. This is Bloomberg.
Gotta love that music. Keeping you up to date with news from around the world with The First Word. I'm Lisa Mateo. New British Prime Minister Rishi Sunak has delayed an economic strategy announcement that was due to be delivered on Monday. It will now be released on November 17th. Sunak seeking more time to make what his office calls the right decisions on managing the British economy. The government is seeking to plug a fiscal hole of more than $40 billion. Former Treasury Secretary Steve Mnuchin indicates the Federal Reserve's fight against inflation will show results soon. Mnuchin spoke at Saudi Arabia's Future Investment Initiative.
You are going to see inflation in the U.S. begin to come under control. Now, it will probably be a 2-year period, but you're going to begin to see that, I think, relatively quickly. And I think people are overestimating the Federal Reserve's actions, just as they underestimated it.
Mnuchin also said that China faces a significant slowdown that will have an impact on the world economy. Bloomberg's learned that Elon Musk is promising to close the acquisition of Twitter by Friday. Musk made the pledge in a video conference call with bankers helping fund the deal. They're providing $13 billion in debt financing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
아직도 몰랐어? 명품을 합리적으로 거래하는 방법. 구구스에선 가능해. 중고명품 거래의 새로운 기준. 내 명품 판매부터 매력적인 가격에 구매까지. 전문가 검증을 통해 믿고 거래할 수 있으니까. 당신의 완벽한 중고명품 플랫폼. 구구스.
Right now, all central banks are playing tough and talking tough and acting tough. If they try to get to 2% inflation, they cause a recession. And this recession is not going to be short and shallow. It's not going to be garden variety. It's not going to be plain vanilla. It's not going to be 2 quarters of negative growth, then inflation collapses and they can ease again.
Nouriel Roubini, the CEO of Roubini Macro Associates, out with a new book in the last week or so as well. Pretty depressing stuff. But on the short and shallow stuff, I have to say, think about how the consensus has shifted through the year. Do you remember we were never going to see a 50 basis point hike? Then we were never going to see 75. Then we'd never see 275 basis point hikes. And surely rates wouldn't go through 4. A 5 handle? Absolutely no chance. Here we are. And now it's all recession, short and shallow. The overwhelming consensus.
Right. And as you've said, is this the new transitory? The interesting thing is, Nouri Roubini, I asked him, do you get a lot of pushback? You're always bearish, so why should anyone listen? And he said, from people who actually are in the know, when they read this, you're laughing at me.
And he I'm laughing.
No, because he said...
I feel like you're asking a friend. Do they ever push back against you? Because they push back against me all the time. Were you asking for yourself?
Don't we have a guest? We have a guest.
Can we move
on?
We've got Mike
I'm
Wilson.
saying, he said, people agree with him, which I think is interesting. He has some good points.
Okay, cool. I'm going to get to Mike right now.
Thanks, good. Hi,
Mike. You just won, and I'm happy to say you were just ranked the best portfolio strategist in the latest institutional investor survey. Mike, I know you well. You'd share that prize with the whole of your team. Mike, can we start there? Can you walk me through what has really given you and the team the edge this year as you've worked through a really fast-moving economy and a tremendously difficult market?
Well, thanks, John. I appreciate that. And you're right, it's a team effort. I mean, a lot of effort goes into this ranking. A lot of it has to do with just client service, if anything else. Our calls have been right. But, what clients pay us for and what clients really want from us is critical thinking and, holding their feet to the fire on, kind of what's happening. And I think what's allowed us to maybe get ahead of the curve a little bit is I'll go back to 3 years ago, and our research well. We first started talking about the recession itself. It was going to be really nasty, but then the V-shaped recovery, we said the next cycle will be hotter but shorter. And so having that framework, right? We're cycle analysts, a little different than psychoanalysts, but we're cycle analysts, and we look at history. Yeah, well, it's similar. But it helps us understand kind of, okay, well, what does this period look like? They're never the same exactly, but having that context, that historical context, we spend an enormous amount of time on that. Plus, I'm a little bit older, so some of it I lived through. And we understand when we see something, okay, it's different this time, and that helps us sort of stay ahead of the pack. Not always, but I think in this year in particular, right, we saw early on that this is going to be a shorter cycle. The Fed was going to have to move faster than people expected. That was going to, curtail expectations on profits. Ultimately, the fire and ice narrative is played out, and that, so just being willing to kind of get in front of the pack, I think has really helped us, not just this year, but in years past as well. And of course, when you do that, you run the risk of being wrong. Okay, and we're wrong occasionally, and it's not always right. But you have to be willing to go there. You have to be willing to take a shot and get away from the consensus.
Mike, given the historical perspective that you do bring to this, where are we in terms of the ice and short and shallow, and this question of, okay, if it is deeper, how long will it last, and how long can inflation remain prolonged? When you take a look at when you start to find optimism in the equity markets, perhaps early next year, is that predicated on this idea that we are not going to be in some sort of high inflation environment for a very long time?
Yeah, I mean, here's a great example where, we have a view that is not consensus, and we have more conviction in it. We've been actually thinking about this for 4 or 5 years. If you go back and look at our research, we didn't just pull it out of left field. We think we're entering, the end of financial repression, the end of secular stagnation, and actually the pandemic was the catalyst to kind of break us out. Now, of course, we're experiencing this first wave of inflation, which was spectacular, and more than people expected. But we think we're into what we think is a boom-bust environment. It's very similar to the post-World War II period of 40s and 50s, where we had more frequent recessions and inflation was volatile. Okay, so it wasn't higher and then stayed there. It was high, low, and the trend is up. Okay, so we have no naive belief that we're going back to the way the world was, lower for longer, and the Fed can continue to keep, rates at zero or lower. We're never going back to that. It's going to be something different. But we also don't think it's the 70s where we're going to have this cost push inflation. We've always said that we think it's a demand pull inflation, and that demand is waning now as supply picks up. And so that will create the ebbs and flows. And what we really think we're in is a volatile economic outcome, which includes inflation and includes nominal GDP, includes all the factors. And it's just going to be a lot more volatile. And that's just a different environment. And if you understand that, it can be quite profitable if you understand how to trade it on both sides.
Mike, just a final question from me then. Does it tell you anything at this point? And how does it influence your thinking about future leadership in this market after a decade of growth dominance on the S&P?
Yeah, we're not in the camp that it's just going to be one or the other. We think it's going to be a broader kind of market where you get broader participation, kind of like 2020. And then, it was broader. It was small caps led, right? We had growth and value working together. I can tell you this: the days of ridiculously priced growth stocks, that's over. Okay, and that, by the way, that was dumb to begin with. So that's good. You take that stuff out, but that doesn't mean all growth stocks are doomed. It just means you can't overpay for it the way that you could when rates were negative. Okay, so we're not going back to that environment, which means you have to focus on companies that can actually operate efficiently in this more volatile economic environment, deliver the goods on earnings, and then pay a reasonable multiple. It's kind of back to basics. It's kind of the way it was when I first started in the business. Get the training wheels off the bike and learn how to ride again.
Hey, Mike, just wonderful to catch up. And send our best to the team, won't you? Congratulations. Mike Wilson of Morgan Stanley there. Lisa, the best portfolio strategist in the latest institutional investor survey, and some tremendous calls over the last 12 months and beyond.
He didn't show us his crystal ball, but
he didn't.
We did get the sense.
He did imply he might have one.
The glow
The
right next
secrets.
to him. Yeah, exactly. Please don't. It's wonderful. No, look, he's gotten it right. And I think that the really interesting thing is he's not afraid to talk about a tactical rally, to embrace something that is going to happen, even if it doesn't cohere with a neat narrative. And I think that right now, that is one of the most difficult things, is it's easy to get caught up in a narrative, but sometimes the positioning can rip against people. And I think that right now, we're in a period where there's been a lot that's been baked in, and the short positions, as he said, are what potentially could hurt people, right? So he wanted to basically say, get out of the way.
Sure.
I thought that was really interesting.
I think we've said it a few times. I've said it a million times in the past. It's not about being right or wrong. It's just about working through the process sometimes and understanding the framework of the individuals that do have the success. We can all get lucky and say we're going to be here, going to be there. The source of their success is the framework, and the framework they've had is just a deep understanding of how this cycle would materialize through the pandemic and out the other side.
Yeah, and there's also an era of self-questioning and sort of ongoing, really, I don't know.
Are you saying that's absent elsewhere?
Well, I'm just suggesting that that's a successful
I just
trait.
wondering if you're speaking about another bank.
To have,
okay, all right.
Need a lot of therapy.
Your friend's coming up. Neil Dutta, Renaissance Macro is next. This is Bloomberg. I could tell you over the next 12 months we'll spend a lot more time looking at housing data, and we're going to do that in about 10 seconds time. Good morning to you. Your equity market looks like this going into that economic data in America. On the S&P 500 we are negative. We are down 0.8% after some disappointing earnings after the closing bell just yesterday. Meta, Facebook coming up after the close a little bit later. Bond market rallying, yields lower by 4 basis points. Mike McKee around the table with that data. Morning, Mike.
Good morning, John. Well, we've got some interesting news for the markets and for economists to try to figure out how this fits into third quarter growth, because we got the September advanced good trade balance. It's a lot worse than anticipated, $92.2 billion, and that is down, well, I guess you'd call it down. It's wider than the 87.3 in the month of August. Retail inventories come in up 0.4, wholesale inventories up 0.8. Both of those are much lower than they were the prior month, but there's still a gain. And when you look at retail and wholesale inventories, you see they're running way, way, way ahead of where they had been in pre-pandemic years. And that does suggest that we're going to have some more growth added to the third quarter numbers, but it also takes away from the future. And it may give us some break on inflation if we see retailers cutting prices as they have been to try to get rid of their stocks. And the number John was referencing in terms of housing, the Mortgage Bankers Association's mortgage application index falls 1.7% in the month in the last week. That's down from 4.5% drop the week before. And when you look at the overall index, it is now the lowest since 1997. So people are really bailing out of the housing market. It's hard to say that this is comparable to that period because we saw rates higher in those days than they are now, and people were still buying houses. But it does look like the housing market is really kind of fallen off a cliff here when you look at sales to the mortgage rate. We will get new home sales, guys, a little bit later this morning.
Let's talk about that data in 90 minutes then, new home sales. What are you looking for? And Mike, can you frame just how bad it is in U.S. housing at the moment?
Well, new home sales are going to be a little odd. The consensus is we're going to see them drop, but we have seen housing starts hold up generally well and building permits actually rise because builders have backlogs. So new home sales are based on basically when you sign contracts. Now, contracts are going to be canceled in some cases as mortgage rates go up and people decide they can't afford them. But it's the existing home sales numbers that will really give you an idea of where housing is. And existing home sales have started dropping tremendously. Those are based on closings, and that was mortgage rates a couple of months ago. So we should probably see further declines ahead.
You're going to stick around with us? You're going to run? You're going to stick around?
Well, I mean, you have a guest that I haven't seen in a long time.
Let's catch up with Neil.
Anxious to see him.
Neil Dutta of ASOS Macro joins us around a table. I was told by Joe Weisenthal to ask you about your sterling target out of the UK, and I said to Joe straight away when he messaged me about 30 minutes ago, Joe, what are you talking about? Does FX targets now? What's Joe talking about?
I don't have a sterling target, but I can tell you that my kids have convinced me to go as the Prime Minister of the UK for Halloween.
You're going as Rishi Sunak?
Yeah, I definitely am.
Is Rishi Sunak coming with good things?
I mean, as I was joking with Joe, I mean, I told him very clearly that, you know, I have a habit of betting on Indian. And I told him, as a result, it's time to go long sterling.
He's got the credibility back in the market.
Yeah, exactly.
That's more than a joke for a lot of people. Let's talk about the credibility of this Fed chair as well, Neil. And it's wonderful to have you with us around the table. The politicians are pushing back, Neil. The usual suspects, Warren, Sanders, but also now the Senate Banking Committee chair as well, in a letter according to Punchbowl yesterday. How did you and the team respond to that?
Well, I think it's amusing. You know, look, if the prediction markets are right, they better get in their jabs right now, because the likelihood is that the Republicans will sweep both the House and the Senate if the prediction markets are right. And I can tell you right now that if the Republicans are playing this right, they will not have any political interest to tell the Fed to back off from hiking. So threats to the Fed's independence from higher interest rates, I think, will be dramatically coming down once the Republicans take over the Congress, because they want the Fed to keep hiking, to slow the economy down, to improve their own political fortunes going into the 2024 elections.
This is actually really important because it also suggests an unwillingness on the fiscal side at a time when we're heading into a downturn. Does this mean that any fiscal impulse from Washington, D.C., based on the outcome that you said is most likely, is going to be that much more reduced and going to be that much less of a counter-cyclical balance to what's upcoming?
Well, I think that's the case going forward. I mean, the next time we have an economic slump, given where interest rates are, and given the recent experience with inflation, I think it's highly likely that we'll have less counter-cyclical policy, both not only from the monetary side, because I don't think the Fed will be going as aggressively next time around, but also obviously from the fiscal side, because the fact that interest rates are higher means that the government's spending more on interest expense, which will limit their ability to backstop the economy.
Growing issue coming out of the election, if the Republicans take control, is the presumptive Speaker of the House, Kevin McCarthy, saying that they will hold the economy hostage to the debt ceiling, which would come up theoretically sometime in the first half of the year, and that they are basically willing to go up to the line and maybe fall over and see the U.S. downgraded or default. How much of a risk do you think that is?
I think it's a risk. I don't know that it's any more than previous years. I mean, remember, we've had this happen with, you know, Democratic president. Back in 2011, Republicans just got into power. We pushed up to the limit. The debt did get downgraded, and what happened with interest rates? They actually declined at the time. So maybe this time will be different, but I have a feeling that they'll push up to the last moment, and if it wasn't for the last minute, nothing would get done, sort of.
I hope we're not doing that again anytime soon, Mike, but I share your fears that we might be pretty soon as well. Neil, the pushback that we often get on this show when we have guests come on and talk about runaway inflation is just to open your eyes and look beyond the data. Look at freight rates, look what's happening with supply chains, look at what's happening with house price data, with rents in certain cities starting to roll over a little bit. When does that start to show up?
I mean, is there a statute of limitations on those arguments? I mean, that's my issue. We've been talking about those issues for the last 6 months, and that's not to say that those things aren't happening, but during that time, core inflation's actually accelerated, and underlying inflation's actually accelerated. So I think there's a statute of limitations on those arguments. I think ultimately what we're talking about there is just relative price shifting. If, you know, let's say people are getting paid and they have their jobs and their wages are growing at 5%, okay? And now the rent burden is becoming too onerous, so everyone who decided to go out and live on their own decides to shack up with a roommate. What did you just do? You gave yourself a tax cut. If you don't lose your job, you're not paying as much on rent. That frees up dollars to go spend elsewhere, driving up the prices for those other goods and services upon which you are spending money. And so I don't know where the money's going to go, but I can tell you, absent a sort of spontaneous increase in the savings rate, it's highly unlikely that, all they're talking about is really relative price shifting. I don't necessarily think that's the way the Fed is thinking about inflation, rightly or wrongly. For whatever reason, okay, and my job is not to tell people whether I think it's right or wrong. It's about trying to tell people what I think is going to happen. And rightly or wrongly, the Fed views the labor markets as the conduit to achieve their inflation objectives. And that means you need to see higher unemployment. And if that's the goal, they are failing miserably, okay? I mean, we just learned that, despite all the sort of chatter about tech layoffs, I mean, Google's still hiring lots of people. I mean, all these large tech companies are hiring lots of people. Consumers still feel very confident about the jobs market. Claims are still very low. Even if you look at regional manufacturing indicators that have been slowing down, the employment components within them remain relatively strong.
I wanted to ask you, though, about big tech. That's exactly where I wanted to go, because it's perhaps we haven't seen the job cuts yet. But perhaps they're coming based on the rhetoric from Google, based on the rhetoric that we've heard from Meta or Facebook, based on the rhetoric that we've heard pretty much across the board. Today, Seagate Technology Holdings says that it's going to cut 3,000 jobs. I mean, we keep hearing anecdotally, yes, this is happening. So is it too soon to say that we're not going to see those broad-based tech cutbacks?
I mean, I think you are seeing those cutbacks, but I think what also is happening is that there are lots of job openings, and so those people are transitioning relatively quickly to new employment opportunities. And one of the things we find is that, the median spell for unemployment is like very low. I mean, maybe less than 10 weeks. So I think a lot of those people may be getting layoffs. Not to say the news is fake, but they're just... the fact that continuing claims remain low tells you that those newly laid off people are transitioning into new jobs pretty quickly.
What do you make of this step-down argument, then? This story that came out of the Wall Street Journal, 75 to 50 to 25.
I think that's implicit in the Fed's dots plot. Now, the issue is for the Fed is that if every time they hint at a mini pivot, the market rips and break-even rates go up 10 basis points, that's a problem, and it makes the pivot less likely. So I do think, the risk is that they end up doing more than what they've already signaled in the dots plot. I wouldn't be surprised to see a Fed funds rate, well north of 5%. I think we're actually on a glide path to that. And the fact that, to me, the most notable thing that Chair Powell has said was at the September meeting when he had that kind of moment where he said, I don't know what the path will be. I can just tell you it'll be enough. That, to me, tells you that relative to whatever they've put into their dots plot, it's likely to be higher than that.
They want to put a lid on markets, Lisa, and on financial conditions.
Yeah, that's the problem, right? And this sort of self-fulfilling prophecy.
Sure.
But what Neil just said there, then they're on a glide path to well north of 5%, and they're going to have to get there because they can't signal anything close to a pivot unless things are so bad.
Well, there's room that things may even improve, in the equity markets between now and year end. I mean, I think that's the interesting thing is that, from my climate, I don't follow Europe closely, but, I was just in London not long ago, and I can tell you that people are feeling a little bit better about the European energy situation.
The weather's
warmer. We talked about the Rishi Sunak rally.
Sure.
That's going to take pressure off the U.S. dollar exchange rate, which will breathe life into cyclical stocks like industrials, which, by the way, have been outperforming. So, you can see a potential melt up into the end of the year.
I've got the final word here. If you're going as Rishi, you need one of these.
I was about to say, skinny tie.
I've got to get
all
you
about
a slimmer
the skinny tie. I was thinking the same
I think
thing.
I have to buy the Prada shoes first.
And the Prada shoes. And I've got no idea where that suit's from either, but I'm sure I can't afford it. Neil Dutzer, Renaissance Macro. Neil, just absolutely awesome. Thank you, sir. Coming up in the next hour, looking forward to bringing you the opening bell with Jim Keenan of BlackRock, Priya Misra of TD, and Troy Gajewski of FS Investment Solutions. This is Bloomberg.
알고 보면 모두가 하나로 연결되어 있다는 거 아세요?
하나 주세요. 그래, 또 와. 어디 보자. 행사 상품
원 플러스 원입니다.
하나는 젊은이가 먹어요. 우리 손주 생각이 나서.
잘 먹겠습니다. 안녕하세요. 세상의 모든 연결이 더 행복해지도록 모두를 잇다 하나증권.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. For the first time in more than 2 decades, mortgage rates in the U.S. have gone over 7%. That's according to the Mortgage Bankers Association. Its survey found that the contract rate on a 30-year loan rose to almost 7.2% last week. That extends a string of steep increases that have really cooled the housing market. President Biden congratulated new British Prime Minister Rishi Sunak in a phone call. The two discussed the Russian invasion of Ukraine and challenges arising from China. They also talked about the unresolved issue of the Irish border after Brexit. A new report from the United Nations paints a grim picture of global warming. It says that the Earth is on track to warm by more than 2 degrees Celsius by the end of the century, despite plans to cut greenhouse emissions. The UN says the good news is that projections show emissions won't increase after 2030. South Africa has set more ambitious targets to stabilize public finances without having to raise taxes. It's also revealed the broad outline of a plan to tackle the state's power utilities' unsustainable debt. The utility, Eskom Holdings, has more than $22 billion in debt. Harley-Davidson posted third-quarter profit that beat estimates. The motorcycle maker saw sales rebound from a temporarily production shutdown. Harley was able to raise prices enough to offset higher inflation. That padded profit, even as sales in its core U.S. market declined. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I think it's very hard to see something that's going to be smooth landing in any way. That's true for the economy. That's true for the financial market in this context. That's why, we think we're on a clear path towards over-tightening of monetary policy, but it's going to be very rocky.
Jean Bovin, Investment Institute head at BlackRock, coming out with a bit of a gloomier view, although not necessarily seeing treasuries as a haven. They are perhaps a haven today. You are seeing yields lower. Kind of amazing what a round trip we've done over the past few weeks with now 10-year yields in and around 4%, 4.075% after having reached up to about 4.5%. A pretty marked shift downward, whether it can last and how much this can really give fuel to stocks. We saw a 3-day rally end today. You see the NASDAQ underperforming, down nearly 2% on the heels of some of those tech earnings. Microsoft shares down nearly 7% now ahead of the opening bell. Joining us is someone who's been bullish tactically, bearish long-term, kind of a Mike Wilson page. Perhaps he's got the same kind of crystal ball. Peter Scheer, macro strategy head at Academy Securities. Peter, I want to get your sense on what we've been seeing with earnings, whether they confirm your view that we can continue to see a rally in the short term, even though they have been somewhat disappointing.
Yeah, I think we have to make it through this earnings period. Obviously, overnight, we're not reacting well to yesterday's earnings. But as we get through this, I think the attentional focus to stock buybacks are still real. You get that quiet period. I think people are still too bearish. And for me, more importantly, this Treasury rally, I think, continues. I think we get to 370, maybe even 360 on the 10-year, and that could push equities higher. So it's a little bit short-term positive. There's a lot of technicals at work. I think longer term, this is my first real signs of my fear for a hard landing, is that people aren't going to fire employees. They're going to pull back on their services, and disruptive companies in particular have to pull back on the services, technologies they're buying, and that might be what we're seeing leaking into earnings.
Okay, there's a lot to parse through here, and I want to get to all of it. I want to start with your call on treasuries, because that's pretty noteworthy that we get back down to 3.6% on a 10-year treasury, given where we have been just recently, just days ago. What gets us there?
So one, on Friday, if you go back, there was so much lost in the news, but daily, basically, you kind of backed off a little bit. Nick from the Wall Street Journal sent a message backing off a little bit. Markets reacted very well to that. I think you're seeing geopolitical pressure placed on us by Japan in particular, but also the UK and the ECB saying, hey, we need you to stop this, currency devaluation we're going through. So I think there's a lot of reasons to expect that. And now with the quiet period, we can start looking at the data. I think we're going to see data coming in weaker. Oil's down every day. We're going to have easy comps. I think the whole inflation fear is way overdone, and it's starting to leak into the data. And with the Fed being quiet, we can respond to that.
So you think that the Fed is going to respond to what's going on With Japanese, with the yen, with the yuan over in China, with what's going on in the United Kingdom, and try to address the dollar strength?
I think some of that will come from the Treasury Department because that's really their responsibility. It's going to be subtle. It's not going to be, overt because we just can't do that. But I think they're going to start saying, hey, we already said we were going to do a lot, and this isn't a pivot. We got to our plan. It's getting time to watch and wait, right? We have done so much. We followed what we said we're going to do. So don't consider this a pivot. This is just part of our original program was to stop at some point and see how it plays out. So I think that's the messaging we're going to start seeing as soon as the Fed's allowed to talk again.
So do you think that right now, going back to your other point about cutting around the edges, basically cutting ad service, cutting other issues that you don't, that's not necessarily the core of the personnel of a company. Do you think that perhaps the big tech earnings are not as well of a bellwether type of signal for the rest of the economy as some people are making out?
Yeah, I think that's probably true, right? They're adjusting to this specific shift, right? So there's other areas of the economy that are doing well. I think you can see autos, you can see places do reasonably well. So I think this is a unique factor. It's part of this pullback. If the Fed keeps pushing on companies and then they start having to lay off, I think this follows through even worse for tech, and that gets us to the hard landing. But for now, I think we can make it through this and start bouncing back up. Because again, a lot of these companies are down anywhere from 30 to 50% year to date. So even with these weaker earnings, there's still some upside.
Okay, this is a really frustrating part about this market. And I was struggling with this with Mike Wilson, and I could tell that he was too. And I'm curious from your perspective, how do you communicate to people? Short-term technical rally, but don't worry, I'm not actually optimistic about anything and we're going to crash later on. How do you understand the pivot point in markets about when things, bad news becomes bad news? We start to understand some sort of hard landing that is divorced from the Fed's response mechanism.
That's a great question. For myself personally, I always try and think in terms of, the next 20 bips on the 10-year treasury or the next 5% on equities. And unfortunately, now that means I'm a day trader almost because it moves so quickly. So I'm trying to avoid that and really make sure that I'm explaining to my customers, okay, this is short-term tactical, this is medium-term markets, and this is what you have to be doing for your firms or your companies longer term, like exiting China, et cetera. And it's just it's a big struggle, I think, to figure this out. And you have to have conviction. You have to be small. And I think that's, again, one reason everyone's pulled back on position. So if we get any sort of rally, I think that can feed on itself a little bit easier than a sell-off can right now.
Yeah, especially because hedge funds have really pulled back on leverage and you've had people really retrench with that bearish positioning that we've been talking about for quite a while. Peter, when you talk about the hard landing going forward, it's always interesting for me to hear people's worldviews and whether we're in a structurally higher inflationary regime or, as you say, you think that the inflation story is overblown. How do we get back then to a low inflation 2% type level, especially because you're telling companies to get out of China and stop doing business there because of some of the geopolitical concerns that the generals that work for your company talk about all the time?
So I think we have to take a step back and think about the starting conditions. Where did this inflation start? It happened because people were buying two of everything, right? People were so worried about their supply chain issues, they went and bought two things. Then you looked at companies themselves, they were ordering more in their supply chains. You had all these supply chain issues. The supply chain issues are dissipating. The consumers overspent. They're slowing down. I look at autos, for example, right? You go back a year ago, every email you were getting was someone looking for your used car. Then it was like, oh, buy this used car, get a new one. Now there's new cars again. This thing has shifted rapidly. Prices are declining. People are responding to the wrong metrics of inflation, right? The Fed kept talking transitory. They got it wrong to some degree, but some of these things are going away. And look right now, all the fears for Europe, energy prices are coming down there. Oil, despite OPEC plus cuts, coming back down. There is a real problem in the economy, and that's what slows us down. And that's why I guess I'm so bearish about a hard landing. I think we've already done too much, and we've set a chain reaction in motion that is going to lead us to real problems later this winter.
So you don't think that there's a wage price spiral in any capacity?
I don't. I think you see some great headline numbers about the wages. I think companies have still been reluctant to hire. But your last guest, I think, made a great point. So tech companies are letting go, but tech is such demand that they can find jobs. But I think as these services cuts start coming through, if that's what we're really seeing, the next step is cutting your employees. And that, to me, is a real risk. If we can't get through some of the inventory hangovers and things that we have, people are just thinking about the wrong problems. They're all worried about the situation we were facing last year. And it's a very different. And if we step back, that idea of starting conditions matter. Supply chain's gone. Consumer overspending's done. It's shifted heavily towards services overspending. But I think even that starts to go away. So January could be a little bit bleak.
Just real quick here, Peter, do you see 0% Fed funds rates in the next 5 years?
Ooh, I don't think I see that. I think they're going to be very reluctant to ever pull back. I think they've also realized that QE is really a nuclear option, and we treated it like a pea shooter. So somehow we have to extricate ourselves from QE, and we'll be reluctant to use that. So I don't think we ever go back to this easy money, because behind the scenes, they probably will admit that it does blow bubbles, but we will see easier policy over time.
Peter Scheer of Academy Securities, thank you so much. And coming up, we're going to be speaking with Sam Zell, founder and chairman of Equity Group Investments, that is on Balance of Power, with David Weston. Right now in markets, you are seeing a bit of softness after disappointments in big tech. This is Bloomberg.
시린니, 이유가 뭘까요? 원인은 치아 표면의 미세 손상. 그럼 솔루션은 바로 시린매드.
채워주고 감싸주고 보호하니까.
시린은 증상, 매드는 솔루션. 시린이엔 시린매드. 부광약품.
The day-to-day volatility has been mind-boggling. Traders here are whiplashed, and I think that's true of people across the markets.
We do think we'll begin to see some moderation in inflation. It's clearly been surprising to the upside month after month.
I think investors are waiting for the other shoe to drop.
Have the markets seen their bottom? We're all talking about the risk of recession, but markets still, to me, don't have it priced in.
The market is back in charge here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures negative TK by 0.4% today. All about big tech earnings kicking off later after the close.
Big tech earnings. I know Rishi Sunak, when he's got some free time today, is going to look at his Microsoft shares, his Google shares, and say, I got to stop tonight about 8 p.m. his time and look at that performance. It starts today. We roll on to Thursday, which is one of the busiest days of the year.
Did you see HSBC coming out over in Europe out of London?
Yes,
loan loss provisions are moving in the wrong direction. Higher.
And they are a China subset. And I read every word of our report on HSBC, and you really wonder if that's what's coming down the pike. The follow-on from a China with 3% GDP.
Chinese equities yesterday got absolutely hammered, and this morning again, Lisa, renewed currency weakness for China.
How much is this going to really influence the policy? We were talking about this yesterday. This isn't going to necessarily be the
1% today. All about big tech earnings kicking off later after the close.
Big tech earnings. I know Rishi Sunak, when he's got some free time today, is going to look at his Microsoft shares, his Google shares, and say, I got to stop tonight about 8 p.m. his time and look at that performance. It starts today. We roll on to Thursday, which is one of the busiest days of the year.
Did you see HSBC coming out over in Europe out of London?
Yes,
loan loss provisions are moving in the wrong direction. Higher.
And they are a China subset. And I read every word of our report on HSBC, and you really wonder if that's what's coming down the pike. The follow-on from a China with 3% GDP.
Chinese equities yesterday got absolutely hammered, and this morning again, Lisa, renewed currency weakness for China.
How much is this going to really influence the policy? We were talking about this yesterday. This isn't going to necessarily be the check that it was on the United Kingdom, simply because Xi Jinping doesn't seem to care as much about the market response. Still, I do wonder what businesses are going to do. I mean, does HSBC continue to double down in China, or do an increasing number of companies start moving away because it just isn't necessarily economically sound?
TK, 736.40. What do you make of that? Dollar CNH right now, 736.40.
Just brought it up, and it's well outside 2 standard deviation. Let's review this. Is it fixed? Is it floating? No, the currency is managed around a band. And right now, we are definitely unmanaged on the Chinese currency. I'm going to go, John, right now to a log axis here.
In real time.
On China. In real time. You can do that in the Bloomberg terminal. Beautiful. And there's convexity in China. There's an acceleration here of yuan weakness.
Are we selling terminals today?
We're selling terminals today.
Good
That's
to know.
what we're doing.
Let's get to the price action this morning.
Mike,
good morning to you, and good morning to the sales team here at Bloomberg as well. Equity futures look like this on the S&P 500. Big tech reporting a little bit later after the close. Futures negative 0.4% on the S&P. We're down about 15 points. Yields lower by 5 or 6 basis points, 4.1837. The euro still stuck beneath parity, 98.65, negative 0.1%. And in a moment, Tom, we'll catch up with Jordan Rochester. He's looking at dollar yen potentially 160. 160 was the number in his note this morning.
Yeah, everybody recalibrating there. I thought, and Sarah Vellis later on from Deutsche Bank, it's going to be interesting here to look at that, I'm going to call it idiosyncratic story, but folded much in with Jordan, John, is Sterling, a 113.18. And as we go to the Sunak speech here in 30 minutes or so, it's a massive now what for the United Kingdom.
We'll keep an eye on that in about 25 minutes' time, 30 minutes' time. Looking at crude, 83.30 on WTI. Lisa, negative 1.5% today.
I think it's fair to say that the week starts today, right? I mean, this is a massive week, and today we start with the tech earnings as well as a number of economic data points, including some of the house pricing data, the S&P CoreLogic Case-Shiller Index coming out at 9 a.m., along with some FHFA house price data. How much do you see a rollover in house prices, and how quickly does this bleed into rents? Yesterday, John, we saw rents start to come down actually quite significantly, but it's not going to trickle into the CPI for kind of quite a while. So at what point does it matter to the Fed? At 1 p.m., we get the U.S. selling $42 billion of two-year notes. Who shows up, right? I mean, we're seeing those yields continue to climb. Can we breach that 4.5% and sell it at that level? And how many people start piling in because perhaps this is the peak, as we heard yesterday? Some are speculating. And today, the earnings after the bell include Microsoft and Alphabet. Microsoft is expected to see the slowest growth in sales going back to 2017. Alphabet, I'm arguably more interested in, John, because that's the advertising tell, right? That's the Snap other side of the story. Are we seeing advertisers start to pull back? Could that be a sign of some kind of broader trend in the economy?
Elisa, thank you. Looking for the earnings a little bit later. Getting earnings right now on UPS. Here are some of the numbers for you. Revenue in line. EPS a beat, Tom, for the third quarter. 296 versus 265 year over year. The estimate was 285. Adjusted EPS coming in at 299. Reaffirming the outlook as well, Tom. Reaffirming the full year outlook this morning.
And this is important, again, on a logistics basis, a national basis with Federal Express, is, well, Julian Emanuel has his revenue modeling right now up 8.8% revenue. That's that inflation-induced revenue growth you're seeing at corporations. That's a big number.
Looking forward to GM a little bit later, Tom. Really want to find out what the tone is of this auto market in this country. Given what's happening with interest rates right now, Tom, can you imagine going out and buying a new car? How much that's going to cost you?
Well, I think the interest rate story is profound. Enda Curran with us later has a global story on what the interest rate impact is on central banks. The interest rate impact on that car is a 3-year depreciation, maybe a 4-year depreciation. And we haven't even talked, as Lisa just alluded to a 7% mortgage. What does that do in America?
And for autos,
what's it in the United Kingdom? I don't even know.
It's the problem for autos, though, specifically. I wonder if we go from undersupply to oversupply, just like that, in a space of 12 months. That's something UBS indicated potentially just a few weeks ago.
We don't talk enough about it, but this is the David Rosenberg theory. There is a camp with Mr. Rosenberg of Toronto that you're going to see a rapid path to disinflation. We saw that not once, John, but twice, 1947 to 1953. Stochastic, up you go, inflation, gloom, down you go.
Looking forward to those numbers a little bit later this morning, and Matt Miller's going to catch up with the CEO of GM later on in this programme. We're going to catch up with Jordan Rochester now, the G10 FX strategist over at Nomura. And Jordan, I teased it a little bit earlier, a few minutes ago. Let's go there. I saw the number 160 and dollar-yen next to it in your note. Walk us through it.
Well, that wasn't my view, John. That was the view from clients. So it was this time last week on Monday, I was sat next to you guys in that table. So we met clients around the New York area and Connecticut as well. And we're looking for 155 at Nomura in dollar yen. I think after this Bank of Japan intervention, what you've clearly seen over the past, let's say, 12 hours is extreme lack of volatility now. We're in a 40 pip range, where the previous 2 weeks we've been on a big vol higher in terms of that march up to nearly 152, then that near 6 yen swing down on that intervention on Friday, done during New York hours when liquidity was very thin, and just after that Wall Street Journal article talking about the Fed becoming perhaps a bit more dovish in terms of when they will slow down rate hikes. So I think we've had some temporary setbacks for that long dollar yen trade, but the fundamentals are still pretty clear, John, that the US interest rates are rising, the Japanese are not. That is your long dollar yen carry trade. But for me, on the fundamental side, from the trade side, the dollar yen is likely to keep rising from Japanese importers this winter, going out and buying LNG, buying coal, buying oil. Even though energy prices are cooling down, seasonally as we get into winter, those purchases of LNG should accelerate, pushing dollar yen higher towards 155.
Jordan, I've had the honor of a formal tea at the Bank of Japan with all the pomp and circumstance. It's different than the Fed folks. At the Fed, you're over at Starbucks and you're paying for it. That's how they do it in America. Jordan, give us an insight on the debate at the Bank of Japan. Is it Kuroda-san only, or is there actually a debate there like there is at BOE or at Fed?
There's definitely a debate. Kuroda's, of course, representing the rest of the Bank of Japan when he speaks on their behalf. But he is also the guy in charge. And when we get to March and April, the question for clients is, Kuroda's term comes to an end, who will be the next to lead the Bank of Japan? And will that lead to policy change? And if you look at rates markets would tell you, yes, we think that something will change, at least on the 10-year part of the curve. Will the bands be wider on the yield curve control? Will they give it up altogether on the 10-year, move it to the 5? If you look at the Japanese JGB curve, even tenors below 10 years are trading above the sort of levels set by the 10-year yield curve control. So the markets are challenging the Bank of Japan as we speak. They're holding on to their 10-year, but the rest of the curve is pricing a change in policy to come.
And is the message so far for this year, Jordan, that currency vigilantes will win? That we're seeing that when it comes perhaps eventually to Japan, although it hasn't happened yet, and then it has come already to Great Britain, where you see a little bit more upside, at least versus where you used to with the pound?
Indeed. Well, for the yen, it used to be everyone's risk-off hedge of choice. The only clients I've met who are long the yen are using it in their portfolio as their potential risk-off in case we get dollar weakness. And as you've seen over this past year, that just hasn't worked. The fundamentals really did change for the yen compared to the global financial crash. The carry trade still drives the pair. It does track US yields quite well. But on the trade side, now of a trade deficit, it's not your risk-off currency of choice when this is a risk-off driven by energy prices. And then for the UK, I think the UK is the canary in the coal mine for everybody around the world, even for the US, for Janet Yellen, for the Fed. You don't want to do a UK, seems to be the conclusion from talking to foreign policymakers. When it comes to budgetary constraints, don't push it. And also when it comes to interest rates, don't suddenly get dovish and allow inflation to run hot. I know we were just talking about the previous section, used car prices. I think they will continue to fall, perhaps quite aggressively. But labour markets are really tight. And the risk now is the second round effects for services. And that's a lot harder to tame that inflation dragon. So I think for the time being, the Fed's going to do 75. Then they'll do 75 again, then slow down into the new year. That Wall Street Journal talking about the idea of perhaps slowing down to 50s come December. That's the debate for the dollar right now. That's why euro and cable have become quite boring to trade, just that everyone's waiting for this Fed meeting next week. Yep. But I think the message will be, no, we're going ahead, we're still staying hawkish, and the dollar will rally into Christmas.
And then waiting for the CPI print the week after that. Jordan, awesome to catch up, buddy, as always. Jordan Rochester there of Nomura. Jordan was talking about dollar-yen there and the intervention from the Bank of Japan. The team here at Bloomberg broke down the data. 4/5 of the weakness in the Japanese currency this year has come outside of Japanese trading hours. And that's why the intervention from the BOJ, Tom, is coming, guess what? Outside of Japanese trading hours.
It's just completely clumsy, and it comes back to core theory. And I guess some people can support their core theory, but most people are saying, you got to be kidding me. One thing Jordan mentioned there that's absolutely critical is everyone's looking at liquidity within the system, using United Kingdom as the example, and the FRA OIS, much akin to LIBOR OIS of another time in place, is spiking up and is right at the moving average from the pandemic level.
Jordan said FX has got boring. Ramo, boring?
No, I don't think that anyone's going to
accuse it of being boring. Dollar. Maybe it's boring now relative to what we've seen over the last few months, in fact, the whole of this year. Coming up, Jean Bavin of BlackRock. Looking forward to catching up with him in the next hour. A comment from him on the midterms and the importance of it in about an hour from now. Looking forward to that conversation. Live from New York City this morning. Good morning. This is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Lisa Mateo. In the UK, Rishi Sunak spent the summer predicting that Liz Truss would trash the UK with her plans if she became Prime Minister. Well, now his prize for being right is a chance to fix the damage Truss caused. Sunak will meet King Charles III today to formally replace Truss. It's a rapid turnaround for Sunak, who lost to Truss in the race for the job. Bloomberg has learned that Adidas plans to end its partnership with Kanye West. In recent weeks, the rapper and designer has made controversial statements, including anti-Semitic posts on social media. That's turned his Yeezy line into a lightning rod for criticism. It's estimated the brand has accounted for up to 8% of Adidas' sales. The U.S. won't change its stance toward China as a result of Xi Jinping seizing more power. Advisors are still trying to set up a meeting between President Biden and the Chinese leader. At the conclusion of the Communist Party Congress last week, Xi placed allies in top posts and paved the way for a third five-year term. NATO is increasingly concerned that Russia's desperation over battlefield failures in Ukraine may lead to the Kremlin to escalate the war. Now, that could involve a massive attack on a target like a dam or even a weapon of mass destruction. NATO says that for now, there's no sign Moscow is actually preparing for such an attack. An instant messaging service, WhatsApp, says it's fixed an issue that's caused a widespread outage. Tens of thousands of users reported disruptions, including not being able to send messages or connect to the server. WhatsApp is owned by Meta Platforms. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
매력적인 디자인은 기본값. 포기할 수 없는 안정은 절대값. 없어선 안 될 편의성은 고정값. 필요한 모든 걸 다 담고도 충분히 합리적인 결과값. 캐스퍼, The Essential 탄생. 캐스퍼 온라인에서.
I can't think of a more consequential election that I've been involved in, and we've been involved in. You know, whether we maintain control of the Senate and the House is a big deal. And so far, we're running against the tide, and we're beating the tide.
2 weeks away from the midterms, the President of the United States. Live from New York City, here's the price action this morning, and good morning to you. Your equity market slightly negative on the S&P 500, coming off the back of a big day of gains on the S&P. A day of gains of more than 1 full percentage point to kick off the trading week. We're down about 0.5% this Tuesday morning. Yields are lower by 6 basis points, 417.95 on a 10-year. Euro-dollar negative 0.1%, 98.67. And before we get deep into US politics, UK politics, in about 15 minutes from now, Tom, we should hear from the new Minister, Rishi Sunak.
The play here is he won't be surrounded by supporters of that. It will be solitary and alone. What's your take on this moment, John?
On this particular moment,
I
think
it's
going to be
3 prime ministers and 3 cups of coffee.
Very difficult to implement austerity in a cost of living crisis in places around the world.
Interesting. Well, we'll talk a lot about this. Lizzie Burden, I know. Lizzie's at 10 Downing Street.
I believe we're catching up with Lizzie in about 10 minutes, yeah.
Very good. Right now, we will catch up with Anne-Marie Horton in Washington. We are 2 weeks away. It is Tuesday. 2 weeks away from an election. Anne-Marie, I got 18 ways to go here as the political elites go back and forth. And what I sense out here is a measure of apathy. Give us your summary of what turnout looks like and the character of apathy in both parties.
We look at a lot of the polls, and you could see that more than 50%, and a lot of them say that they intend to go out to vote. They want to go out to vote. When you think about apathy, there does seem to be a sense from voters that there is this frustration when it comes to the economy right now, and that continues to show up in every single poll across the board, whether it's a question on the economy or inflation. Those are the top priorities. The issue is there's not a lot the government can do to fix that right away, right? The Democrats constantly say this is a global issue. That is true. They try to back away from some of the legislative measures they took that maybe the Republicans say added to inflation. But overall, the world is dealing with inflation. This is something that is difficult for the current administration to try to defend, even though they are doing that. But when you think of apathy, that's where it's coming from. How can the government impact my life? And this is what I'm struggling with. And across the board, it's gas prices, it's grocery bills, and it's paying for housing and rent.
Do the candidates and the political experts, do they trust the polls?
It's a great question. A lot of people say you cannot trust the polls. President Biden yesterday, speaking at the DNC headquarters, says you cannot trust the polls because the polls have been wrong before. You were just talking about Rishi Sunak. The polls were wrong in the United Kingdom during Brexit. The polls have been wrong here in the United States. But at the moment, what you are seeing, and what is typical, especially for midterm elections, is that the polls are they're getting closer and they're getting more narrow as we head into, the final 14 days. We should also note that a lot of people have already even voted, right? There's been early voting for weeks in this country.
It's been really difficult to balance the domestic and the international, Anne-Marie, but the international has really hung over everything when it comes to the domestic politics. What do you make of the fact that certain Democrats are pressuring President Biden to speak with Vladimir Putin at this tenuous moment 2 weeks ahead of the election?
It's an interesting moment because we also heard similar rhetoric regarding Ukraine from the Republicans. Last week, Kevin McCarthy, the Republican leader of the House, likely will be the next Speaker of the House if there is going to be a red wave in terms of the House, talking about there's not going to be a blank check for Ukraine, that there's not just going to be this constant funding for Ukraine while people are dealing with kitchen table issues every day and potentially going into a recession. Now you have progressives saying maybe we should start negotiating with Russia to make sure that there is a diplomatic path forward for Ukraine. The White House is saying there is not going to be any negotiations with Russia unless that is what Ukraine wants. They constantly say nothing about Ukraine without Ukraine. We should note that the progressives did come out and say we are not against what the Biden administration is doing, but they do want this path forward in terms of diplomacy. And that's as a number of issues are mounting on. What I'm looking forward to is in December, when there potentially needs to be more spending, whether it's military, financial, humanitarian aid, that the Biden administration is likely going to push for Ukraine. Is there going to be more pushback, not just from these Republicans, but also within their own party?
How much of this is also being driven just by the inflationary outlook and what's going to happen with gas prices heading into the winter?
It's a great question because, Lisa, what's coming up December 5th? That's when those EU sanctions are going to bite, which means it's going to be incredibly challenging. Even if you want to be able to accept Russian crude on the global oil market, you can't, because maybe the shipper or the insurance company comes from a European, which are dominate in this sector, whether it's a Cypriot or a Greek ship. It's going to be challenging to get this crude around, which is why you saw at the last G7 they discussed a price cap. That at this moment is a very contentious issue, because if they cannot get this price cap aboard and allow this Russian crude to flow, that means that this Russian crude is likely going to only stay in Russia, and there could potentially be shut-ins, and that is just going to elevate this price at a very difficult time. Jonathan said it yesterday, though. What they have going for them right now in Europe and even in the United States is the fact that it's an incredibly warm out, and potentially it's going to be a warm winter.
MH, thank you, down in DC. Let's pick it up right there. Hardly being talked about. Gas prices in Europe are down by more than 70% from the August peak. TK down by more than 70%, and today down by a couple of tenths of 1%, but to see them back at 99.
Is there why?
Back at 99.
They
it's
get
warmer.
supply.
It's warmer and they've got
It's the
supply.
weather.
It's the weather and they've got the supply. They've got the storage up, to be specific. So they met their storage targets ahead of schedule. We broke those headlines along the way over the last couple of months. And then we started to hit some warmer weather as the cooler period started to click in, Tom.
It's October.
It's been a whole lot warmer.
We barely started the
Bear in
winter.
mind, Tom, that it can get pretty cold
Yeah,
in parts of Europe, even in October. So that's the good news so far, and we'll see if that continues. But certainly that's contributed to a lower gas price in Europe over the last month or so.
Again, we mentioned Rosenberg earlier, and there's a whole school of thought here gaming out a sustained inflation, whatever the level is, whatever the country. And there's a lot of people saying the microeconomics of the system clicks in, and down you come to some form of disinflation that can surprise.
Certainly, Tom, about a month ago, I think we were all tremendously concerned about industry getting shut down, rolling shutdowns throughout Europe, rolling blackouts throughout Europe. And Lisa, now maybe you can park that for a moment. I've got no idea if that starts to re-emerge as a conversation in the weeks to come. But still, we need to have a conversation about next winter and the winter after that, and whether they can repeat the trick of getting that storage up to capacity where they want it to be in about 12 months from now.
So right now, one thing that I've been reading about is how there's almost a glut of natural gas in some of these storage units. So at what point do we start talking about how much of this has been priced into euro area valuations that have been completely beaten up?
Gas prices right now, 98 handle in the Netherlands, Tom. That European benchmark.
I mean, it's impressive. GE, the earnings aren't that good. We'll talk about that.
Hi there, I'm Pamela Ambler. Welcome to I See Your Trade. In this episode, could ESG be the biggest investment opportunity since the internet? I'll be joined by our guest, Denise O'Dowro, who's one of the world's leading ESG and sustainable finance experts.
The biggest need is innovation in green energy. We need to change the way that we power our needs in today's society.
I See Your Trade is brought to you by IC Markets, a leading high-performance trading provider. Trade up to IC Markets.
Three hours away from the opening bell, live from New York. Good morning to you. Your Tuesday morning price action looks a little something like this on the S&P 500. We're negative a third of 1% after some big gains to kick off the trading week yesterday on the S&P. On the Nasdaq, we're down about 0.2%. This is how the bond market's shaping up. On Friday, we had a little look at 460 on a 2-year. This Tuesday morning, we're down another 4 basis points to 446.64. Let's stay on the front end and go over to the other side of the pond, to the UK. The gilt, the 2-year. The 2-year bond yield in the UK yesterday, down 37 basis
biggest
points.
Ever?
Biggest move in 30 years, I'm told, Tom.
Yeah, biggest since Wellington.
Big move lower, down another 4 basis points this morning. Rishi Sunak, the new Prime Minister, about to speak, Tom, in about 4 minutes' time. The attention then shifts from him, really, to the budget and then over to the Bank of England in about a week from now.
Your thoughts on this, and John, I'm going to go to what we've done with Draghi at Davos and all. Is this guy a technocrat like Draghi, or is there something different here in the political equation?
I think it would be wrong to call him a technocrat at this point, Tom. What's interesting to me, actually, at this point is whether the Chancellor is Jeremy Hunt and whether we actually get the budget in the way we thought we were going to get the budget at the end of this month and what that looks like. Do they go even further when it comes to spending cuts?
Further austerity.
Possibly,
We're going to go to Lizzie here, but John, one final question. Where does Mr. Gove fit into this? Who is Michael Gove, and where does he fit into the formation?
It's probably a question for Lizzie Burden and Rishi Sunak himself, Tom.
You're reading this 24/7.
I'm looking at GM right now, coming in with EPS at 225 and the estimate at 189.
Yeah, pretty
Third
good.
quarter
GE was
adjusted
going the
EPS,
other
yeah.
way. But yeah, Mari Barra will join us later. Matthew Miller will be speaking to her. Let's do this right now. We need to go to 10 Downing Street. Lizzie Burden is there for this historic moment. There have been many moments. Lizzie, what will be the distinction today as he walks from the door to the podium versus when an optimistic Liz Truss walked to the podium weeks ago? What's the key distinction this morning?
To me, the key distinction between Rishi Sunak and Liz Truss is that he is a pragmatist, and he has proved that throughout the pandemic. He was actually accused of being a socialist, so generous were his pandemic support programmes like the furlough scheme, and indeed he raised taxes to pay for healthcare, even though fundamentally he says that he's a tax cutter. And European leaders are going to be hoping that that pragmatism transposes to Brexit as well, but Rishi Sunak's really going to have to keep that in check on both taxes and Brexit if he wants to keep the Tory right on his side. And they're, along with the other MPs who've put him in power, not the party membership, not the public. And so that coalition is going to be fragile and crucial.
Lizzie, I know a lot of people on this side of the Atlantic that just want to stop talking about the UK and British politics. Let's get through the next couple of weeks. Do we get a budget at the end of the month? And when the Bank of England meets, will they have a deeper understanding of how much spending cuts we'll actually get from this Prime Minister?
보는 눈, 그건 하루아침에 생기지 않아. 수만 번의 시뮬레이션, 수만 번의 좌절 끝에 마침내 얻게 되는 거지. Keep trying, keep it going. 그럼 결국엔 idol, icon, identity. Why not? 네 인생 greatest of all time. 멋지게. 너 보는 눈 있잖아. 고랑모.
Well, we've already heard from various Bank of England deputy governors in recent days, and they say that the Bank of England and the Treasury have already been talking, even though Rishi Sunak's spokesman will not yet confirm that the Chancellor is going to be Jeremy Hunt, although it looks increasingly likely, or whether the date is going to be October the 31st. But Rishi Sunak, more than any Prime Minister, would be aware of the effect of surprising the markets. And so you can probably expect that he's going to confirm who his Chancellor will be and what the date of that budget will be later this afternoon, along with the rest of the Cabinet.
Lizzie, how difficult is it for Rishi Sunak to issue cuts with respect to spending, given the fact that he is very wealthy, that he doesn't necessarily represent the mainstream in any kind of populist way?
I struggled to hear you, Lisa, there, but in terms of the difficult job that lies ahead for Rishi Sunak, even though he's had 2 runs at being Prime Minister, the characterisation in the national press today is that the easy part's over. Now the difficult decisions begin, but Labour leader Keir Starmer's already characterising it as austerity 2.0. It's very, very difficult politically. But the good news for Rishi Sunak is that he's always said that it was going to be difficult, that he's going to be honest with the public. In fact, he resisted the temptation to say, "I told you so," when Trustonomics was imploding. But he has laid the foundations to deliver these difficult decisions. The thing is, he's going to have a cabinet full of ministers who are going to want to bring back money to spend on their pet projects. And when he's got to hold this coalition together, he's not going to want to disappoint anyone.
Little test for the Prime Minister now, Tom. The lectern's out in front of number 10 Downing Street. It's his first appearance as Prime Minister to address the public in the UK. Let's see if he's on time.
Well, he's got to be.
Is he going to be one of those Prime Ministers that's late all the time?
Well, that would be a Bill Clinton. We call that doing a Bill Clinton, and somehow, I don't know here, but
President Biden's in that camp too, TK.
Yeah, my head is spinning on this, John. Do you have a sense here, as we await Rishi Sunak, that this is finally stability, or is it going to be in the next 2-3 weeks the same chaos Trussian-like?
There is a hope that this man is going to be the face of stability. And Tom, I mentioned this, and I might sound snarky, but I think there's a hope for a lot of people in this market that after today, TK, we can stop talking about the UK. And what does he have to do? To Lizzie's point, we still need to work out who the Chancellor's going to be. We assume it's going to be Jeremy Hunt. If that's the case, okay. Then we need a deeper understanding of what the fiscal approach is going to be. And then it's on to the Bank of England. And you hope from there, Tom, we just get back to where we were and we can move on from all of this and move on from it quickly. The fact of the matter is, though, the British people, TK, won't move on from it quickly because this cost of living crisis that we're talking about worldwide at the moment is dominating the United Kingdom as well. Interest rates are going to have to go higher. Mortgage costs are getting more expensive. And the cost of living, Tom, is going in the wrong direction.
Real rates are moving up there, and as we heard from Jordan Rochester, is the United Kingdom just out front of many other nations in the struggle. On Bloomberg Radio, we welcome you, a shot of 10 Downing Street with a different podium than the Truss podium, more stark, more corporate, I will editorialize. And off on the port side, we're on the starboard side, the right side of the door, as Mr. Sunak will come out, is Lawrence the cat with his back to the door because there's a rumor, will Mr. Sunak live at 10 Downing Street when you're that fancy?
Oh, there we go.
That was in the zeitgeist.
How many Prime Ministers has that cat outlived, Tom, in the last few years? Lizzie, can I just come to you quickly before the Prime Minister walks out? What does the Governor of the Bank of England want to hear today?
Yes, we talked about that. Don't worry, Matt.
He wants the stability he's been promised. He wants to know who the Chancellor is and when this budget's going to be. And if he can confirm that it's Jeremy Hunt and it's October the 31st as expected, the markets will be happy and the Governor will be happy. Ultimately, he wants cooperation between the economic institutions of the UK. And we heard from the Chief Economist, Hugh Pill, earlier, taking a thinly veiled swipe at the Truss administration for really undermining the Office for Budget Responsibility and the Bank of England. You would hope that that's going to end now with the Sunak administration.
At 37 minutes after the hour, futures at -12, and the VIX under 30 is of note here. Earnings coming out. We'll get to that in a moment. Lizzie, I want to sneak this in if I can, and very importantly, John will hopefully go to an on-time Prime Minister here. Lizzie, will he tour the country? Will he, like King Charles after the funeral, will he go to Wales? Will he go to those cities that were Labour and became Conservative? Will he go to Scotland? What does a new PM do?
I'm sure he will, and his constituency, don't forget, is up north in Yorkshire. I think he might be the first Prime Minister from a Yorkshire constituency, correct me if I'm wrong. He obviously took over, you'll know this, Tom, from William Hague. But he's going to need to strengthen the union because this chaos in the Tory party is only given Nicola Sturgeon, the leader of the Scottish National Party, confidence, and he's also going to have to charm the red wall seats that put Boris Johnson into office with such a landslide. At the moment, it looks like the Tories would be wiped off the electoral map when it comes to a general election. So his message has been unite or die. He's going to have to unite the country as well as the party.
Unspoken, John, is he's a lad. He's 40-some years old. He's the youngest prime minister from 1812.
It's an impressive stat, Tom.
Way back. He's
very close
I don't think
to...
we've talked enough. He's a kid.
I think only a few years younger than Tony Blair was when he became Prime
Okay,
Minister, though.
thank you. But, you know, you look at the gerontocracy that is American politics. In 42, it's like in Finland,
Yes,
in Estonia. This is...
It could be Speaker Pelosi's child. I'm with you. Is that
Or
where you're going with
grandchild,
this?
is that where we're going?
You went there, I didn't. Lizzie, we've talked a lot about this being a parliamentary democracy, that the leader of the Conservative Party needs to be able to govern the party within Parliament. Lizzie, let's talk about the party membership of the Conservatives. Is this their guy?
No, but we wouldn't know, would we? Because it never got put to them. I'm sure many of the membership are annoyed about that, but it could have ended up being so divisive. Rishi Sunak didn't have to go to the membership, but I don't think it's wise to say that he would have lost to Penny Mordaunt, because perhaps the membership would have had buyer's remorse after putting Truss into number 10. But I'm sure that the party MPs are grateful that we didn't have to go through the drama, the psychodrama of a leadership election put out to the membership yet again. Because this is, I mean, I've just been stood here 7 weeks ago. You'll forgive me if I've got a bit of deja vu.
It's unbelievable, Tom, that we've been doing this the way we have. I've said a few times, we've got a system to deal with it. This is the system to deal with it. I do wonder if there's certain aspects of the policies announced by Jeremy Hunt, the Chancellor, who we expect to be the Chancellor in the weeks and months to come, Tom, certain aspects that he might have to revisit. The number one that I'm thinking of is the idea that you only offer support to offset the energy pain through to April of next year. I just wonder, TK, whether that's something they have to revisit pretty early on if the crisis over energy supplies continues.
And it's this word that's propped up, I'll say Sunday, maybe Saturday, but austerity and the new definition of austerity. And the fundamental thing, John, as you mentioned earlier, maybe Lisa, you mentioned it, it is austerity within a higher nominal rate regime. People at home, they don't care about fancy bow tie real rate stuff. They're looking at higher nominal rates across everything they do.
The former government, the former leader, to be specific, Liz Truss, tried to do something different, Tom, and it failed. Markets weeded it out very, very quickly. And I just wonder, Lizzie, what the options are available for any government right now facing down a cost of living crisis, high inflation in places like the United Kingdom, what they can actually do. How much fiscal space is there to help out the people of countries like the United Kingdom? I believe we've lost Lizzie Burden outside number 10 Downing Street.
Okay, let's go to Lawrence Sakat.
You think Larry's got something to say on that?
I'm sure he does. Well, she said it's deja vu for him. Can you imagine the vujade the cat has right now?
Honestly, seen this one a few times. We all have. We are waiting for the British Prime Minister Rishi Sunak. When he walks out of that door, he will do so as the leader of the Conservative Party and of the leader of the United Kingdom. When those comments begin, we'll bring those comments to you. TK, we also need to talk about the earnings that are coming out. And I will say, Adidas is something I want to talk about briefly. Adidas. They have been silent for weeks on the relationship with Kanye West. And finally this morning, they come out and tell us they are terminating the partnership with Kanye West after the anti-Semitic comments from him over the last couple of weeks. Lisa, many people incredibly disappointed it's taken this company this long to make this comment.
Wasn't he responsible for about 8% of their sales or something incredible?
Like that, yeah.
And they're saying that they're going to take a write down. And the immediate effect is $246.5 million hit to net income in the current fiscal year. You're right. It took them a long time because he's pivotal to their sales. At what point does this become, though, a deal breaker given some of the recent shenanigans?
Isn't that disappointing, though, for companies that preach all of this stuff about diversity and inclusion, that you get comments like that and they go silent for weeks because he's key to their sales? Isn't that absolutely ridiculous? Think about how many times companies have had to distance themselves from certain individuals because they've done certain things, whether it's drugs, steroids, performance-enhancing drugs. They've had to step away, and then you get anti-Semitic comments by someone key to your company and you say nothing for weeks about it?
Okay, just to be completely transparent, this was a discussion at the dinner table because there were certain members of the family who really like Kanye West's music. And can they keep listening to it? And they had this whole debate trying to rationalize it. And we just said, you know what? You either have a credo and you have some sort of ethic that you follow or you don't. And that's the bottom line.
That stock is down by about 4% in the pre-market. Tom, I wanted to talk about GM as well. General Motors, third quarter adjusted EPS 225, the estimate 189. Revenue just a little bit lighter. Nothing overly concerning in this going into a conversation, an interview, Tom, with the leader of GM a little bit later in the next hour and 15 minutes or so. She'll be sitting down with Matt Miller, I believe.
It's a beast of its own, and I'm going to give a major shout out to Ite McCauley over at Citigroup, who I think was way out front on this. The absolute mediocrity of GM and then the surge that we saw up through the pandemic, and frankly, a rollover to revisit the mediocrity of 2018. The 10-year annual return that Mari Barra has had to be challenged by is 5.06%. 5% a year shareholder return. Can you rationalize that given an auto company? Granted, pandemic, granted, national issues, granted, technology issues, and the rest. But you just wonder when they get, is it safe to say they get Germanic, where they start developing free cash flow, like some of the European companies?
Is that Germanic?
Yeah, I mean, it's like Mercedes or BMW and the rest. I don't know, but there's always a spin here. There's always something new. They're mentioning electric vehicles today. They're going to increase production of that. Okay, great. Where's the shareholder return? That's what, I'm looking for it at 5% per year.
You want the new excuse right now, 3M. 3M, the company sees full-year adjusted EPS at $10.10 to $10.35. Previously, they had seen $10.30 to $10.80. What are they blaming? Drum roll, the uncertain macro environment, and Bramo, the US dollar. There we go.
That's going to be the catch-all. But at some point, there is some truth to this, right? I mean, the appreciation's been pretty dramatic. And how much are international companies from the U.S. really going to suffer as a result? But this is the second downgrade to its outlook so far this year for 3M. How many of these multinationals have to do that before there's some sort of bigger sense? And how much really visibility do we have about how long this is going to continue for, and really how much this has to do with the dollar? I mean, I can tell you're somewhat skeptical, John, about whether this is an excuse for something else. Drum roll. What could it possibly be?
I'm just saying I'm not surprised. Okay, that's all I'm saying. I'm not surprised. We'll keep an eye on the earnings for you. We understand the Prime Minister's still not arrived at number 10 Downing Street. When he gets there and we have that address, we'll bring that to you. TK, the Prime Minister running late after an audience with the King a little bit earlier this morning.
This is a new king. And, I'm not privy to the short meetings of an ancient queen, but you wonder if this is a new style of King Charles, where there is a substantial conversation. I don't know.
I believe we're following the car now up the mall, Tom, from Buckingham Palace.
No, we're not doing an O.J.
You don't want to do this?
Let's not
you don't want to do this?
No,
no, it's not a car chase.
I feel like I'm back in London.
This is not acceptable. I really don't want to do this.
TK, you want to do this?
Where's Anna Edwards to help me out here?
I'll happily do this with you.
Who's going to pick him up at the end?
It's within the autumnal glow, John, of the leaves.
In just a moment, Lisa, they'll go past Horse Guards Parade.
I can't handle this.
Onto Westminster.
There's a ceremony to
over to number 10 Downing Street.
You trying to excuse this, Tom?
I've been living for this moment, Lisa, for 20 years.
Have you?
Everything has been building up to this, to follow the car from the palace to number 10.
Let's review. How did this guy, I mean, I know he married into a lot of money in that, but how did he make his money? Was he a classic investment banker?
Bit of Goldman, that kind of background, TK. You know. Made his own money.
But he wasn't like chief economist. Let's be clear. He was a deal maker.
Well, but this is the reason why it's going to be difficult for him to make some severe cuts to spending at a time of austerity, given his own largesse. I'm just wondering how that's going to play into this.
But we've had huge, filthy rich people back centuries that have run things. I mean, is it uncommon to have somebody? I mean, granted, there's loaded and there's levels of loaded, but is it a so what that he's that wealthy? And his family's that wealthy.
Looks like they're just going past Trafalgar Square, Tom.
What do you want him to do? Stop at Greg's? And
I thought we weren't doing this.
Pick up something.
How about
on the
this?
way.
When the Prime Minister actually arrives at number 10 Downing Street, I'll bring those comments to you, TK. You want to carry on following the car?
Oh,
I think we're done following the car.
I don't think we have a choice. Maybe there's some views of the buses are stopping, and of course here they promenade back to 10 Downing Street where Lizzie Burden is. I want to get back to earnings and to say the tech earnings today, and I think, Lisa, you mentioned this in your brief. Google is the real first look at the future of digital advertising, which is a growing part of Amazon's business. And of course, there's others out there. And my problem is we conflate Google in with Snap, we conflate Google in with Facebook, and I think that's off the mark.
And then get a little look at Microsoft after the close as well, Tom.
Very important.
2 big names. Then on to Thursday. Keep talking about Thursday. Thursday's huge. If you want to talk about tech, did you see the tech names in China yesterday? Absolutely hammered. Alibaba, Baidu, JD. At one point yesterday, were all down about 20%. Hammered.
I did a fancy chart of Alibaba, and the plunged is the right word, John, but back to a long-term support line of where they've been for years. Did they go through to a crisis low? No, but they're certainly back to a support that speaks ill of the equity markets and the trust in the new regime.
Let's touch base with Enda Curran on some of this, the Bloomberg Chief Asia economic correspondent. Enda, we saw the events over the weekend. We saw the fallout in this market. And let me tell you, in the FX market, Enda, it continues.
Yeah, it does continue, at least with the currency, say. You can point to fundamentals there, John. The sell-off in the yuan was delayed. It's now clear that the authorities are allowing it to weaken. We're seeing it go back to levels both onshore and onshore that we haven't seen in some cases at all, in fact. Now, that does, of course, reflect a strong US dollar, but it does reflect what's going on in China. Sentiment is very negative and turning even more negative post-Congress. There's no sign of a pivot on COVID-0, no sign of a pivot on the real estate story either. So that's what's happening. The equity story is a bit more
Enda, I've got to jump in. The Prime
yesterday
Minister of the United Kingdom, Rishi Sunak, addressing the British people. Let's take a listen.
I've just been to Buckingham Palace and accepted His Majesty the King's invitation to form a government in his name. It is only right to explain why I'm standing here as your new Prime Minister. Right now, our country is facing a profound economic crisis. The aftermath of COVID still lingers. Putin's war in Ukraine has destabilized energy markets and supply chains the world over. I want to pay tribute to my predecessor, Liz Truss. She was not wrong to want to improve growth in this country. It is a noble aim. And I admired her restlessness to create change. But some mistakes were made. Not born of ill will or bad intentions. Quite the opposite, in fact. But mistakes nonetheless. And I have been elected as leader of my party and your Prime Minister, in part, to fix them. And that work begins immediately. I will place economic stability and confidence at the heart of this government's agenda. This will mean difficult decisions to come. But you saw me during COVID doing everything I could to protect people and businesses with schemes like furlough. There are always limits, more so now than ever. But I promise you this, I will bring that same compassion to the challenges we face today. The government I lead will not leave the next generation, your children and grandchildren, with a debt to settle that we were too weak to pay ourselves. I will unite our country, not with words, but with action. I will work day in and day out to deliver for you. This government will have integrity, professionalism, and accountability at every level. Trust is earned. and I will earn yours. I will always be grateful to Boris Johnson for his incredible
신한투자증권 싱그러운 에너지 만끽하기 먹고 싶은 것 마음껏 먹기 기분 좋은 땀 흘리기 반신욕으로 오늘의 피로 날리기 midnight 부탁해 잘 자고 잘 쉬기 어떤 곳에서도 편리한 공간을 완성해주는 나만의 온 세상 온 세상으로 갑니다.
We're probably going to see persistent inflation and that these yields are not all overdone.
The real worry is not only about this winter shortages, but also next winter shortages.
We have an almost abnormal obsession with all things inflation. For the most part, what we're seeing is the consumer's okay.
People continue to have a pretty high cash coffer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It's a Friday on radio, on television. We continue today, a special surveillance. Maybe we'll do normal hours today, not like we did yesterday. Thank you all for your comments on our coverage of the resignation of the Prime Minister yesterday. Today, we don't care. Lisa, it's the bond market. Let's reset. It is unreal.
And they are connected. The bond vigilantes are taking over. They are coming out in force. We thought that perhaps we'd seen peak hawkishness, perhaps we'd seen peak yields. That was not the case. Yields around the world, whether the U.S. or Germany, surging to multi-decade highs, at least according to what we're seeing in some places, or a decade highs. And how much does this reset expectations and valuations?
Let's reset with Garfield Reynolds of Bloomberg News. He goes back to 1984, and you've led on this, Lisa. It's not about the level of where yields are and that. It's been the persistency of the lift. This distraction, that distraction, the midterms coming up. Forget about it. The persistency of the yield lift is the story of this October.
Well said. And what we're seeing is the longest streak of consecutive weekly increases in yield, declines in price for the 10-year Treasury. How much does this reset the understanding of where equity valuations are? We were talking about resilience in the face of earnings. How much does that change simply because the yield equation doesn't give them that freedom?
And there's this talk of Powell and Volcker. We're going to have Steve Major with us with HSBC in the 8 o'clock hour. That's must listen for Global Wall Street. But Lisa, what's so important here is with the 10-year yield, 12 weeks higher yields back to 1984, that sort of edge of that historic Volcker moment of about 81, 82.
And raises issues about whether Larry Summers, whether Bill Dudley, whether they were right. Whether the yields can go that much higher than many people ever thought was possible because the markets haven't broken, because we have seen inflation continue to surprise to the upside, and because of the global nature of a sell-off that has a persistency we haven't seen in an entire generation.
My level for you house hunting this weekend, if you're done with your leaf peeping,
let's
go look at a house.
Oh, thanks.
It's marked down. 7.32% is my bank rate 30-year mortgage. What level do you use, Lisa, as your benchmark yield as we go into the weekend?
the Mortgage Association, right, having that as one. I'm just looking actually to take a page out of your book, leaf peeping notwithstanding, real yields. To me, are really speaking volumes.
Really
the fact
stunning.
that 1.76% on the 10-year, this is adjusted for the market expectations for 10-year inflation. How much are we looking at something that is unsustainable? I remember speaking with a couple of investors who thought that 1.5% was the line in the sand. Well, we've blown through that and keep climbing.
What we're also doing, of course, and thank you to Anna Edwards on the green. I believe we're going to go there in this hour. This is the reality. There are a selected group looking at a selected airline which has a selected former prime minister on it, supposedly landing at LHR right now. Now, I don't want to say that's happening, but that's the speculation.
Are you talking about Boris Johnson?
It's a selected
yeah, exactly.
It's a previous prime minister who resigned, which I think is it 8 prime ministers?
Okay.
Yeah.
So we
George
have
Canning is not on that airplane.
George Canning, for those who don't know, died in the early 1800s and was the second shortest serving prime minister. Otherwise, this is really an anomaly. How much are we looking, though, at, and I keep going back to this, yes, this is UK specific. Yes, this is turmoil. You could say this is spurred in part by Brexit. You could say this is spurred by the energy crisis and also the inflationary environment. How much is this an example of what we can expect of the bond market taking control, markets really in the driver's seat at a time when governments are not used to not having their backs? And you have, meanwhile, central banks that are not going to finance the deficits by simply buying all of the debt issued. This is a game changer. How much does this change the political environment globally?
Let's do a data check, do a brief, and get to a true foreign exchange expert. I'm going to talk with the collapse of sterling. It's down one big figure, 111.21. A 110 prints a big deal. Anything through 1.1000 is a huge deal. Dollar stronger, DXY back above 113 gets my view here. In yen, 151. I'm going to round it up. 151 is stunning. We'll talk about that in a moment. Futures a bit negative here. The VIX goes nothing for the week, 30.16. We had a 29, for a whisper there, we had a 29 on the VIX. And the yield, as we've been talking about, pick your yield. I go with the 10-year yield, Lisa, 4.27%.
All right. Well, today we're looking at the last slew of Fed speak before the quiet period. The quiet period beginning next week. Thank God for the quiet period. Right. So we're going to get possibly Charlie Evans. We're not sure at 9:40 a.m. He's the Chicago Fed president, but John Williams, New York Fed president, will be speaking at 9:10 a.m. We'll be speaking throughout the show, but just as a side note, I'm curious. We speak about all the Fed speak. Jim Bullard, kind of in a bit of hot water with question marks around this off-the-record event at Citigroup, and some people wondering, he's saying he's not going to be doing any more private events. Earnings continue today. American Express and Verizon Communications within the next 90 minutes or so. The earnings that we have gotten have been, I guess, some strong, some weak. And this really highlights the bifurcated nature of the physical goods market, as well as some of the services that continue, like that airline, that flight perhaps carrying a former prime minister.
You wonder how British Air will do, with all their troubles through the pandemic versus what we saw from United and American Airlines as well.
And just one final note.
Please.
In Brussels, European leaders will be gathering to talk about the energy crisis. And we have seen energy prices, natural gas prices come significantly. What do they say about the United Kingdom? What do they say about where their hands are tied in terms of how much fiscal support they can provide?
The prices come in on gas from the hysterics of a couple of weeks ago, and I think it's worth studying over the weekend. I mean, everyone's weekend reading is going to be incredibly rich here, just starting with the politics of the United Kingdom. But again, I'm going to go back to folks today. Our real focus is going to be on bonds. Steve Major of HSBC will join us in a minute. Futures negative 18. Mark Chandler has written books on the astrology of foreign exchange, the interdependencies, nation to nation. He is chief market strategist at Bannockburn, and we start strong with Mr. Chandler this morning. Mark, let me go to Global Wall Street and what everybody wants to know. When is the comfortable time for Ministry of Finance in Japan to step in on 151 yen? Do they do it now? Do they do it in the quiet of their weekend? Or do they wait for the Asian Monday morning, our Sunday, 7 p.m.?
Yeah, it's a great question. Hatam, after they intervened at the end of last month, and I think they did three things that make the intervention less than successful. First, it was not a surprise. They continued to warn the market they were planning to intervene. Secondly, they did it unilaterally. That is, there's very little support from whether it's Europe or the United States for BOJ intervention. And the third thing I think they did is by intervening, they did not signal a change in policy. And so what we were telling our clients was that the only thing worse than intervention was failed intervention. And I think that's what's happened. Yeah. And so I think the Bank of Japan's in a tough position. If they do intervene, it probably won't be as successful as a last bout. They spent $20 billion practically to get maybe a week's night worth of pleasant sleep.
Mark, the Chandler word for acceleration, for a rapid advancement, is convexity. There's clear convexity in the unraveling of Japanese yen, Turkish lira, and that. Do you anticipate a fourth quarter and into 2023 of acceleration in these trends, or can we find stability?
Yeah, that's a $1 million question there, Tom. I think that the dollar is close to a top, partly because I think that Fed policy, as the market's got it priced in, they're 5% now. That's a 75 basis point hike in early November and again in December, and another rate hike early next year. I think that inflation is close to a peak, even if the core rate is too sticky. I think here's what I'm looking at.
Please.
Q1, the annualized rate of CPI was over 10%. In Q2, the annualized rate of US CPI headline was still above 10%. Q3 fell to about 2%. So I'm looking at inflation to be coming off. I know that it's very controversial right now. I know many people have been burned calling for this before, but I think that we're coming to the tail end of this historic dollar move. And I think the Bank of Japan and the PBOC, the Central Bank of China, are basically playing for time until Fed policy peaks, until the market brings the dollar back off of these historic levels.
Does this mean simply that it doesn't matter what happens in Europe, that this is entirely a Fed story from your vantage point and peak inflation in the U.S., and that it's not necessary to see a material turning around in a European region that seems like it's heading into a really difficult moment?
Yeah, so I agree with that, Lisa. I think that for me, there's two big drivers here. One, of course, Fed policy. Everybody knows about that. I think what's less appreciated is that there's been a serious deterioration of Europe's trade balance as well as Japan's. So the deterioration of the external accounts, as economists would call it, I think is another factor weighing on the currencies. But I think in the most immediate sense, that if the Fed were to announce today, maybe a Fed speech says we're done, I think you see the dollar come off very sharply.
Mark, you've just driven the 10-year real yield ever higher. Rounded up, we're up at 1.78%. We've moved mightily, like 88% to my study of 2.05% is somewhat of a normal 10-year real yield. Where's your number on that? What is a normal 10-year real yield?
Yeah, tell you the truth, I don't have a clue. And I say that because I say that partly because, these things like a real yield, R star, you can't touch them. They're sort of they're abstractions, they're statistical abstractions. And I think that when you look at Fed funds rate, which is really what I focus on for the real rate, I think we're still looking at a negative real rate on Fed funds. And typically, looking for a little further out to the 2-year, you get a positive 2-year yield, real yield. And we don't have that yet. But I think this is a different cycle. And I think that because it's an unusual cycle with all these shocks, whether it's COVID, whether it is the supply shocks, whether it is Russia's invasion, I'm just not sure that these benchmarks are very useful right now.
This is really, really important, folks. This is why we have Chandler leading off today, because A, he does not have a clue. There's no question about that. And also, he moves away from the usual statistics and looks at a benchmark for Chandler and Bannockburn of 2%. That was brilliant.
I think that should be our mantra. To tell you the truth, I don't have a clue. So you'll
Pharaoh
come to
tells me that on the day. Where is Pharaoh? Is Pharaoh coming back?
He's not coming back because you said he's playing footsie with the Dow. And he said,
Hey, Zero Hedge quoted from his paper last night. I thought it was pretty good. Appendix 6, futures negative 21. Yes, we will speak of London. We are going to go to Parliament here as the quick battle heats up for a new Prime Minister. Stay with us. This is Bloomberg.
지금부터 판결을 시작하겠습니다. 피로를 가져온 간세포에게 유죄를!
존경하는 재판장님, 이의 있습니다. 간세포는 잘못이 없습니다. 증인 신청하겠습니다.
피곤한 건 간 때문이 아니라 바로 침대 때문입니다.
뭐라는 거야?
침대 탄성이 약하면 뒤척일 때 우리 근육들을 써야 해서 밤새 피로가 쌓이거든요.
역시 내 잘못이 아니었어. 이 모든 혐의에 대해서 다음과 같이 판결을 내린다. 침대 피로 유지! 야 그녀! 뭐 특별한 침대라도 있는 줄 알아? 너 진짜 가만 안 둬!
가만히 있어.
강탄성 스프링을 넣어 침대 피로 회복. 한샘 포시즌 매트리스.
Keeping you up to date with news from around the world with the first word, I'm Kaylee Lyons. Ukraine's foreign minister says he talked with Israel's prime minister about Kyiv's request for defense systems to help combat Russian missiles and Iranian-made drones. Israel has offered to assist Ukraine with a missile warning system, but says it will not provide weapons. The U.S. has accused Tehran of sending trainers and technicians to Crimea to support Russian drone attacks. The European Union has agreed to press ahead with a set of emergency actions to address the bloc's energy crisis. It comes after Germany yielded to pressure from other member states to pave the way for a temporary price cap on natural gas. The European Council's president says the move sends a clear signal to the market that the bloc is ready to act together. The Biden administration is said to be discussing whether the U.S. should subject some of Elon Musk's ventures to national security reviews. Sources say that would include the Twitter deal and SpaceX Starlink network. U.S. officials are uncomfortable with what they see as Musk's increasingly Russia-friendly stance and his plans to buy Twitter with foreign investors. Adidas has issued a fresh profit warning as unsold goods pile up and consumer demand weakens across China and Western markets. The German sportswear maker says it now expects an operating margin of 4% this year, down from a prior forecast of 7%. The CEO, Casper Rohrstedt, has already announced he's stepping down next year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lyons. This is Bloomberg.
We've seen the power of the markets over the last few weeks. I think Chancellor Jeremy Hunt was getting on top of that, putting together a package that would have been reassuring to the markets on the 31st of October. Clearly, what we mustn't do now is anything which signals to the markets more chaos, instability and uncertainty.
From the time of Theresa May, Lord Hammond, he's the former Chancellor of the Exchequer for the United Kingdom, with a view on his party. There are many views this morning, to say the least. It is a movable feast, and again, we say thank you to our team, and particularly to John Micklethwaite, our editor-in-chief, for wisdom yesterday in the chaos. I believe it is less chaotic yesterday. Tom McKenzie is at Westminster and picks up the pieces for us this morning. Tom, I want to do Civics 101, which I believe is in the United Kingdom, when you want, you can change the rules. We are going from a count of 20 MPs to get to 5 or 6 candidates, whatever, to 100 MPs to get to 2 or 3 candidates. Who decided that the Conservative Party could change the rules?
So that was the backbench. Well, that was the 1922 committee. Mr. Brady, who chairs that committee, you're absolutely right. Within this system, they do have the power. He does have the power with that committee to change the rules in terms of how they select the leader of the Conservative Party. They've done that, of course, on this shortened, radically shortened time frame. As you say, we could have a new prime minister in place by the end of play Monday. The deadline is for the 28th, so Friday, of course, in terms of when they get that new leader. The jostling, of course, and the horse trading continues in the Houses of Parliament behind me. The last count was, according to the BBC, that Rishi Sunak is currently leading with 44 MPs who have come out to support him. But Boris Johnson as well, a lot of reporting that he's cut short a holiday and is coming back as well to throw his hat in the ring. That is not confirmed, is not official. Rishi Sunak, Penny Mordaunt and Boris Johnson, none of them have officially thrown their hats in the ring yet, but they are the 3 leading contenders. The key question is, for the markets, what happens to October the 31st, when the new Chancellor, Jeremy Hunt, had said he wants to pronounce and come out with his fiscal plans, which will be checked by the Office of Budget Responsibility. That is crucial for these markets. Now that date is very much in question, Tom.
Tom, how much is it really important for a lot of the members of Parliament that they get a candidate who's going to keep Jeremy Hunt, who's going to keep the status quo, who is not going to pressure the Bank of England to be less aggressive?
Well, Jeremy Hunt has unarguably done something of a decent job in terms of getting the premium on UK assets down after that mini budget. Yields have come off and the pound strengthened. Not in today's market action. There is that volatility back again. Of course, we're seeing yields up and the pound under pressure. But on the back of his ability to unpick that Trussonomics plan and to, of course, gut it, most of it, 90% of it, he did restore something of some stability across these markets. And most of the guests that we'll be speaking to say they would like to see the Chancellor remain in place. Important for investors. Here's the question, though. When Boris Johnson, if he does confirm he's running, we know there is animosity, deep animosity between the current Chancellor Hunt and Boris Johnson. If Boris Johnson takes the #1 spot on Monday, then there is a clear question as to the longevity of the Chancellor, who has done some work to restore, at least partly, the stability across UK assets and, of course, that sense of credibility in the markets.
Tom, how vulnerable is the Tory party right now? How much is Labour making some inroads at a time of incredible deterioration in popularity?
At Barclays Corporate and Investment Bank, we're powering possible for clients, providing real results, creating sustainable advantages, turning threats into opportunities. Barclays Corporate and Investment Bank, powering possible.
You know, we spoke to a former strategist with Boris Johnson, worked with him on that successful 2019 campaign very closely, has known him for 12 years, and he says it is not hyperbole to talk about the future of this Conservative Party, given just how deep and how entrenched these divisions are. And actually, Rishi Sunak and Boris Johnson are really symbolic of that deep, entrenched division. Rishi Sunak, of course, on one side, the more modest, the more moderate parts of the party. Boris Johnson, of course, who led the Brexit campaign. So you have the right-wing parts of the party, but also have the grassroots who are very much in line with Boris Johnson. Rishi Sunak, though, supported by the moderates, but not so much amongst grassroots members of the party. So a split of the Conservative Party is not out of the question longer term.
Tom, you know, to borrow from the Beatles here from a few years ago, and I guess it's happening right now, according to his father, flew in from NASA BOAC, and so maybe it is Boris Johnson to the rescue. How does he treat now, after the scandals with the Labour voters who chose to vote for Prime Minister Johnson a number of years ago? Has he lost them forever?
That is a key question. It's worth reminding viewers, as you've just done, that he did come through with this thumping majority in the election that won over these former Labour seats. But he has also faced all of these scandals. Within the party, 148 members of his own party voted against him in a confidence vote. Outside of Parliament, the popularity of Boris Johnson has declined on the back of all of these scandals. It's also worth noting that he faces a parliamentary investigation as well that would haunt him if he does indeed throw his hat in the ring and if he does end up being the leader once again of this Conservative Party and this country.
Tom McKenzie with our British team here on Bloomberg.com UK. Outside of Parliament this morning. Lisa, what we do is we look at the litmus paper, and it's not good this morning. Sterling weakens.
And this, to me, is really telling, given the lack of certainty with the path forward, as well as what it will take, and this goes to what John Micklethwaite was saying yesterday, what it will take to restore credibility to a nation that has seen a pretty significant blow. Let's just put this in a perspective. Whoever comes in next will be the third Prime Minister of the United Kingdom for this year. It comes at a time when you've seen bond yields surge to the highest levels in more than a decade, and it comes as the Bank of England is tasked with tightening policy at a rate that many people are uncomfortable with, including some of the candidates that have been named to possibly succeed Liz Truss.
And just to pause here, Chris Hayes over at MSNBC had out a tweet yesterday, which was very quietly Prime Minister Truss shaking the hand of Queen Elizabeth II, and all Chris said was, this was 7 weeks ago. Well, that's how fast things have moved.
And that's why it was sort of poetic that she handed in her resignation after 44 days as prime minister to the king after accepting the prime ministership from the Queen. There's sort of upheaval in a nation facing a difficult winter cannot be overstated.
The difficult winter is seen in the bond market and in foreign exchange as well. We're going to continue to follow this story in the United Kingdom, the politics of it. But, of course, the ramifications back to the city and to global Wall Street. And I want to go again. I can report this morning, folks, sterling is broken down. We're back to 111.14, nowhere near 107. But any migration of that under a 110 would be shocking and would change this political race.
To be very fair, though, this is a global story, and it comes with dollar strength.
Oh, we
it
see
comes
it
with
this week.
yields higher, dramatically higher in the cases of some denominations in the United States. And to me, that is one of the biggest stories, if not the biggest story of this year.
And how long it takes to have a cup of Tang, it's real simple. The real 10-year yield printing a legit 1.78%. Claudia Sahm soon. This is Bloomberg.
ASML은 매일매일 기술 혁신의 중심에 있다고 생각합니다.
미래를 이끌어가는 힘의 반도체가 가장 큰 원동력이 될 수가 있고요. 반도체의 원동력에 ASML의 기술과 기술 혁신이 담겨 있다고 할 수 있죠.
이게 바로 우리 회사를 다니는 자부심이기도 합니다.
반도체 산업에 기여하고 기술의 발전과 함께 성장하는 것이 ASML의 정체성이라고 봅니다.
Bloomberg Surveillance, we welcome all of you on a Friday, staggering into the weekend, and you need reading. Here's my first read of the weekend. John Byrne Murdoch over at the FT with an absolutely brilliant piece on what he calls the opacity of Chinese data. He's being polite. He's got a couple charts that just are jaw-dropping about how the economic data structure of China is radically different than what it was 5 or 6 years ago. We await GDP sometime before Christmas, I think is what we're looking at. The data, equities weaker, futures negative 21, VIX does nothing, 30.18. Yield is the story. Abramowitz is all fired up, 4.28%. 10-year yield, real yield is stunning, 1.78%, is now 1.61%. Dollar demonstrably stronger today, and sterling with the headlines. I'm going to get a 110 handle on sterling here in a bit. 111.06. That is a much weaker sterling. Yen, a 151 is in its right and own story into Sunday morning as well. Is it always good to have somebody come into the studio who has a relationship, a ratio, an economic belief that's picked up by Fred? This is very, when you have your name in the database of Fred, you're on the edge of rock stardom.
Well, let's bring in the rock star, Tom.
Let's
go for it.
Claudia Sahm with us. So why don't you go to her, Lisa, because I know you're all shaped up here. Out of Michigan with all sorts of discussion and analytics on when a recession is a recession.
Yeah, and what comes is she's been in the Fed. She's worked on the inner workings of this body that has been at the forefront of global economics and markets. Where we are right now with respect to Fed speak, do you think that it is accurate pricing to look at a 5% Fed funds rate for the first half of next year and think that that will be what it takes and that this is going to not torpedo the economy as much as perhaps people are pricing in?
I think at this point, anyone that's talking about the first half of next year, there's a lot of false confidence. I would not be surprised how fragile financial markets are, that the Fed has to pause to get them back under control. Right. I mean, the U.S. financial markets are in a good place right now, but if nothing else, the U.K. has shown us how fragile to an event, to a bad policy decision. So I don't feel confident about what they're going to do in December, let alone where we're going to be by June of next year.
I know what Tom thinks of the parlor game of Fed speak and what they're going to do or what aren't they going to do. It's not very instructive. There is a question about the consistency on the Federal Reserve from a personnel level, and we talk all the time about Fed speak and how much of it there is. The latest, Jim Bullard, the St. Louis Fed president, has been reported to have given a private off-the-record event at Citigroup to hedge funds and bankers. Reporters were not invited. This is causing a firestorm. Even former Fed officials are coming out and saying this does not look good. What's your reaction to this at a time when people are looking to the Fed for leadership?
It's inexcusable. And to me, it's not an optics problem, it's an ethics problem. Jim Bullard is one of the Fed officials that is making decisions about rate hikes that have effects in the United States, will have effects for U.S. workers, and they are having effects around the globe. The idea that he gave any kind of private remarks to investors is outrageous, and he should go.
Ambrose Evans Pritchard did a tour de force in the Telegraph on modern theory and its lack thereof. He tore apart the Phillips curve and the belief in it right now from the early 50s, 80 Phillips at London School of Economics. He tore apart the Beveridge curve, which Krugman believes in, this out of Beveridge of middle century London School of Economics. Is there a theory right now, or are we making it up as we go?
They're following a theory that is so outdated.
What is the theory they're following?
The Phillips curve. So this trade-off between unemployment and inflation is at the core.
Do you observe that right now?
I can see that in their logic. This is why they're waging a war on workers, trying to get the labor market to quote unquote soften. They think that's what it takes to get inflation down.
This is your, I interrupt. This is Claudia Samm's wheelhouse, folks. I'm going to make this as clear as I can. If the Phillips curve doesn't work, what is the relationship of monetary theory to our our complex labor dynamics?
So we can use the tools like the Phillips curve, but there is so much supply-driven inflation. The speed at which they are going, the speed at which they need to think, they need rates by the next half of the year. That's it. You can't use that tool for that. And there's a lot of research. It turns out we've done research since the 1958, and they're not using it. They're trying to excuse away it's all demand driven. And if it is, the Fed does that. And the Fed is being very impatient, and it's hard to watch.
If we are ex post, if we are after the fact, what is the data we should look at if we are ex post? Claims isn't getting it done, isn't it? Because jobless claims look extraordinary right now. They look fully employed, frankly.
In a very unusual way, the Fed has painted themselves in a corner and said it is all CPI. The Consumer Price Index is the last place that the lower producer prices, the lower import prices, any kind of weakening, which we're already seeing, that's the last place it shows up. And they've told us they will not stop until it shows up there.
But earlier this year, you were talking about how we could see even disinflation, right? That we could see inflation roll over pretty dramatically heading into year end. We haven't. And services inflation has really been a big driver. It's not just rents. It's much broader. We just get the results from airlines. They're doing great, even though their tickets are incredibly expensive. So what have you gotten wrong with respect to the pace of the deceleration in inflation?
What I've gotten wrong is to look at the macro data. And in talking to businesses now, I mean, they have excess inventories. Why aren't you cutting prices? I mean, inflation is a business decision. They're the ones that write the price tag. And what they say is the consumers are here. Why would we cut back? And so I think the process of some of the supply disruptions, whether it's people coming back to work, whether it's like getting the goods here faster or the strong dollar feeding through, it's taking a lot longer than I would have expected. When I talk to business owners, I'm like, that makes sense.
Well, but this is the concern for the Federal Reserve and possibly the reason why they are being as aggressive as they are, because they had waited too long in the past. And that arguably is the reason why inflation accelerated to the pace that it did. If there is this uncertainty about why it's not coming down more, there is a big risk to not raising rates substantially. Isn't that right?
We're not in the 1970s. There was a decade of high inflation where the Federal Reserve was asleep at the wheel. We've had less than 2 years of high inflation, and the Federal Reserve has gone in big this year. Mortgage markets are showing us, wow, these are big increases and they're really fast. And we know long and variable lags. It takes time. And we also know that the rental market, what's happening right now, those prices are coming down. The Fed knows this. And they're going fast and hard.
Folding the international events here, I was thunderstruck at the IMF meetings how the adults down there have a much longer time frame back 40 or 50 years, and they're much more looking at international dislocations than the parlor game of inflation rate dynamics. At what level is Jerome Powell, central banker to the world, driving the policy of all these different nations?
The Fed is absolutely in the driver's seat. I mean, the dollar has strengthened so much. He is pushing the ECB to raise rates, the Bank of England to raise rates. They have absolutely supply-driven inflation, and frankly, they're going to make a bad situation worse. Europe is headed towards a severe recession, and the Fed they are contributing.
So what do they do? I mean, we've got a Fed meeting November 2nd, and after that, let's have Claudia Samm, market expert, come in here and give us a take. Are we way overdoing the parlor game out? Fed meeting 2, Fed meeting 3?
They need to slow down. They're not going to. I mean, 75 is absolutely happening. 75, 50, 25 would be great, but I don't know. I wouldn't be surprised at all for a 75-75.
Is currency of value to you here? I mean, to study strong dollar in all the different dynamics of pairs?
So what a strong dollar does is it means it's cheaper for us to import goods. And we like a lot of cheap goods from abroad. And right at this point, we are doing beggar thy neighbor. We are bringing in, with the strong dollar, we are importing disinflation and we are exporting inflation. And that's good for us. Yay, America. But that's not, if we push the global economy into a severe recession, we're not going to withstand that.
You come out of the Michigan Combine, which is massive inflation analysis, all the different professors and the wonderful Granlick and all the rest of it. Which matters to you now, a services pullback or a goods pullback to disinflation or even outright goods deflation? Which of those two is more important?
Well, broadly, we say that the best cure for high inflation is high inflation. Right, that consumers need to get price sensitive, they need to pull back, and we're seeing that there has been slowing in the growth of consumer spending. A rotation away from goods and back to services, it's going to be disruptive. Every rotation we see is disruptive. We need to get back to something that is a semblance of normal.
Lisa emails in and she says, would you ask Claudia Sam here about what the inflation worriers are getting wrong? I mean, the inflationistas used to be Chuck Plosser in Philadelphia, and now the inflationistas are Larry and Dudley. Line them up like ducks. What do they get wrong right now?
Well, the Larry and Dudleys were right for the wrong reason this year. Last year when they were talking, it was all about the rescue plan, Well, COVID, Delta, and Omicron, and all the variants, and then Putin showed up, right? So if you don't get the story right for the right reason, you will make very bad forecasts. So their forecasts right now are just, set them to the side. The thing the Federal Reserve is doing is they are so afraid of these inflation expectations taking hold. Those expectations look solid. People believe the Fed is into fighting inflation, right? But they're now worried about, they're stable, but they could come unanchored and rise. And it's like, you really are going to tank the global economy over something we have no signs of? And when they move slowly, right? So it's just, that is their big fear right now. It's embedded inflation expectations.
You have cats at home. Your new cat, did you really name it Pivot?
No, she's Puffy.
Puffy, okay. Claudia Sam, thank you so much with Sam Consulting, and certainly one of our great experts in this nation of the measurement of a path to recession. We're going to continue. Sterling weakens. That is front and center. Futures negative 20. This is Bloomberg. Stay with us.
Keeping you up to date with news from around the world with The First Word, I'm Kaylee Lyons. President Biden has started aggressively promoting his student debt relief plan. The government has been working out the kinks in the program, and a White House event Monday is set to officially launch an application website. But multiple legal challenges, including a lawsuit from Republican-led states, are moving through courts, threatening to halt the effort. Italy's Giorgia Meloni has clinched a mandate from her coalition on the path to becoming Italy's first female premier. The coalition, which includes her Brothers of Italy party, former Premier Silvio Berlusconi's party, and Matteo Salvini's Lega, told President Sergio Mattarella that she is their candidate. Mattarella is expected to formally ask her as early as Friday to form a government. China has locked down parts of a central city, confining some of its 13 million people to their homes for at least a week. Other major hubs are rolling out virus restrictions as well, reflecting the country's commitment to its COVID-0 policy. Residents in high-risk areas are required to stay at home until no new infections are reported for 7 days, and then they get moved to medium risk. Hong Kong officials have canceled a screening of a Batman film 1 year after passage of a law that lets them ban movies on national security grounds. It was a showing of the 2008 movie The Dark Knight, set for next week at an outdoor venue. A notice said the decision was, quote, based on direction from the Hong Kong Government Office for Film, Newspaper, and Article Administration. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lyons. This is Bloomberg.
많다. 가입부터 설치까지 신경 쓸 일이.
비다이렉트 샵은 다를 텐데. 가보자고!
BTV 인터넷 가입부터 설치까지 빛의 속도로.
감동 그 자체.
비다샵은 연중 부휴. SK 브로드밴드. 추가 할인의 사은품도 딱.
I think inflation has reached the top. I think it is starting to come down. I think it may come down more slowly than people are hoping because of the stickiness in the shelter cost and the stickiness in labor markets. But as I said, I think the Fed has had a positive impact.
One of my favorite people, Jonathan Gray of Blackstone Group. If you are young and you make a lot of money, what do you do with it? And this guy, more than anyone I know on the island of Manhattan and the 5 boroughs, is ponying the money to charity. No one like Jonathan Gray. Great to hear from him with Shonali Basak here over what Blackstone's doing, particularly in real estate. Lisa, let's just take a moment here on that. This is a sensitive issue where in the modern age, fancy people with fancy money are cornering the real estate market in America. And that's part of the Blackstone questioning, if you will.
Well, and this has been the story for a number of years. Will they continue to be buyers as mortgage rates go up and prices come down? And also, how much are they going to raise rates at a time?
Raise rents.
Raise rents at a time when there is this increase, and yet there is popular antipathy toward this.
Futures negative 23. We're watching yields. Lisa stunned by a 1.78% real yield, and that folds into all of our investment calculations on a Friday.
We're seeing a macro move. Let's be very clear.
That's the best phrase of the day.
This is
macro
a
move.
macro move. Yields higher, dollar stronger, disrupting a lot of different trades. You're seeing that with the euro weakening. But again, this is a dollar story, 97.37 euro-dollar cross. You could see this in the 10-year yield breaching the highest levels we've seen going back to 2007. Right. What does this do to reset valuations, to reset understandings, and how much further this has to go? Sebastian Gailey, senior macro strategist at Nordea Asset Management, joining us on a macro move. Sebastian, how durable do you see the moves of today, seeing new highs in yields, seeing new highs in the dollar versus certain asset classes, seeing the yen on the brink of unraveling?
Yeah, the interesting question is, in essence, can we predict how high the Fed has had to go when we don't understand the inflation dynamics very well? Over time, people have become more detailed, supply, demand side, looking at rents, looking at the different subcomponents, analyzing the different stratification within the consumers. There are rich consumers, they don't care. There are middle income consumers, some of them do care, they're very leveraged. And the ones who are poor, obviously, you can't sell so much to target. Others have to basically are left with inventory of prices which they've overpriced, and margins are very, very, very high profit margins. And so we have this big demand which is coming in with supply, which is an issue, and eventually it slows down, led by the poor, but the middle income and the rich are still doing very well, and the message hasn't completely gone through that leverage is getting very expensive, that your real estate market is probably overly expensive. And so there's not yet the moment of doubt within U.S. consumer where everything adjusts. And on the corporate side, also, some of the corporates remain in a delusion. They think everything is actually doing well. From CEO confidence indeed has fallen a lot, but it's probably led by the people who sell low profit margin type of products. Like Apple are a little bit worried they might fire 1,000 people, not very much more. And so we haven't seen that big adjustment both on the household side, on the corporate side. And when it happens brutally. Well, and that's the issue. We don't know when it's going to happen. We don't know how much the Fed exactly has to tighten. It's probably already over tightening, and it has no choice.
How close are we, Sebastian, to something breaking in markets before they reach that point?
And if you look at equities broadly outside of the United States, they're actually quite cheap. So if you have to make a call as an asset allocator, you can say in the next 3 to 6 months, or let's say 3 to 5 months, is actually going to become very interesting for equity investors. From the U.S. Side, some of the stocks, NASDAQ and the likes, still remain very expensive. There's still this belief in America being a great economy, well-managed economy, and being just a great place to invest. And it's not only for Americans, but pretty much everyone else around the world. And it's part of the reason where the dollar is so strong.
Yeah. Sebastian, you wrote a brilliant essay of optimism on the United Kingdom. You said the compare and contrast with Italy is wrong, wrong, wrong. Explain to us your optimism as the United Kingdom extracts itself from political crisis.
And so one of the reasons you can get political instability is because you pander to simply one group within that population and not the entire population. And UK has a long history of basically being well governed, and we've seen significant accidents recently. But in general, they just know how to do the right thing, both from the Labour side and from the Conservative side, not always immediately, but eventually. And so there's a sense that there's a social contract in the United Kingdom, as you can see it also all around Europe, not everywhere around Europe, and also to some extent in the United States. It means that people believe that the Bank of England will eventually do the necessary. The government eventually does it. And Mrs. Truss actually resigned. Nobody pressured her. She was under significant pressure, but she did it by herself. So she considered, okay, this is not good for the country. I will step aside. It doesn't happen in many countries.
I got a day trade through to Monday. Am I going to go long sterling here, Sebastian? Help me.
What you want to do in FX in general, preferably, is avoid it. I have long experience as a currency strategist. What you do want is stay on a long dollar position, but it's becoming increasingly dangerous both on the dollar yen side and dollar versus emerging market. We're seeing the renminbi weaken consistently on the back of what must be recession in China, and so it's a difficult and unfortunately complex environment. The long dollar story probably still has some legs, but it's becoming very dangerous.
Sebastian, thank you so much. Terrific Friday brief. Sebastian Gelli, always better on Friday when the Nordea Asset Management is, well, you know, Lisa, and I use this word too much, but the swirl that we've been through, not only this week, but the month, or maybe it's 8 weeks. I lose track here in this forever long 2022. I look at the screen and all I can hang on is the inflation adjusted yield. That's what every guest is focused on.
And to be very clear, because people will say real yields are still very negative, they're not actually positive if you look at where inflation is now. This is for what people are gaming out in markets for inflation over the next 10 years. So that means that people think that the Federal Reserve is going to raise rates by the most above where that inflation rate is expected to be over the next 10 years, going back to 2009. How much, though, does this talk about what we've been discussing for a long time? People keep getting it wrong with inflation, and we don't understand why. The lack of certainty around what the main drivers are and the stickiness of this. I mean, Philadelphia Fed President Patrick Harker yesterday.
What did he say?
He said that the Fed's anti-inflation policies are, quote, frankly disappointing. And he talked about how he expects the yields to be, Fed funds rates to be well over 4% by year end. This is the base case.
Yeah, but to me, it's not the level of what the yield is doing. It's going to be the length of that. And the major message.
We're probably going to see persistent inflation, and that these yields are not all overdone.
The real worry is not only about this winter shortages, but also next winter shortages.
We have an almost abnormal obsession with all things inflation. For the most part, what we're seeing is the consumer's okay.
People continue to have a pretty high cash coffer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on a Friday on radio, on television. What you need to know. Well, we're going to go to Tom McKenzie at Parliament on the Derby in the United Kingdom. It is an odd Friday in the United Kingdom after the history that we saw yesterday. We are going to try to steer through the next 2 hours. Steve Major to join us with HSBC here on yields. Lisa, it has been secondary this week. It deserves, as you say, to be the macro story. A 10-year real yield can't get out of its way, 1.78%.
Bond markets are taking charge in a global economy and the global political regime that I could arguably say, given what happened in the UK. How much does this really tie the hands of fiscal policymakers that have gotten used to central bankers that will buy their bonds and bond markets that will give them cheap financing at a time where yields are surging to the highest levels in more than a decade.
And surging is the right word. I mean, as we go into the jobs report, as we go into November 2nd and a Fed meeting, the answer is there's a dynamic here into that meeting we didn't see 2-3 weeks ago.
And part of this is driven by that tension that we were parsing out with Claudia Sahm, this idea of the Fed is moving further than people had imagined they ever would or could, simply because we have been surprised again and again with the inflationary impulse and how durable it is and how strong it is. And it's not just the U.S., it's Canada, it's the United Kingdom, it's the European region.
You know, I look here at the Bloomberg Index, and this is the blend, folks, that you see on the Bloomberg Total Return Index. There's like 8 or 9, 10 of them, and there's one that you center on. Negative 18% and widening out every day, a price decline in bonds.
And a price decline that people are saying is resetting yields to a level where they're sort of becoming attractive, but the marginal buyer is not yet coming in. And I know that you have your thoughts on that. But how much is this a reset, to your point about how long rates remain at this level? A reset in corporate America, in the global corporate sphere, with roll-ups, with potentially companies going bankrupt.
Yeah.
Right now, we're not seeing that price into the market. And earnings have held in, at least for the most part.
Sunday night, Phillies, Padres, maybe. Yankees, Astros, maybe. Ministry of Finance, maybe.
Exactly.
We may get in our Sunday night at 151 on yen. Maybe we need to pay attention.
I know, right? 151 climbing in terms of the dollar versus the yen. And at what point do they step in? What's the line in the sand, right? People were saying it was 150.
You got me.
It surged through that. They before said it was 145. We're well past that. And how much do we keep going? And are they just simply going to try to control the pace of the deterioration, of the weakening in the yen versus the dollar versus outright support it?
On Friday, not that many earnings on Friday. American Express comes in with a report. We'll go over it in 2 seconds here. Revenue up 23%. It was supposed to be up 25%. I mean, that's what their view is. Those seem like ginormous numbers, and yet it trades off a little bit here. Their forward guidance is not so forward.
The full year earnings per share is estimated to be $9.25 to $9.65. The estimate was $9.90. This is actually really quite important, given this could be a bellwether on wealthier individual spending, and whether they could be cutting back as well. I don't know. We haven't seen it in the
The acclaimed Bloomberg headlines on American Express. Here's one. American Express haven't seen changes in consumer spending. And the next headline is Redo, keeper of the Amex, says Tom stopped spending. So there's some of the granularity that you've got. Data. Let's do it right now before the brief. Futures negative 17, Dow futures negative 100. The VIX critically above 30. The VIX has gone nowhere this week. That in itself is a story. The curve inversion a little bit less, in that 10-year real yield 1.77% on dollar strength. Lisa?
Yeah, we are looking also at a slew of Fed speak, and I really do have to harp on this Patrick Harker comment yesterday about how it was disappointing how the Fed tightening has worked so far and where the CPI has come in. We do hear from John Williams, New York Fed President, 9:10. Charlie Evans is expected to speak, Chicago Fed President, at 9:40 a.m. Also today, earnings. We did just touch on American Express, which just came out in about a half an hour. We'll get Verizon Communications. It's been hit or miss, right? It has not been consistent. We have about a quarter of the earnings coming in at this point, and it's really been hit or miss. American Express missing to me is very interesting. I'm curious to parse through and understand, okay, if their spending habits aren't changing, why is revenue coming in light?
What I don't get here, Verizon, 10-year total return per year, 2.83%. I don't know what to do with that.
Well, but this was what we were talking about yesterday. Utilities have been chugging in at less than junk bonds in terms of the returns. Does that change? I mean, how many people have come on this show and said utilities are the place to be because they're havens, they haven't been bid up, they haven't done the snap thing. All right, we're also going to be hearing from European leaders today, and this to me is something I am just sort of keeping an eye on. This is the second day of a summit in Brussels, talking about price caps, talking about what to do with the energy crisis. I know.
What's important about this? Seriously, explain for our American audience, what's the so what of Brussels this morning?
Two things. Number one, I want to see what they have to say about Liz Truss's resignation and where the bond markets have been pricing different plans to try to address the energy crisis. And then I want to understand, okay, crisis over, we see natural gas prices in Europe plunging on the likelihood that they have higher stores. So what do they have planned for the winter after? How about the winter after that?
Okay, Tom McKenzie here in a bit will give us an update from Parliament. Right now, your conversation of the day of a diversified portfolio. Sarah Hunt joins us, portfolio manager at Alpine Sachs & Woods. We'd love to have her on with the linkage here of all the media babble into what do you actually do in the equity market. Sarah, how much cash do you hold right now?
I would say that we're holding higher than normal cash levels. So if normal is somewhere between 0 and 5, maybe you're closer to 5 to 10 or in some cases over that. I think that this is a very difficult time in the equity markets. As we've seen, the volatility has just been much wider than expected. And we have had the markets come down in multiple compression before we really get an earnings reset. And I think that's the biggest issue going forward, besides what the Fed is doing. It's the earnings reset. And we haven't really seen that yet. And I think it's coming.
And given that you think it's coming and other people do too, I wonder how much Chris Harvey...
different piece of this market, and you're getting some good news and some bad news. Like UNP said that they're worried about stuff. CSX said they weren't as worried about going forward carloads. So I think that there's just a lot of uncertainty between companies and everybody else right now. And I think that I just don't see how S&P, which consensus has higher next year, I don't see how that doesn't have to change before we start to get more comfortable with where equity valuations are, because the multiple compression has happened, but the E is still expected to be higher next year than it is this year.
Let's just put a bow on that, Sarah. Does this earnings season so far make you more or less bullish on riskier assets in the months to come?
I don't think it does either. I think really, I mean, this goes back to what are you looking for? We're looking for companies that can both grow their dividends and have some consistent earnings power, that through different cycles. I mean, I think that this earnings season isn't really changing that. The fact that Adidas just came in after Nike with bad numbers and everyone's saying the consumer is so great, I think there's just a huge disparity in what's going on in different places where people are spending. And I think it's really hard to game that out ahead of time and think that you know exactly where you're going to be correct.
Sarah, it's a new territory in that we're going to some form of risk-free rate. A lot of really good conversation on this show about the new regime for equities. What does the Sarah Hunt new regime look like if you get an actual real yield, an actual risk-free rate?
Well, you guys have talked a lot about on this show about the fact that it's hard to price risky assets when you're still repricing the risk-free rate, right? So that's part of what some of the volatility is about right now. I think historically speaking, it's not unusual to have rates maybe not in the 5 to 6% range, but maybe in the 3 to 4% range. And I think that there will be an adjustment to that. And part of that adjustment has been the multiple compression that we've seen so far. The problem on top of that is that we are probably facing recession if we're not already in one now. And we certainly are concerned about global growth, and not just U.S. growth, but growth everywhere. And I think that part of that, you've got energy prices that are problematic. You've got food prices that are problematic. Right. Some of that on the back of Russia, Ukraine. There's a lot going on.
So I just need some advice. Do I buy Apple this morning?
We like Apple. I think that the market gives you opportunities to pick everything up a little bit cheaper, and this is what we've seen so far. So there's a lot of stocks that we like. I think of Apple as more of a staple than a tech company because nobody can live without their phones or their iPads. No. I think that there are some places in the tech world that we like. Right. Still, the whole group is being sold together for the most part, although Apple has held in better than a lot of its compatriots.
There's your banner this morning. Hunt, Apple is a staple. Sarah Hunt, thank you so much. Alpine Sachs & Woods as well. Let's digress to tech chat right now. Yeah. At your house, do various offspring have lined up the next Apple item that needs to be bought?
No, in my household,
I think I'm like 4 out.
Seriously, they have antiquated tech that they sort of line up and have multiple screens in front of their.
Come with a vengeance.
Yeah, no, but it's funny. They have like 5 screens and they kind of switch from screen to screen. I'm basically a fantastic mother, as you can tell.
I can tell.
But
it's abuse.
Basically,
it's amazing. This is really important actually with all the the macro babble we do. Some of these stocks are staples like toothpaste.
Yeah, although you possibly aren't buying as many upgrades if the kids can actually go outside and play with their friends rather than during the pandemic where they couldn't. I'm just saying that, now there is an alternative and you can kind of say, guys, get off the screens. They can say, no, we don't want to.
Remember that?
You can try really. And
anyway,
I'm digressing.
Dollar straw, you're just going down in flames. Steve Major in the next hour. Stay with us. Dollar Stronger. Good morning.
현대해상은 왜
마음이 한다고 할까요? 지켜주고 싶은 마음.
네, 하나, 둘, 셋.
오래오래 함께하고 싶은 마음. 힘이 되고 싶은 마음. 고마워서. 마음이 닿는 곳에서 보험이 시작되니까 마음이 합니다. 현대해상.
Keeping you up to date with news from around the world with the first word, I'm Kriti Gupta. Ukraine's foreign minister says he talked with Israel's prime minister about Kiev's request for defense systems to help combat Russian missiles and Iranian-made drones. Israel has offered to assist Ukraine with a missile warning system, but says it will not provide weapons. The U.S. has accused Tehran of sending trainers and technicians to Crimea to support Russian drone attacks. And the European Union has agreed to press ahead with a set of emergency actions to address the bloc's energy crisis. It comes after Germany yielded to pressure from other member states to pave the way for a temporary price cap on natural gas. The European Council's president says the move sends a clear signal to the market that the bloc is ready to act together. The Biden administration's officials are said to be discussing whether the U.S. should subject some of Elon Musk's ventures to national security reviews. Sources say that would include the Twitter deal and SpaceX's Starlink network. U.S. officials are uncomfortable with what they see as Musk's increasingly Russia-friendly stance and his plans to buy Twitter with foreign investors. Credit Suisse will aim to settle a tax fraud and money laundering case in France on Monday. The Swiss lender is reportedly in the final stretch of negotiations with prosecutors to reach an agreement that would include a fine but no admission of guilt. The size of the settlement is unknown, and the deal could still fall apart ahead of the court hearing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kriti Gupta. This is Bloomberg.
We fixed a high threshold, but a threshold that should be achievable by any serious candidate who has a realistic prospect of going through. A threshold of 100 members of parliament nominating a candidate obviously allows for 3 candidates potentially to come forward.
Graham Beatty for the Conservative Party. The Minister Brady is the one making the rules. Maybe he's like the head referee at the NFL games this weekend. We welcome all of you on radio and television to a most interesting Friday. John Farrow's off. Lisa and I are really trying to focus on bonds, on stronger dollar, on yen weaker. Rounded up, a 152 yen is stunning. But yes, even we on this Friday must turn to the United Kingdom. And we do so. The movable feast now's BBC just has the esteemed Defense Secretary, Ben Wallace. He will not run. And I think the major message for Americans on this Friday is, don't we wish in America we had the timeline of this race? Wouldn't it be great to have a midterm election or presidential cycle that goes to 9 a.m. on Monday?
It is 9 a.m. Monday. We're going to find out our time, what happens in terms of leadership. I don't think that anyone in the UK would say they're in an enviable position right now in terms of some of the tumult. We do, of course, though, think that we have an enviable position in terms of our bench of people who have been covering this. Tom McKenzie right now at Westminster of our Bloomberg here. And I'm wondering, Tom, you're watching all of the MPs come out with flags saying who that they're going to vote for. Who's the front runner right now?
빠졌는데 더 슬림해질 수 없을까? 내 통신요금?
비다이렉트 샵 안 가봤구나? 가보자고! 비다샵! 뜨거!
BTV 인터넷 기본 할인에 화끈한 30% 추가 할인까지.
비다? 샵 가능? 샵 가능?
비다샵 24시간 오픈. SK 브로드밴드.
더 빼준다고?
Well, the front runner remains Rishi Sunak, of course, the former Chancellor, but also the person who triggered, of course, that pushback that eventually led to Boris Johnson being forced out, and that has alienated him amongst large swathes of this Conservative Party. So we're looking at the Daily Telegraph, that is the Conservative leading newspaper. They're quite well sourced. They've come out with around 48 MPs now backing Sunak, 37 though for Boris Johnson and 16 for Penny Mordaunt. Worth reminding viewers, none of these three candidates have officially confirmed that they are in fact running. But that's where we are in this. We are monitoring the number of MPs coming out, putting their names behind these candidates. And as you said, we could have a new Prime Minister, a new leader of the Tory party and a new Prime Minister of the United Kingdom as soon as the end of play Monday. The first ballot, as you said, 9 a.m. US time, 2 p.m. UK time. The official deadline, they have to have chosen someone by Friday the 28th.
It feels like there's somewhat of an existential question behind this. How much authority the new Prime Minister will have coming in, given the diminished influence of the Tory party, given the black mark of Liz Truss. What's your view on that?
Well, these are politicians now with policies that are being policed by the markets, and that has just been made ever clearer. You're seeing the volatility again with the pound under pressure today and yields up. They now know, even the orthodox or unorthodox members of this Conservative Party now know that their policies will be closely scrutinised by the markets. And so to that extent, there are the guardrails around the policy making. But then there are the polls that they have to contend with as well that show an historic lead for the opposition Labour Party. Yes, we are officially 2 years out from an election, but to what extent can you push through policy when you are divided in your domestic party and you're facing the kind of pressure from voters when it comes to the polls as you look ahead to those potential elections?
Tom, the Sunak-Johnson animosity, is it a personal thing? Is it, heaven forbid, actual political theory they disagree on? Color this, not hatred, that's too strong a word, but color the political reality these two face.
So I was speaking to the former strategist for Boris Johnson earlier this morning. He said this is a personal dispute. They dislike each other personally. There was the tension leading up to, of course, the ousting of Boris Johnson. In terms of the policy agenda and the framework, well, this former strategist for Boris Johnson said he doesn't really have an ideology. Rishi Sunak does. He's been proven right around the market reaction to this mini-budget, unfunded tax cuts. So in that respect, he has credibility with the market. And he has support with at least some factions of the Conservative Party, but he is also, the former Chancellor, deeply alienated those parts of the party, those members of Parliament, but also grassroots supporters of the Conservative Party who continue to support Boris Johnson. So the idea that these two would serve together is very unlikely at this point. The other question is, if Boris Johnson does win this, what happens to the current Chancellor, who has done and made some progress in restoring some of that credibility?
That's right where I wanted to go. Just to wrap up here, Tom, and my head is spinning on this, folks.
Yeah.
Johnson, who's his chancellor? Sunak, who's his chancellor? What's the game on that right now?
나와 하나가 되어줘.
더 혁신적인 금융을 원해.
나 쓰기 편하게 해줘.
맥통장, 너만 믿을게.
진짜 세계적인 금융이 되어줘.
금융에 바라는 것이 이토록 다양해진 시대. 금융이 할 일은 하나가 되는 것입니다. 연결이라는 크고 깊은 변화로 모두의 금융이 되겠습니다. 하나로 연결된 모두의 금융, 하나금융그룹.
Boris Johnson and his Chancellor, frankly, very, very difficult to say. You can say that he's going to rule out Rishi Sunak. Absolutely.
Yeah, okay.
Does he stick with Jeremy Hunt? Possibly. There is some animosity on that front. Rishi Sunak wins this. He's currently leading with more MPs backing him. A long way to go, of course, until that Monday ballot. Who does he choose to be his Chancellor? Possibly someone from the right of the party to try and close that division.
My deepest sympathies. Tom McKenzie, thank you so much with coverage in this absolute chaos in the United Kingdom. And Lisa, seriously, to their great credit, after the whatever it was, 7 weeks ago, 6 weeks ago, whatever it was, the madness, the timeline here is just shockingly short. A week from today, they're going to have a prime minister. I think Monday, 2 p.m. their time, we're going to get a real clarity on that.
And
I don't know what happens between Monday and Friday.
What Tom said there was really prescient, I think, also. The markets are in control here, that basically any conservative member who comes into the office is going to have to run their policies by the market, essentially, to see whether there is enough stability in the response, whether bond yields don't climb dramatically, whether you don't have a further sell-off in the pound before they are ratified by the public. This really calls into focus this question about how tenuous right now the political system is at a time when there is historically low popularity for the Tory party.
No, but to sum this, the vigilantes are tangible. I mean, there's the bond vigilantes, there's the FX vigilantes, and there's the Bank of England vigilantes. I mean, I don't even understand where Governor Bailey fits into this.
Well, there's going to be increasing pressure, and there has been already, to possibly pull back with some of the rate hikes, saying, look, we've got your back with the fiscal policy. We're not going to be spending a ton of money. So at what point does that become a problem for markets as well, right? You don't have a candidate who can actually call into question.
Bring that over to the Fed. I'm going to bring up the FOMC screen on the Bloomberg November 2, December 14, and I click the little thingy here, and I go out to a long ways away from December 14th, February 1, and on to March 22. Where are we March 22nd of next year?
Well,
I have no clue.
The market's saying 5%, and it's saying that we're going to stay there for quite a while. And that, to me, is sort of a sea change, given where we had been.
Massive. What does that do to dollar?
I mean, that's what you're seeing. Well, you're seeing it do to dollar, right? I mean, you're seeing it strengthen against absolutely everything, and torpedo right now, the end.
The team coming off of yesterday's festivities and fireworks in the United Kingdom. A great lineup today. Leslie Falconio will join us. Stephen Major of HSBC in the 8 o'clock hours. Stay with us on this Friday. Good morning. Bloomberg surveillance movers coming up. One of the movers is the government of the United Kingdom. Lisa will have that
well
for
done,
you
Tom.
in a moment. John Farrow is off. We've had hundreds of emails today. What's the likelihood of a Farrow sighting Monday? And I'm really not sure.
It depends on whether there's a sighting of a new prime minister.
I think it is. It's hinged on the new prime minister as well. John Farrow will be with us, I believe, back on Monday.
He'll be back, yes.
I talked to him yesterday at length, actually, and he was following the festivities in his disunited kingdom. Thank to Tom McKenzie at Parliament this morning. We'll have much more reporting on this. This is a movable feast, folks, for the morning. Stay with Bloomberg Radio and Bloomberg Television. Ben Wallace, the Secretary of Defense, I'm using that as an American phrase, in the United Kingdom has just ruled himself out from running. Futures negative 13, Dow futures negative 104, VIX 30, but actually a little more constructive. Oil doesn't give me much love this morning. Currency, stronger dollar. Yen is the story. Watch it through the weekend to their morning, a 151, 152 on yen. Sterling took a run to 110, weaker, 111.27. Market movers. Lisa.
Thanks, Tom, for that. I've been looking at the big tech names, which we were talking about earlier.
Next week,
and
right?
We get the big tech on Thursday, the sort of Amazon behemoths and the Apple. But we got Snap, and Snapchat's been on a downward trend pretty significantly, and it is down by more than 25%, now down more than 27% after reporting its slowest quarterly sales growth ever. They missed their estimates. How much does this really speak to a problem in the broader ad-driven tech world? And this is the reason why you're seeing some of the other names sell off in sympathy. Meta, among them, down almost 3.6%. Google, or Alphabet, the parent company, down 1.7%. Again, this speaks to why advertise if you, A, don't have the goods to sell, which actually isn't the case anymore if we talk about inventories, but B, if you really don't see the same kind of revenues and your margins are getting cramped, and you need to really right-size and figure out the business plan ahead. Talking about right-sizing Twitter, there were reports overnight that if Elon Musk comes out and does buy this company, he plans to cut the staff by 75%. Those shares down by 7%, not because of that, but because this morning, Bloomberg's reporting that U.S. officials are questioning the deal and investigating some of the ins and outs of Elon Musk and what he's done.
I read this wonderful reporting from Bloomberg, from Jennifer and the team at Bloomberg. And first of all, this is really serious, really original. Agreed. Here's a guy who gave technology to Ukraine. Great. And I don't know the details of that, and I don't have an opinion on that. But this transaction may be held up because that's like a Department of Defense national security thing.
But it highlights Elon Musk as a polarizing figure and someone who really skirts the edges of compliance, the edges of what's okay, including on Twitter. And so how much does this really affect the likelihood of him taking over? And then what does that say about all the job cuts? Because even before he was planning to take over, they had planned cuts for that staff.
Right now, Verizon out. It looks okay. They're going to, quote, start cost savings plan.
Yeah, read job cuts.
Yeah, thank you.
I mean, that's basically it. Can I just say one other thing? You know, when I was confessing...
Can she say one other thing? Okay, go.
Okay, thanks. When I was confessing my terrible parenting, someone, a viewer who begged me not to be named, said, in our house, we have had to use going outside and playing with your friends as a punishment for not doing your chores. You are not alone. I love that. That really, I think I should use that.
These kids today.
These kids today.
What can we say? What we can say is to speak to Leslie Falconio, head of U.S. fixed income asset allocation at UBS Wealth Management. Leslie, thank you so much for joining us. And so much of this is the readjustment to the news flow we're seeing. Are you into a year ahead review yet? Or are you still trying to get through the fourth quarter?
Well, we're in a little bit of both. You know, I think that we're trying to understand the fourth quarter to really project the year ahead. And I think that one of the interesting things is as we look at what's happening in terms of this fourth quarter and how we enter 2023 is that we're seeing these yields in the 10-year that we haven't seen since, 2007. You have a large correction, particularly in fixed income, and mostly due to the rise in interest rates, will really set the tone for next year.
They're going to set the tone for next year, and it's a yield structure back from another time in place. Does that change your equity allocation or the factors that matter in equity that you finally have a risk-free yield?
Well, I think, as a fixed income person, I look, very closely at the risk-free yield and what you're being offered in terms of equity versus fixed income and how much that risk-free rate has risen and whether it's high yield or equity, investors are compensated by that risk premium, given that we have seen this rise in interest rates. And overall, in our opinion, I think the fixed income market is a bit ahead of the equity market, particularly the U.S. equity market. And there's pockets of vulnerability that we're seeing that really haven't adjusted in terms of risk premium when we think of sectors such as high yield. High yield has been incredibly resilient this year. At the spreads of 490 or 500, you're maybe the median spread. So, we don't think that going forward, what investors need to look at is really where the underperformance has come from, mostly has been a rise in yield, and whether or not you're really being compensated in terms of your risk premium.
Brilliant. And Lisa, this is to the heart of what you've been talking about, with some parts of credit have moved and other parts have shocked by the lack of movement.
Especially in the riskier segments, the more leveraged companies that are hanging in there because they are less rate sensitive. So let's move that into some sort of investment thesis. I mean, one of the biggest consensus trades that I've heard of recently is investment grade bonds. So many people love investment grade bonds because they have sold off dramatically, yields at the highest levels going back to 2009, and yet yields keep rising. What gives?
Well, I think, the yields keep rising because interest rates keep rising.
But spreads too.
Spreads as well, yes. And I think the difference between, say, like high yield and investment grade corporates, and by the way, we think high yield is very rich to investment grade right now, both fundamentally are at a situation where they have very low leverage, high interest coverage. But as the Fed raises rates and you have this borrowing cost that's going to stay higher for a long period of time, particularly during a period next year when growth will be slowing, you really have to assess which sector you want to be in and where you're being compensated for that potential pocket of vulnerability. And we do think that IG, given the fact that it's widened out a bit because it's seen much more supply, offers much more value than high yield here.
So right now, are you basically really going into longer term treasuries and some of the higher quality investment grade names and just locking it in and saying, if we can get 6% yields, which is what you're getting on average in the investment grade space, well, hallelujah, let's hang on here for the next 3 years and we're going to look great?
Well, I think what you just said is very important the next 3 years. And I think you have to look at, value versus timing. And look, as we know, this is not the most liquid market, and there's a tremendous amount of volatility. And we are getting incrementally longer, meaning we're adding a bit of interest rate risk incrementally, but we are in the fourth quarter. We do believe 6 months from now, yields will be coming down, and that, the opportunities we're seeing today, particularly on the yield and rate side, will actually be a tailwind to performance next year. But in the short term, you're going to have some volatility. But the yields that we're we're seeing here in both, whether it's investment grade corporates or agency mortgage-backed securities, and the spreads, we haven't seen them, in probably about 10 years.
We're just talking about the U.S. here. What about the United Kingdom? Are you buying that dip?
Well, I mean, the UK is a little bit, in our opinion, I think a little bit too volatile. I mean, I think there's a lot still happening in terms of the UK, in terms of a falling knife that you might not want to step in front of. There's a lot of issues that may have been resolved, but we do think they're going to be a bit more of contagion in terms of the potential recession in Europe, and the volatility there is a bit too high.
Well, see, I want to back up and just look at the carnage that's out there for many clients, and not just UBS Global Wealth Management. It's been a group effort to see price down and yield up. How do your clients who have a 10%, 15, dare I say, 18% loss in fixed income, how do they respond to the idea of reallocation and making a new go of it?
Well, I mean, look, there's no question. I mean, the performance in fixed income, the double-digit negative total returns has been very visibly displeasing. But, the purpose of fixed income is income. And you finally have a wider opportunity set that we haven't seen in years to compound that income going forward. I mean, particularly if you're an investor that holds to maturity, you're getting prices that are well at a discount. You'll move up to that par level and earn that incremental total return. And it's still an important part of a portfolio, particularly as a diversifier. And again, I mean, when we think about the magnitude of rates that we've seen in 2022, we don't expect to see the same magnitude in 2023.
Leslie Falcone, thank you so much with UBS this morning. Lisa, I want to go to your wheelhouse here, and it's on this idea that high yield maybe hasn't deteriorated like the others. And folks, you can see these in fabulous indices at Bloomberg. This is, of course, all the legacy of Lehman and Barclay. Now with Bloomberg, our total return indices are really informative, particularly when you look across a set of them. And the high yield one hasn't moved like the other ones. So when I say to you, Lisa, the zombie roll-up, which is easy in equities, what does a zombie roll-up look like in distressed debt?
It's unclear because, and this is actually a debate I've been going back and forth with a number of different investors, why has high yield remained so intact given the pain that we've seen in investment grade debt? And there's an argument, well, it's less rate sensitive, but it's also on the spread side. And then people say, well, they're better capitalized, they're better rated, and they have longer maturities. And oh yeah, the oil sector is doing great, and the energy sector is a significant portion of it. So that's the other argument. But then you have all the people who flood in, just like Leslie Falconio just said, and said they're just getting it wrong, right? And so then that leads to the question of, well, then what does this credit cycle look like if you don't have a Fed that's going to come to the rescue? And if you do see yields, baseline rates go to 5%, and this is your point, Tom, and this is a good point, and stay there for a longer period of time.
I mean, I just brought up, you can do this, folks, on the Bloomberg. I'm like the worst person in the building on this, but I'm enjoying the Snap 5-year, 4-year out, 6 years out convertible bond. And I'm enjoying that, Lisa, from 100 down to 69. It's down 30%.
Yeah, I mean, it's been dramatic, but...
I mean, people don't talk enough about the price decline in some of these single bond securities.
Although you could argue, even with that huge price decline, we haven't seen the forced selling. So you haven't seen the really dramatic dislocations that would either cause the Fed to come in or would cause people to be able to buy truly on a discount fire sale. So... is this really as bad as it gets, right? And this is what some people are saying.
No. As bad as it gets is the 98-year Austrian bond Farrell got me into. We'll look at that in a moment. This is Bloomberg. Stay with us.
Keeping you up to date with news from around the world with The First Word, I'm Kriti Gupta. President Biden has started aggressively promoting his student debt relief plan. The government has been working out kinks in the program. A White House event Monday is set to officially launch an application website. Meanwhile, multiple legal challenges, including a lawsuit from Republican-led states, are moving through courts threatening to halt the effort. Italy's Giorgia Meloni has clinched a mandate from her coalition on the path to becoming Italy's first female premier. The coalition, which includes her Brothers of Italy party, former Premier Silvio Berlusconi's party, and Matteo Salvini's League, told President Sergio Mattarella that she is their candidate. Mattarella is expected to formally ask her as early as Friday to try to form a government. China has locked down parts of a central city, confining some of its 13 million people to their homes for at least a week. Other major hubs are rolling out virus restrictions as well, reflecting the country's commitment to its COVID-0 policy. Residents in high-risk areas are required to stay at home until no new infections are reported for 7 days, and they get moved to medium risk. Hong Kong officials have canceled a screening of a Batman film 1 year after passage of a law that lets them ban movies on national security grounds. It was a showing of the 2008 movie The Dark Knight, set for next week at an outdoor venue. A notice said the decision was, quote, based on a direction from the Hong Kong Government Office for Film, Newspaper, and Article Administration. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries worldwide. I'm Kriti Gupta. This is Bloomberg.
What you saw Trust do, very much linked to what Quartain did, was to essentially try and blow up the markets. I mean, there was no possible way of having these enormous unfunded policies. The markets simply couldn't sustain them.
The professor from Dartmouth, David Blanchflower, was with us not once but twice yesterday, and we really thank him for his perspective here on his Bank of England and, of course, on the political uncertainties in London. Right now, 4 or 5 movable feasts, and we had to look at 2 or 3 and push them aside by a single headline from the White House. This is according to Bloomberg News. White House not aware of national security review for Musk Ventures. And Lisa, this has to be Twitter. And I guess we'll have more on that coming up here.
Yeah, and we are seeing the shares pull back from some of their earlier declines, down only 3.5%. I will just note this, that our own Jennifer Jacobs had tweeted the story out, and somebody responded, it would be hysterical if the government stopped Elon from overpaying for Twitter. And then Elon Musk responded to that saying 100% with a laughing, crying emoji. So that was, his technical response to that.
My distant view is price to sales. It's ugly. Also is sterling. It was a weaker sterling through the tumult of the morning. It has rebounded in the last 1 hour. And suddenly, as Caleb Pickering was wired up, Lisa, sterling's rolling over. We're not through a 111 yet. We'll have a headline on that when we see it.
Meanwhile, the earnings very much bleeding into the forward economic view. American Express just recently coming out missing and saying that they built more for charge-offs, more provisions, and they increased their expected charge-off rate going forward. Caleb Pickering joining us, senior economist at Bloomberg. Given how quickly things are moving, how much are markets getting ahead of themselves with respect to how high rates this market can handle, this economy can handle, and how pervasive this inflationary push really is?
That's a good question. I am actually wondering at the moment whether the bond market and the equity market are worried about different risks, and these risks are mutually exclusive. So the equity market is now starting to panic about the squeeze in earnings and the loss of pricing power and weaker demand. The bond market still seems to be telling us that we've got more inflation and interest rate risk to worry about. Those are mutually exclusive events. If we get the loss of pricing power, then we don't have to worry about inflation into next year. And so I think it's more likely that the equity market is actually calling this right than the bond market, in which case we should be anticipating when central banks pivot quite soon.
All right. So this comes at a time when the bond vigilantes are back in force. And from London there at Berenberg, you have a good view into that and just how violent that response can be. Yep. Can the central banks afford to pivot given how jumpy bond markets are, whether or not they're right?
Yep. I think that's a really interesting way to look at this, because it probably means central banks cognizant of this and don't want to go through the UK experience where all of a sudden bond markets really start to panic and throw up rates by, multiple tenths of a percentage point over the course of a day. You don't want that situation to happen. And so as a central bank, you may be inclined actually to go a little bit further than you need to. You might need clear evidence of disinflation, that you're in recession, which probably means, I think, Europe, we're getting there quite soon. US probably needs to run into next year.
Caleb Berenberg has just a fabulous team with Mickey Levy in America and Holger Schmieding with his brilliant continental view. Let me take you in the United Kingdom. Is the surprise forward not from the Fed, but a blink from the ECB that has a war going on?
The ECB doesn't have the same inflation problem to deal with that the US has. The US has a strong demand underpinning. The prices are rising and they're broad-based. In Europe, continental Europe, it's mainly this energy supply issue. To the extent that Europe is in recession now, we're seeing evidence of weaker demand. Really, the ECB just needs to keep raising interest rates until inflation peaks. Once that happens and they start to see those base effects roll over, you can start to take out some of the fear and you can hold rates. So I think we're probably quite close. I don't think we get close to 3% in the Eurozone. That would be more than enough, whereas the Fed probably needs to go substantially above that.
We're all focused on politics here, and certainly the zeitgeist yesterday was the separation of economics and politics in your United Kingdom. I don't buy it for a minute. How does Governor Bailey respond to a nation staggering to 2 p.m. Monday afternoon?
Well, at the moment, there's nothing for the Bank of England to do. We had the announcement earlier this week that active QT would begin towards the end of this year. The next Bank of England meeting to focus on is the 3rd of November. By that time, the Bank of England will know who the Prime Minister is and what kind of fiscal policies the UK will be pursuing over the medium term. The problem the Bank of England has got, after what we've seen, all of the noise, the bond market reaction, it probably needs to meet market expectations in the next meeting. 100 basis points is probably what we get, which will be a doubling of the rate hike in September. But I think after that, maybe 50 more basis points in December, and then the Bank of England's probably going to be done. By early next year, it's going to be so obvious that the UK is in a recession and it's disinflationary, and there's that you don't need to go any further.
So the Berenberg call on sterling right now as we near a 110 handle once again. Where are we on sterling with that scenario?
That scenario, we're probably moving sideways on sterling, but it's going to be volatile around the politics. You might see a bit of a relief rally if, say, Rishi Sunak, he's the market favorite, wins and becomes prime minister. But the world is really suffering from a strong dollar, and understandably so. We have a major war in Europe. West is in recession. You want deep liquid US markets, so you hold dollar assets. It's hard to see until the market turns more risk on, that dollar strength starts to come out. And so we're all going to be weak against the dollar for a while. That probably is a story for next year before we start to see this position reverse.
On a Friday, Caleb Pickering, thank you so much with Berenberg.
Pleasure. Thank you
for reading over the weekend. I look at this, Lisa, and as I mentioned earlier, it started with John Byrne Murdoch in the FT on really questioning, as is Tim Colpin at Bloomberg, how you measure GDP in China. And he cites at University of Chicago that it could be half as much growth as we're actually seeing. So I've got a scenario out to think about over the weekend, the anti-science of COVID, and pushing against that is all the challenges of a Pacific Rim slowdown. Which way do you go? I have no idea.
And that feeds into the idea that we were just hearing there from Callum Pickering, which is that dollar strength will persist. And this is the opposite of what we heard from Sebastian Gailey and Mark Chandler, because the rest of the world is flat on its back. And who does that hurt more? The Chinese slowdown? That hurts more Europe. That hurts more Germany. So then where does that strength come from that forces the dollar into a weaker position anytime soon that eases some of the inflationary imports of the European region and beyond?
Well, it's very emotional here. For those of you on radio, there has been imagery over the last number of hours and indeed days as well. And I think Lizzie Burden, of course, reporting from 10 Downing Street yesterday, captured this image. For those of you on radio, it's Lawrence the Cat at the podium outside 10 Downing Street, getting it done. And some humor here. You mentioned this yesterday, Lisa. The gallows humor is tangible. And of course, we missed the walk of the cat back to the door, but
someone also pointed out they put an Airbnb sign above 10 Downing Street. That was another meme that was going around. There have been a lot of them where they try to understand exactly how quickly this story
we will try to keep the reporting more than distant from Lawrence the Cat. We can do that at Bloomberg.com UK. A terrific summary of all going on in London. This is Bloomberg.
We're going to find that this is going to be an even tougher environment than people think.
The liquidity of the market remains good.
Markets are starting to price in the idea that whatever U-turn is going to happen, nobody is guaranteed that there will be a new turn around the corner a week from now.
The reality is that hard activity data are still pretty strong.
What we're saying about 2023 is we think the first half is going to be really sloppy. That's when we think numbers come down. That's when we think we're going to be dealing with a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
When does something break? Welcome back. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. John is off running for Prime Minister in London. Right now, we are here with a market that is moving so quickly, Tom, that it really is hard to keep track of. Yields higher, dollar stronger, the rest of the world flat on its back.
And you've said the smartest quote into the weekend reading, which is this fear of the break, because what hasn't happened is we haven't broken. Now, these reaction functions, we're going to talk about this with Alicia Levine, but I'm sorry, Lisa, there's enough movable parts on a Friday where you have to lean in to try to get to the Asia Monday morning. Yen 152 rounded up is all you need to know.
I'm glad that you pointed to the yen. When does something break really paints a picture for Japan right now.
Never see it
Earlier
coming.
this morning, people were saying, when do they come in? When do they intervene? They've intervened before. They're not intervening. 150 was the level. We're at 151. We're above that, and it's still not really coming.
I turned away to talk to Alicia Levine about the scam known as the SAT exams, and 10-year real yield moved to a 1.80 just while I looked away.
But that's my point. This is moving quickly, even after all of the increase that we have seen in yield, even after all the reset, even after markets price in a 5% Fed funds rate for the first half of next year. How much more can we possibly do?
I think it's a movable, we got the British distraction here right now, but away from that, and you and I have been remiss on this, the data on the Bloomberg screen has really been the story of the week. Can I just mention that the Bloomberg Financial Conditions Index has gone against Chairman Powell and has moved from significantly restrictive up to a gross accommodation, and again, 1.80 10-year real yield. That changes the discussion for global Wall Street.
Well, and this goes to the point that we've been hearing about from Mike Wilson over at Morgan Stanley. He said that expect a bear market rally because expectations are so low. Earnings will come in and they'll be better than expected because that's what they do. They guide people lower and then they beat those very low bars. And that's what we have seen with some companies. It hasn't been enough. And that, to me, is a pretty big takeaway. With American Express, one of the bellwether types of companies, coming in short, as well as the shipping sectors.
Yeah, I'm going to mention it. I'm much more interested in Verizon, which has been a challenge for over 10 years, and they're talking about cost cutting of some form. I guess we're going to see a lot more of that into the end of the year.
We are seeing weakness, and we're seeing the weakness deepen as we see yields continue to climb.
There's the Bramble gloom.
Well, come on. Let's take a look at what's going on. We're down 0.6% on the S&P, and it has been heading lower throughout the morning. At one point, it was really trying to stay flat. You are seeing the euro continue to weaken. This is a dollar strength story, and that, to me, I think is pretty pervasive across the world with the pound, with the euro, with the yen, 97.47 and 10-year yields. I mean, honestly, to see just on the cusp of 4.3%. Could we see 4.5% by the next couple of weeks?
I'm looking at the real yield and not the nominal story, and it's just completely changed story. How do you write your year-end essay right now? I have no idea.
What do we do? Go to cash. Go to cash. Triple
I
leverage
think
all
that's
cash.
the title of Alicia Levine's.
Well, Alicia Levine actually joins us here without the Star Destroyer behind her. Alicia Levine, head of equities and capital market advisory at BNY Mellon Wealth Management. What is your view, Alicia, and how you view this move upwards in yield? Are we watching something break in slow motion?
So I don't think we're watching anything break, but we shouldn't be surprised at this because that last CPI print really said it all. Core inflation is now higher today than it was in 1982. Forget the top line, it's the core. And that's ultimately what central banks are looking at and what the Fed is looking at. And that's our problem. What's amazing to me is that ratchet up in yields this week, the equity market kind of shrugged it off. You would have thought there would have been a more dramatic reaction there. So I think we get something in the next few days to reflect what's happened with yields and with rates ratcheting up higher.
You are hugely adept at the mathematics of the moment. I want you to correlate the bond dynamics we're all talking about over to how you reset for equities into next year. Can you link the two beasts together, or are they non-correlated?
So I think you have to link the two together, because in this year, equities were really the caboose and the bond market was driving the train here,
Right.
which I get teased about,
No,
blaming the bond market. But
Right.
it is true, because your multiples get compressed when yields and rates move higher. What the market is doing is pricing in an over 5% Fed funds rate. You're going to feel it on the equity side. You can't avoid that. It's all one system.
Okay.
You don't have assets that just trade on their own. It's against the risk-free
Right,
rate.
but in a log Euclidean space, or even if you go to some fancy XYZ space as well, is it non-linear from here in the dynamics of the bond market pushing stocks around?
So that's a really interesting question. You're asking, has the work been done? Right. You're asking, have we had enough multiple compression? And I think the answer is the direction is still in a volatile way. But I do think a lot of the multiple compression has already been taken care of, because if you think we're headed into recession the first half of the year, you're going to wind up with lower yields eventually. And that, in a weird way, is going to support the market. Also, the earnings season is coming in, Lisa, as you pointed out, better than expected, in part because of inflation, in part because we had the financials report, and so they're doing well on net interest margin. And, the high-end consumer is spending. Think about Nordstrom's. Think about LVMH. And travel. So people are out there spending. It's not a total collapse yet. So you could have some stabilization as you have two-year yields move higher.
So what happens first? The Fed blinking, or seeing yields kind of get out of control and cause some sort of torpedo effect in the multiple valuations?
So I don't think the Fed blinks. Okay, so the Fed will blink if there's an event. And right now, the UK walked back from their event, which walked back the event on the global bond market. And they seem very intent on getting higher here. And they've really trapped themselves, right? They've trapped themselves because they keep on talking about CPI, which, as you know, is backward looking, because they want to signal to the average household that the Fed is on the inflation job. Backward looking. We still haven't seen the effects of the rate hiking cycle for another 6 months. So, you have signs, housing's rolling over, you have signs of a slowdown, but the Fed's out there hiking with old data.
Meanwhile, taking a look at what we're expecting from earnings, we get some of the big tech names next week. We have seen Snap. That was concerning, and it's been very concerning this morning for owners of Meta, which already has tanked. Facebook has lost a significant portion of its value. How much more do the tech bubbles have to burst at a time where they've already been devalued dramatically?
So high growth names, when they stop growing high growthly, get not only an earnings downgrade, but you get the multiple compression as well. So to the extent that you have stocks that are still trading at 40 times next year's, the tech names are still too high. Ultimately, those names have not been driven down dramatically.
I got to slip this in. If there's a factor adjustment into 2023, and I'm really big on the zombies are going to be taken out in this new rate regime, what do the non-zombies do, and which factors matter next year for the profitable non-zombies?
So there will be a wave of M&A coming from the non-zombies, and cheap, right? You're going to have really fire sale of companies here for IP as well. You could have M&A just for IP in some of these sectors. But, ultimately, to the extent that companies raised cash during the time of near zero rates, you should have some resiliency there. I think the credit cycle happens in the private markets, in those middle markets where they couldn't quite raise the cash, because the corporate America is flush with cash right now. The refinancing there is not going to be the problem. And ultimately, the American consumer, I was looking at the unemployment data yesterday, the new claims data. We're at rock bottom.
Yeah,
there is not a problem in the labor market here. So, you have this weird push-pull where you're getting the bullwhip effect on inventories, and you've got labor working and spending.
Yeah. Alicia Levine, too short. Thank you so much for being with us. Alicia Levine of BNY Mellon Wealth Management. That is one of the most fascinating points, Tom, this idea of the private markets being where the big reset comes. And we heard from Harvard's endowment, and they actually said that they outperformed what they actually expect to have done in retrospect because they haven't yet seen the big markdowns in the private markets from some of their managers.
I like what we heard earlier this week, where we go back to alpha, where individual security selection, bond and stock, really begins to matter. I can't emphasize enough the percentage of people out there that have never lived a Sharpe ratio, a legitimate risk-free rate into the risk-reward calculation.
Who've lived by indexes, who've lived by blanket buying.
They've lived by the great disinflation.
Right.
It's gone.
And so now what happens when you get a credit cycle in assets that you actually have to look at, right? I mean, that's what we were just hearing from Alicia. And I thought this story was interesting. Apollo and JP Morgan are working on building out secondary trading of private credit because they're anticipating the same kind of thing. And there's been some reporting on that because they expect that to be.
They're going to trade Bitcoin?
Well, I mean, I guess.
What I would say is in the 8 o'clock
lucrative.
hour on a Friday, we have Alicia Levine over to Steve Major of HSBC, and that's what the show's all about.
Absolutely. Steve Major has been really out front, and he's going to have a pretty controversial call. I don't think he sees up and away for yields the same way that perhaps Larry Summers
Oh, no,
does.
it's going to be fascinating. Plus, he's got to talk about Aston Villa and Steve Gerrard out the door.
Well, I will let you spearhead that
I'll have a
discussion.
monologue on that because where the hell is Pharaoh, right?
You're going to have a monologue on that coming up, hopefully without just too many monologues. Stephen Major, Global Head of Fixed Income Research at HSBC. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Kriti Gupta. Biden administration officials are said to be discussing whether the U.S. should subject some of Elon Musk's ventures to national security reviews. Sources say that would include the Twitter deal and SpaceX's Starlink network. U.S. officials are uncomfortable with what they see as Musk's increasingly Russia-friendly stance and his plans to buy Twitter with foreign investors. Ukraine's foreign minister says he talked with Israel's prime minister about Kiev's request for defense systems to help combat Russian missiles and Iranian-made drones. Israel has offered to assist Ukraine with a missile warning system, but says it will not provide weapons. The U.S. has accused Tehran of sending trainers and technicians to Crimea to support Russian drone attacks. American Express has slumped after it set aside more for bad loans than analysts expected. It suggests rising interest rates could start hammering customers' abilities to pay their bills. Provisions for souring loans were $778 million in the quarter, worse than the $573 million analysts in a Bloomberg survey were expecting. The European Union has agreed to press ahead with a set of emergency actions to address the bloc's energy crisis. It comes after Germany yielded to pressure from other member states to pave the way for a temporary price cap on natural gas. The European Council's president says the move sends a clear signal to the market that the bloc is ready to act together. And Credit Suisse will aim to settle a tax fraud and money laundering case in France on Monday. The Swiss lender is reportedly in the final stretch of negotiations with prosecutors to reach an agreement that would include a fine but no admission of guilt. The size of the settlement is unknown, and the deal could still fall apart ahead of the court hearing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kriti Gupta. This is Bloomberg.
I think that as we move forward, we're going to find that this is going to be an even tougher environment than people think. And I've been advocating something I've been advocating for a long time. This might be the return, to use the Wall Street term, alpha. This might be the return of stock pickers and bond pickers.
Tough. That was Jim Bianco, president of Bianco Research. Tough today in the FX market. Bonds on the move, currencies on the move, and it is a strong dollar. It is weaker bonds across the world. Yields up. Tom, things, it feels like, are starting to break around the edges.
Right.
With right now the Japanese yen at 151.8.
We're going to dive into this with Steve Major in the next half hour, but to take 30 seconds and steal it from Ed Ludlow on Twitter right now, we are at a moment here. I can't say enough, folks, looking at the Bloomberg terminal, the critical breakage points here on the Bloomberg Dollar Index, which shows, I'm going to talk pro talk here because it's that important. Short-term convexity on Bloomberg Dollar Index taken log. I see the yen breaking out with new velocity towards a 152, and sterling, with all the politics going on, Lisa, is absolutely textbook short cable, textbook chart short cable right now.
But how much is this really being driven by the dollar story and the yield story? And I say this because, yes, the UK has been a train wreck in terms of the political turmoil. However, you're not necessarily seeing this just only isolated to Great Britain. It's also the yen. It's also the euro. It is
absolutely global. And I got to stagger back to one statistic here before we get to Twitter. 1.81% on the U.S. 10-year real yield. That is moving. That is almost to the phrase leaping logarithmically up. And from a 161 to a 180, maybe that's the one statistic that helps.
We're talking about how quickly yields are moving on the flip side of the dollar and the real yields, the nominal yields,
10 basis points,
4.33% for the 10-year Treasury yield. At what point do we end up with something that really is a game changer in terms of longer-term expectations?
Keep you abreast of this, and of course, looking into foreign exchange is the deepest part of the market. The deepest part of Elon Musk's market is, well, maybe it's not going to work. A number of items out this morning saying he may have another cash call to finally get this transaction done. Edward Ludlow joins us right now, expert on all this. I think there's 4 Musk stories this morning. Which one matters for his ability to get this transaction done?
Yeah, the Bloomberg report that DC's antagonized by him.
This is about Biden, national security.
Yeah, so Bloomberg
Council,
reported that according to sources, his recent behavior and commentary around the war in Ukraine, about his brief threat to remove the Starlink connectivity services that he was providing to help the efforts in Ukraine, and also just simply the deal to buy Twitter. Our sources tell us that across a range of government agencies, they're thinking we might take a look at this. Now, by the way, public service announcement, the White House has this morning said that it's not aware of any review of Elon Musk's security clearance or any security review of his businesses. But clearly they're thinking about it. This isn't the first time it's happened. 2019, he goes on the Rogan podcast, smokes marijuana. He also leads the biggest private space company.
Come on. You're not going to equate marijuana with a guy who builds technology which helps Ukraine in battle.
I'm not. All I'm saying is that this discussion around Elon Musk's behavior and his security clearances. Remember, SpaceX provides services not just to NASA, but to the military and the Pentagon. But also, he's a big contractor, right? And they simply said this is not behavior forthcoming or fitting for somebody who has this level of security clearance. The bigger issue around the deal is this. Ironically, we'd reported things going pretty well. Bankers on both sides working. The bank's getting ready for the debt call to come in, right? And then this comes out and it throws the deal into doubt, and you see that reflected in the market.
This is a distraction, let's be honest, because Twitter has been an ongoing distraction, a story unto itself with the Elon Musk kind of hubbub, but it masks the real story even at Twitter, which is that they were planning cuts at the company even before he got involved, that this was a company that was really struggling. And you're seeing that not just with Twitter, but the social media facing tech companies more broadly, as we saw from Snap. I mean, how much have we seen the reset already take its course versus have more to go?
Go back to what Jim Bianco just said on this program. The shock is greater than we expected. Actually, we thought the softness in the advertising market was done with. After the war in Ukraine and in Europe in particular, we had the commentary from Alphabet, parent of Google. We had the commentary from Snap actually already. But the wording in their earnings statement was so specific. A pullback in spending by advertisers. They're decreasing budgets, and all of these names are fighting for a small pool. Why is it important? It's actually a pretty good lens into the macro picture. Advertisers pull back their spending because consumers aren't spending. Why? They're hurt by inflation.
People are probably not interested as much in tech right now because they're looking at markets and they see, hold on a second, and they see yields moving dramatically. But this is part and parcel of potentially a similar story. The free money is over and tech is going to be reeling. And that is what we're seeing right now play out.
My eyes didn't light up just because I'm interested in tech and I'm trying to justify my existence. But, I take Citi, for example. They have this call where they're overweight global tech. Why? Look at the specific names, the one with the strong balance sheets, with the entrenched market positions. When you're trying to work out what to do in an earnings season and where earnings on an EPS basis will hold up better than other corners of the market, there is a thinking that actually, of course Apple's going to fare better here. They're more nimble. They've got the cash to flex. They're smart about how they handle the economy globally. So there is some optimism out there around global tech being a better play, almost like a defensive stock.
Yeah.
Do you buy that theory? I don't know. But there is some corner of the market that believes that.
We'll perhaps find out. Ed Ludlow, thank you so much, of Bloomberg. We'll find out perhaps on Thursday with the earnings. Right now, stocks and bonds very much on the move, yields higher, and the dollar really preeminent, Tom, around the globe.
Well, when Bruce Galbraith tweets in and says, Tom, give me a DXY quote. I don't have my Bloomberg with me. Bruce, good morning to you. DXY 113.86 out to 114. 115 is an unimaginable print. And I'm going to go right back to the IMF meeting where on camera and off camera, it was the same thing. They're watching swap lines, which is the borrowing of overnight money, think Friday, between major countries, including Switzerland. It's confusing, it's advanced, and critically, the nations that do not have available the ability to go out and borrow gajillions of dollars overnight, that don't have swap lines. And I'm going to say that these are the shadows cast right now by the rumors, the speculation, Lisa, about the unknown of swap line discussions of the IMF and all the major central banks.
Are you suggesting that there's some sort of backroom negotiation that has to be going on?
No, I'm not saying back room. I'm saying I'm looking at the Bloomberg screen on a Friday, and it's giving me all sorts of information that there's something going on out there. I don't know what it is.
I think that there is something going on. There's yields higher, and there's the dollar markedly stronger, and even more so as the moment goes on. And I do have to keep coming back to the yen. We had expected intervention. It has not come yet, at least to the satisfaction of markets, with a pervasive weakening in the currency as they stick by their yield curve.
Their goal is control there, and the way you get control is Saturday, Sunday into their morning. Stay with Asia and Bloomberg Radio and TV here on Sunday.
And Stephen Major, he's coming up. Cannot wait for that discussion.